All right, 9 o'clock on this Wednesday morning, July the 7th. Welcome to Yahoo Finance Live. I'm Miles Upton, joined as always by Julie Hyman and Brian Sazzi. Let's take a look at futures this morning. We have an interesting day unfolding in financial markets. So we see equities here, NASDAQ futures leading the way higher, Dow futures under pressure once again. But the action this morning is really happening over in the Treasury market. The 10-year yield during yesterday's trading session falling down to around 1.38%. That was the lowest that we'd seen since March. Now a further move lower in 10-year yields. We actually got a print below 130 basis points, the lowest since February. So of course, we sit here for months and months and talk about higher inflation and rising yields, and here we are round tripping with yields, particularly on the long end of the curve. We'll talk about that coming up later on in the program, and of course, stay on this story throughout today's program and really just thinking about what this means for where markets are going. And the trouble continues for Didi, the ride-hailing giant, removed from WeChat and Alipay after Chinese regulators opened a cybersecurity review into the company. Of course, that came over the weekend, really on Friday night, just one day after Didi had its much ballyhooed IPO here in the U.S. Stock was under serious pressure yesterday and off an additional 3% in pre-market trading. Plus, Nextdoor is going public in a SPAC deal that will value the business at $4.3 billion. Company CEO Sarah Friar is going to stop by in just a couple of minutes to talk about the prospects for that company. And Apple, Amazon back on the Yahoo Finance trending ticker page. Apple is up about 13% over the last month. Amazon shares yesterday on Andy Jassy's first day in office hitting a record high. Of course, the growth names back in favor. Treasuries certainly a part of that. We'll break down that trade coming up here in just a little bit.
All right, as Miles just mentioned, Nextdoor said this week it plans to go public through a merger with a SPAC in a deal valuing the company at $4.3 billion. In its investor presentation, the company said it has 27 million weekly active users and that 1 in 3 U.S. households, in fact, use the platform. Nextdoor added it sees sales growing 44% this year to $178 million, leading to an adjusted operating loss of about $50 million. Sarah Friar is Nextdoor's CEO, and she joins us now. Sarah, good to see you here. Congrats on this deal. The last data I saw on Nextdoor, you were valued at about $2.2 billion for a capital raise in 2019. Now the valuation has been bumped up to $4.3 billion. Why that bump?
Well, largely due to growth. We're in hyper growth mode. We saw phenomenal growth in 2020. Our DAO, our daily active users, grew 50% year over year. And as you noted, we've now reached 1 in 3 households in the United States. And of course, we're global. So we're in 11 countries around the world, 276,000 neighborhoods. And in countries like the UK, for example, we're seeing that same build happen. Today, we're in about 1 in 6 households and actually a little bit under 1 in 5 in London. So with that scale, brings monetization, brings a great business model. And so the valuation has risen commensuratively.
And, Sarah, I'm curious how you guys, and you outlined a little bit in the presentation, where you see yourself sitting with respect to competitors. I'm looking at the graph here where you have, you're comparing the frequency of use that Nextdoor has to Instagram and Twitter and Spotify, Weather Channel, so on and so forth. What I don't see on there, which is where my mind went, was, your Angie's List type home, referral services. How do you think about the opportunity that you guys have there, relative to the opportunity you have against some of these social networks that, again, are a little more prominent in the presentation?
Yeah, I mean, for sure, we are a local network, a community network. And so that is why we do have as a comparison set a lot of the companies that you mentioned, where we excel, number one, in retention. So our 3-month all the way to 2-year retention is head and shoulders above those peers. We're best in class. I think the second thing that we bring is a really unique audience. So we do show a chart in the presentation that shows that people who are coming to Nextdoor aren't visiting a lot of the other social media sites. So for advertisers, that unique audience is a way to get their message to people they can't reach any other way. But to your point, we are building overall a marketplace as well, right? We have aggregated all of these neighbors and neighborhoods around the world, they come to Nextdoor for utility and they come for community. But on the utility side, often it's to find the best plumber in that moment, right, where you have a leaky faucet. Maybe it's to find the best cup of coffee because you've just moved into your new house and you're getting to know your neighborhood. So of course, that allows us to really speak to those local businesses. We've done a lot of investment in the last 2 years in building out a business platform, an ad platform for them. It's been incredibly successful, as you can see from our revenue growth rate. And so that does start to bring us into the zone of folks like Angie's List, Thumbtack, who are actually our customers because they come to Nextdoor to be able to put in front of our neighbors those pros that they have aggregated as well. So sometimes it's a first party return. So a neighbor gives you that recommendation you really need. And then sometimes it's coming from a great customer of ours that can also help you get to that pro in your moment of need.
And you guys also talk about the TAM for the business has almost doubled globally. You see it, doubling over the next couple of years. And I'm just curious how much maybe COVID-related mobility trends are driving that, or is it more just Facebook and Google clearly have a chokehold on the digital ad market, but with a growing market, it follows then that there is a larger opportunity for additional competitors if they can gain a toehold.
Yeah, so there's two ways we define TAM. There's the TAM just first of all of neighbors coming to the platform. And what we see there is Nextdoor has an inherent network effect, a true network effect, right? When you join the neighborhood just got better for everyone else on the network. And so we know that when we start in a younger neighborhood, we'll see good engagement. But when we get up into our top quartile neighborhoods, we see an over 2x improvement in engagement. And so what that's doing is driving the TAM of neighbors who can come to the platform. So there's really good growth there. And of course, international only further bolsters that. And then what you're getting to is the digital ad market. So there's not an advertiser that I speak to that isn't moving their spend online, right? Print, TV, just getting harder. With digital, you can really target your customer. And so Nextdoor is part of that shift to digital. Where we are unique is we are hyper local targeting. So whether you're the local mom and pop coffee shop or whether you're the largest retailers in the world, folks like Walmart, we can make sure that you're getting your message into the neighborhood and often in a really hyper local way. We can actually change the message in the app to recognize a neighborhood and maybe a piece of information that's particular to that neighborhood. So it's definitely helping drive our growth. And I think it's providing yet another new place for digital advertising to happen.
Sarah, it's Julie here. I want to ask you about content moderation, which I know has been a challenge for you guys like it has been for most social networks. A little bit different for you guys because you do have that location attached to your users. And I know you have spent some resources on trying to fix, for example, some racist comments that had been in some of the discussions. So now that you're going to have more resources, what kind of efforts are you going to continue to put in or even ramp up when it comes to this area?
So this is a hugely important area, right? We have to earn trust every day. It's our number one core value. Nextdoor is really founded on trust. So remember, where we're different from other networks is, first of all, when you join, we confirm that you're a real neighbor in the real neighborhood. So we don't allow avatars and bots and people to have multiple, usernames and so on. So what that does is it brings accountability. It's harder to be completely obnoxious when you might end up standing, on the side of the soccer field with that same person. On top of that, we built out local moderation because we think it's important to have local context. But of course, technology also plays a part here. So we will invest in areas like machine learning and data science to make sure that we're catching content that may be inherently toxic in a neighborhood, right? We want to build out kindness. And then the other thing we've done is we've done a lot of work with behavioral scientists, some of the best in the world, to be able to put into the technology ways to just help you be more accountable and be your better self. We don't want to stymie tough conversations. It's incredibly important right now that we can talk about things like race, for example, in neighborhoods. And so to do that well, though, we often often slow people down. We've done things like anti-bias training. We've done an anti-discrimination reminder, a kindness reminder, and all of these things just stop you in the moment, remind you that great neighborhoods are created with kindness. And we find that people often edit what they're saying, but they still post. So the conversation, importantly, continues, but it continues in a much more constructive way.
Sarah, I didn't catch this in the presentation, but when do you think the business model will turn profitable?
So the way I think about that is, while we can drive hyper growth, investors want us to keep investing, right? Our profile is as a growth company. Historically, I've often run to the rule of 40. Investors may have heard of that. So the concept is that you add your top line growth rate plus your EBITDA margin. And if that's above 40, that means that what you're doing is on a good course. So in a high growth company like Nextdoor, we will keep investing behind that growth, probably for many, many years, because of our ability to do things like take the platform and shift it globally. But we know we have a really profitable business model, right? It's a proven business model, gross margins over 80%. So if we do need to turn down investment, we can do that actually relatively flexibly to turn up overall profitability if our growth rate were to start to slow. So for now, definitely in growth mode, but something we keep a very firm eye on, and something that I've learned, through my years of working with great growth companies like Salesforce and Square, for example.
And Sarah, you're on the board at Slack, and you're on the board at Walmart. And you've been on that board at Walmart since 2018. I would imagine somewhere close to when you took over from Nextdoor. It's not very often you get to work with a family like the Waltons and a CEO over at Walmart like Doug McMillon. What have you learned since being on that Walmart board, and what have you applied to Nextdoor?
Yeah, it's a great question. When I was joining the Walmart board, I read the book about Sam Walton, and never was there a person more community minded. And so that was actually one of the reasons I got really intrigued by what they had built, right? Walmart is the ultimate Fortune 1, but also the ultimate community business, right? They are often the only store in town, and they often act not just as a place to go buy things, but as a meeting place, a place where communities can come together. And so that's certainly one thing I've learned. They're also global, right? We've done some amazing work with Walmart in countries like India. And so learning from Doug how he manages that global expansion has really been incredible. So I feel really gifted to have been able to spend time watching a company at that sort of scale, particularly with Nextdoor and the scale that we know we can build. Nextdoor should be a global concept. Everyone is a neighbor. Everyone wants to drive that community and needs that utility in their local neighborhood.
Everyone needs those $4 or $5 hamburgers that Walmart sells at a discount, low price. We will leave it there. Nextdoor CEO Sarah Friar, good to see you. Good luck on the transaction. We'll talk to you soon. All right, coming up, the Yahoo Finance platform is lighting up with intense activity on 3 big tech stocks. More on these hot names straight ahead.
You're watching Yahoo Finance Live, and we have been watching what's been going on with large cap tech as of late, as have the Yahoo Finance users, because we've seen really a resurgence of the FANG stocks on our trending tickers list. This sort of goes hand in hand with what we've been watching about the weaving in and out of the value versus growth trade, that as we've watched that evolve over the past year or so since the onset of the pandemic. Take a look inside the Yahoo Finance Interactive, because we're looking at here a comparison chart of the S&P technology ETF, the XLK, versus the financials, the XLF, just as representative of these two groups. So this is a one-year chart, and you're seeing that really after the financials had been performing better for the year to date. And here's a look at the 2-year chart of these. So technology performing better over that period. But if you take it to 1 year, you have seen a flip of that script. And then if you just look over the past 3 months, we see a flip once again. So again, technology sort of coming back to the fore if you zero it out and normalize these charts in these different time periods. Another way to look at that is just to look at these charts of the individual movers. Amazon, for example, which we've been talking a lot about, with Jeff Bezos leaving as the CEO, staying as chairman, and Andy Jassy taking the reins. But, you know, you see Amazon now hitting new record highs. We're looking at Apple potentially opening at a new record here today. So all of these stocks coming back in pretty decided fashion, Brian. And I know that's something that you've been watching as well, not just the FANG stocks, but something like NVIDIA, too, which has been on a big winning streak as of late.
Yeah, this NVIDIA move has been impressive. Investors clearly buying, I think, the stock in advance of that $40 billion ARM deal getting closed. But, you know, Julie, you mentioned Amazon. Over the past 24 hours, Amazon and Apple have been among the top 2 hottest trending tickers on the Yahoo Finance platform. And I have not seen that for a while. We have had a year pretty much dominated by an AMC, a Bed Bath & Beyond, a GameStop dominating this list, which tracks the hottest tickers on the platform. And that big cap tech trade has fallen by the wayside, but not right now, at least for the past 24 hours. And I was locking in on the NYSE FANG Plus index that tracks the FANG stocks very closely. That is up 17% since hitting a 2-month low on May 12th. Very interesting move here. The 2 stocks essentially powering that move here, Miles, is Amazon and Apple. Apple is the top performing FANG stock over the past month.
Yeah, I mean, speaking of NVIDIA, I would just like to posit that I think NVIDIA should replace Netflix as the member of that group. Netflix shares flat over the last year, and it's been a good performing stock. But even if you go back over the last 5, really hasn't been as exciting as NVIDIA has been over that period. But I think that both the growth trade and then to see what's happening with yields, it's another. I think to me it speaks to 2 things. The first, which is an obvious point, which I think we can all see, is the market just falling into what's familiar. And I think that's to be expected through certain periods of transition. We obviously had a major shift in leadership for a several-month period at the beginning of this year. You had the meme stock trade happening in the background of financials and value, cyclicals, small caps doing so much of the leading for really 6 months, 8 months. And so to see some rotation back into what worked, not just in 2020, but what worked for years, which is betting on low rates and high growth tech stocks, I think makes some sense. And then also just the speed with which the rotations in and out happen, especially this quick move that we've seen into tech. It really didn't get started until early June in the run up to that Fed meeting. And then, of course, it has continued as we get into the second half of the year. And we've remarked several times over the last, well, I guess really the whole time I've been here at Yahoo Finance, but one of the foundational themes for me in terms of following markets is just the speed with which things happen, where it goes from no one is talking about this to everyone talks about it. Oh wait, the move is done. And I think that we see a lot of that playing out with this little mini rotation as well.
Yeah, just wanted to mention real quick what we're looking at on the screen is sort of representative of what you're talking about, Miles, and that's the ARK ETF, the Arkiverse, as you like to call it, that we've talked so much about, that had such a dismal spring, right, as we saw this trade coming off. It's coming back, right, and value is coming off a little bit in comparison. Here we're looking at the iShares MSCI Value ETF, just as a point of comparison, just another way, again, to sort of express what it is that we're talking about.
Now, let me go back real quick to what Miles mentioned, the 10-year yield in the rise in tech stocks. It is fascinating. And Julie, you flagged this before we came on air. And the 10-year is what, close to 1.3%. The move down since the Fed meeting has been absolutely remarkable. But that has caused this rotation back into tech stocks. And if you take the NYSE FANG Plus index and overlay it with the 10-year yield, you could pretty much see that index start to take off just as the 10-year yield started to fall. So Miles, right, you're right on. To your point, tech stocks are probably likely to continue that bid higher for as long as the 10-year that bias remains the downside.
Yeah, and look, I'm poking fun a little bit of a cheap shot here at the folks who've been calling for higher yields for the last 30 years, 40 years in some cases. But there's an inherent pessimism in saying that inflation is going to run rampant. There's also an inherent pessimism in low interest rates and low yields. Of course, those are on opposite sides of how you would trade an inflationary event. And so to see that coming to the market is always an interesting sort of pretzel here for folks.
Yeah, and it is an interesting thing that we always talk about stocks being a discounting mechanism. I mean, what is the bond market telling us right now about the future pace of economic growth? We know there are concerns maybe about, we're at peak, it's going to slow, but is it going to slow such that 1.3% is warranted on the 10-year? I guess that's something we'll have to just wait and see. In the meantime, we're going to wait for the opening bell. We're going to take a quick break. And when we come back, we will have that bell for you with, as we've been talking about, NASDAQ futures showing strength, even as the Dow and S&P more tread water. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Wednesday morning, about 3 minutes out from the opening bell here on what's shaping up to be an interesting day in markets. We see futures here not doing a whole lot. NASDAQ futures leading the way higher this morning. Dow futures pretty much unchanged here, off about 6 basis points. Of course, all the action, as we had just been discussing, is happening in the Treasury market. We see 10-year yield down to around 1.3%. Let's stay on the topic of rates and how they fit into the picture here. Bill Smead joins us now. He's the CIO and co-portfolio manager at Smead Capital Management. Bill, great to speak with you once again. So I'd love to just start with how you're thinking about the move we've seen, not only this morning in the Treasury market, but really over the last 6 weeks or so after we hit that high back in the spring, and we've seen a lot of air come out of at least the yield so far, and particularly the 10 years we have here on the screen.
Right. So first off, I'd like to remind everyone the most damning words in investing are "it's different this time." So what happened 12 or 13 years ago coming out of the financial crisis is the United States government borrowed a ton of money to recapitalize the banks. And everyone thought for sure that inflation was going to be caused by that. And literally, people staked their career on the idea that all that $1 trillion of federal government borrowing was going to cause inflation. Well, where they were wrong is just because you double the amount of money in the bank doesn't mean anyone's going to use it. And the difference this time is we've borrowed $4 trillion or more dollars, and there are 90 million millennials that are starting to use it. So Julie mentioned that what is a 1.3% Treasury interest rate on 10-year telling us? Well, it's telling us that that's the price today that buyers and sellers are agreeing to. That's all that tells you. It doesn't tell you anything else, because what did the stock market tell you at the bottom in 2009? That people were stupid for not buying. What did the top in 2000 tell you? That the day before the tech bubble broke, it was the price that people met to pay those very high prices. So the market isn't there to teach or tell, it's there to provide opportunity. And we will get inflation from this. We already have inflation for this. Go buy a car, go down to the auto dealership to buy a car and find out how much they're marking it up above the invoice.
I actually did that very thing this weekend. Just hang on for 1 second, Bill. We just want to take the opening bell here. Zega Financial, ringing that bell. It's got a new ETF that's coming out, so they are marking that. So, Bill, obviously, yes, we are seeing prices go up. The question has been whether they will continue to rise at this pace, which the Fed has said they are not. So let's put all this aside for a moment and look at the question of what opportunities you are finding. If indeed the market is not there to teach us lessons or tell us anything, but is rather to provide opportunity, what opportunity is it providing us with a 10-year at 1.3%?
Great. Great question. First off, the commodity prices in relation to stock prices hit a 100-year low a year plus ago, 100-year low. So that is a bull market. It's a spectacular bull market. And go back and look at the bull markets in equities that say started in 2009 or started a little over a year ago. The first year is always huge, a huge move. We've had that huge move in commodities, and you'll get corrections along the way. But net, we are in a bull market in commodities, and the equities that are attached to those commodities, whether it be home builders allowing individual households to lock in their rent and escape inflation on housing, or whether it's the price of oil, it's coming. It's coming. There's nothing they can stop it. It has nothing to do with the pandemic. It all has to do with 90 million Americans wanted what 65 million Americans wanted before this.
Bill, help the average investor understand this newbie investor, the 10-year yield at 1.3%. As someone that manages money, does that signal to you that the bull market is likely to continue into year end? Or does it serve as a red flag to you that the bull market might go up in smoke by year end?
What it does tell you is more than likely there will continue to be a lot of pressure on investors to own things whose price is temporarily enhanced by the inexpensive money. Warren Buffett in his annual meeting compared it to gravity. The lower the rates are, the less gravity there is. So yes, there's an undergirding of common stock prices, and Miles is absolutely right. The price earnings ratio they'll pay to buy Apple Computer or Amazon is substantially higher the lower the 10-year Treasury goes. However, all the things are in place for that Treasury to go higher. And by the way, Miles is right. People were betting for 30 years that the rates would go up in Japan. They called it the Widowmaker trade because it never happened.
And we'll see, Bill, if the Widowmaker trade can cross generations. Maybe it becomes, betting on higher long-term U.S. Treasuries for money managers now coming into their prime. But we'll have to see on that one. Bill Smead of Smead Capital Management. Bill, always great to get your thoughts. Thanks for spending some time with us this morning. Appreciate it.
Thanks for having us.
All right, let's take a look here at what's on the move this morning. Julie Hyman's going to take us inside the Wi-Fi Interactive. Julie, of course, as we've mentioned all morning, really the action happening with Treasuries. Charts are never as exciting for Treasuries as they are for the stock market, but I know it is not Treasuries alone on the tape today.
Of course not, but we'll start with Treasuries, why don't we? Because we've been talking so much about it. So I will say that we were seeing the 10-year yield fall by as much as 6 basis points earlier in the session. Now it's down about 4 basis points, but still a relatively big move considering all of the talk about inflation. That's not, what Bill was talking about notwithstanding, this does reflect inflation expectations to a certain extent, and it's not showing much inflation expectations. There are other measures you can look at as well, but this particular one just ain't showing it. Let's look at what's going on in stocks here. We are seeing on the Dow a little bit of a gain in today's session, not even 0.2%. The NASDAQ up more, about 0.4%, bringing its two-day gain to about 0.5%, and the S&P just up about 0.25% in today's session. We've been talking a lot about what has been going on with large cap tech, and that continues to mostly move higher. Let's see here if we've got that record for Apple. I believe that we do. Brian Sazi, I know that you were looking at the exact level, maybe not on an intraday basis, but it looks like on a closing basis that we have potentially a new record for those Apple shares. We continue to see Amazon push up to new highs as well, and Microsoft, as we watch it, also pushing up to new highs. So this is really a big move upward that is being led by the large cap technology stocks, even though the overall market isn't always participating in the moves we've had recently. As we like to talk about a lot, since large cap tech is so heavily weighted in the major averages, when it is strong, it tends to drag the averages along with it, even if we're not seeing broad-based participation all the time. To Miles's point, Netflix is trading lower today by about 0.5%. So, but NVIDIA is too. So I don't know if the swap works on a daily basis, but it certainly works on a longer trend line, to be sure. Let's take a look at the sectors also.
That Netflix chart is not becoming of a FANG name.
No,
Needs to be better.
Very fair. Very fair. And if you look at the sectors here, we're not seeing as clear that rotation today because energy shares are actually trading higher. We've got real estate and utilities trading lower, and then you've got tech here kind of in the middle, up just about 0.4%. We are going to get more details on what's going on in the markets with Jared Blickery right after the break. have been able to tell today, the story is a lot about the change in leadership that we are seeing within major averages, with large caps tech really coming to the fore. Jared Blickery watching that trend as well. Tell us about that and what else you're watching, Jared.
Well, I'll tell you what, I'm looking at the big board right now, mostly green, not a lot of red. What's red is very instructive. First, the 10-year T-note yield, that's down another 4 basis points. We've been talking about the move lower, might be a little bit overdone. I'll get to a chart in a second. Second thing I'm looking at is utilities. That's in the red, along with real estate. So you would expect those two sectors to be in the green, because that's what lower interest rates, especially on the long end, tends to provoke. But in fact, they're not. Also the VIX down to the low 16. Low 16s here. So let's get to some charts. I'm looking at the 10-year T-note yield, a 3-month chart on the Wi-Fi Interactive, lowest level in months, but might be getting a bit overdone. It was in late May, right in here, that I said the pain trade this summer may be into the growth trade and out of the value and cyclical trade. Indeed, interest rates collapsed from there, and now we're getting oversold, at least on the daily time frame. We could go a bit lower. We really don't have big support or potential support until 1.25%, but we get in there. I think the move is largely over. Might have a retest, but heading into earnings season in a couple weeks, I think the value and cyclical trade will pick up again, but maybe not today. We'll have to see what happens. The leadership change I was talking about earlier, let's go to the sector look. We can see we got materials, consumer discretionary, industrials, and tech, and communication services all outperforming. So we got a healthy mix of value trades, cyclicals in the form of industrials and discretionary, and also some of the big mega cap names. That would be Amazon, Apple. All these guys are represented here. To the downside, real estate and utilities. So we are seeing some interest in value and cyclicals. Now that they have sold off a bit, I would expect that interest to pick up if we head even a little bit lower. So I think people are going to test the water over the next few weeks. Having said that, let's go over some of these sectors and some of the industry groups that I'm paying attention to. Travel, looks like the Wi-Fi Interactive might be, there we go. Travel, the airlines are down a bit, but for the most part, we're seeing a little bit of green, kind of a good sign there. Banking, that was not one of the outperformers today. We're seeing some, I would call this a mixed board there. You take a look at the energy market. We're going to be looking forward to potentially an OPEC Plus decision today, or maybe it'll just get postponed again. Have to stay tuned for that one. Overall, and let's go to the Chinese stocks as well, because this is something I've been tracking, more weakness. And I think there's a huge, huge sea change underway here. I'd be surprised if you could trade ADRs for any Chinese company in about 5 years, the way this is going right now on this trajectory. So something else to keep an eye on and pay attention to there.
Jared, also a lot of focus on gold here ahead of the release of the latest Fed minutes.
Yeah, I've been looking at gold, and it had a nice run up. This is a 10-year T-note yield again. I'll see if I can scroll down. It had a nice run up about a month ago, and then it just kind of petered off. There we go. See if we can pull up this chart here. I think that, I was talking about the move in bond yields. You would expect gold not to perform well under this environment unless there's some kind of haven flow, and that's not happening right now. Really, everything is about interest rates and interest rate differentials if we don't have those haven flows. So you talk about what's happening with gold, the US dollar. That's going to depend on what the projections, what people think the Fed is going to do in response to its bond buying or tapering in that regard. So I think gold is going to perk up as we get resurgence in the long end of the curve. Could take a few weeks for that move to get underway. And then are we going to see all-time highs in gold? Might take until the end of the year, maybe next year. I'm not a huge gold bug right now. I do like it in certain instances, but the potential for a big move, I think, is probably later in the year.
Interesting. All right. A little bit of gold bugism from Jared Blickery here this morning. Thanks so much, Jared. We're going to take a quick break. When we come back, we're going to talk more about a story that Jared mentioned that's an important and developing one, and that has to do with Chinese regulators cracking down on foreign listings of Chinese firms, how that's affecting those firms when we come back.
All right, welcome back to Yahoo Finance Live on this Wednesday morning. We see stocks higher here as we get today's trading session underway. One stock that was under pressure in pre-market trading has been a big story this week is, of course, DD. The stock falling sharply during yesterday's session, and we see off another 5% news that the company's main app has been removed from WeChat as well as Alipay. Yahoo Finance's Akiko Fujita joins us now for the latest on this story, Akiko, which continues to get a little bit more muddled and a little bit less constructive, I guess we could say, in terms of DD being able to reassure the market about the state of its operations.
Yeah, and it feels like we're getting a little more clarity on what exactly the motive of the Chinese government regulators are in terms of cracking down on Didi. But let's start with that story you just alluded to in terms of the Didi app being removed from WeChat as well as Alipay. And of course, yesterday we were talking about regulators calling on those apps to be pulled from the App Store. Now, WeChat and Alipay certainly not app stores, but this is a significant development largely because of the big user base within both apps. We're talking about these Chinese super apps where everything on mobile evolves around these apps, whether it's transactions as well as interactions. WeChat has 1 billion users. Alipay has 900 million. And now the apps had provided a shortcut for users to be able to get into the Didi app. That has since been removed. So while users who've already downloaded Didi can still access it, they wouldn't be able to do it through these apps. So that would create another hurdle to getting through to the app. Now, separate from that, we did get additional developments from Chinese regulators, specifically Bloomberg reporting the Securities Regulatory Commission in China is looking to revise rules for overseas listings to specifically crack down on companies that use a structure known as a variable interest entity, or VIE. Now, that structure allows companies to transfer profits to an offshore entity registered in places like the Cayman Islands with shares that foreign investors can then own. Now, many companies, including Alibaba, Didi, Tencent, have all been using this structure for years, and it has allowed firms to exploit a loophole, largely because the regulations as they stand on the books in China don't necessarily make reference to companies that are registered outside of the mainland within these jurisdictions. The revised rules would require those firms to seek regulatory approval before listing outside of the mainland. And for firms that are already public, they would now need approval for additional share offerings in offshore markets. And we're mentioning this obviously because of Didi as well as those other companies like an Alibaba that trades in the US. But this could also create huge hurdles for companies that are seeking a listing outside of the mainland. A lot of people looking at ByteDance, which is the parent company for TikTok. They've been looking at a listing overseas. There are now questions about whether, in fact, they could delay that further, or they could potentially be forced to list a little closer to home, guys.
So, I mean, Kiko, it's kind of one of these, we talked about this yesterday with this story where, you have Chinese regulators want to accomplish a certain goal, but maybe they go about doing it in unconventional ways, let's say. But is there common ground here between what Janet Yellen and Treasury wants to do and what Chinese regulators want to do in terms of closing some of those loopholes? Because that's where my mind went in talking about the VIEs.
Yeah, it's interesting to see this because while regulators haven't officially recognized VIEs, regulators have known about it for years. And this dates back to the early 2000s in terms of these structures being used for Chinese companies who are listing overseas. Now, yesterday we talked about this. There have been concerns within the U.S. as well, lawmakers really pushing for increased transparency for these companies that are registered in places like the Cayman Islands. So it does seem like increasingly these Chinese companies are being squeezed on both ends. And Jared just alluded to this. He said he'd be surprised if any Chinese ADRs would be traded in the U.S. 5 years from now. Miles, the other day I was thinking back to a conversation I had back in 2019 when those who were pushing for these laws were saying, look, this is going to be the reality moving forward. Now it seems as though Chinese regulators are catching up to that and saying, look, you can list overseas, but if you do, you have to play by our rules.
Yeah, well, look, with the number of SPACs that are out there, maybe we can replace some of the Chinese ADRs with more oat milk companies or something like that. Keep the markets churning with a different composition. All right, Kiko Fujita with the latest on the evolving DD story. And of course, main implication here, stock remains under pressure off an additional 5% this morning. All right, off for a short break here. On the other side, we will double click on Brian Sozzi's favorite story, which is what we've seen with Apple shares over the last month, now up almost 15%, stock trading up to a record high. I'll talk about that coming up after this.
Well, as we've been talking about Apple shares amongst those large cap tech stocks that are doing quite well as of late. Question is, though, can you continue to ride this momentum higher? That is a question, Brian Sozzi, that you are attempting to answer today. So what are you hearing out there?
Doing what I can there, Julian Miles. And I think the headline here, at least for me, is investors are devouring Apple stock. They're just nomming it here in the market. First, the numbers, though. Apple stock is trading at a record right now. Before this session, the record was 143.16, hit on January 26th of this year. The stock is now trading above that. Apple stock, the past 6 days, up 10.2%. Again, coming into the session, looks like it will tack on more gains there. And then Apple stock is the best performing FANG component in the past month, with a gain about 11% or so. Amazon stock is number 2, despite the leadership transition, Andy Jassy taking over as CEO from Jeff Bezos. In the latest push higher this week, besides the declining 10-year yield, sending up those big cap tech stocks, I think really comes compliments out of JP Morgan analyst Samik Chatterjee. Yesterday, he lifted his price target on Apple to 170 from 165, really noting here some important points. First up, Apple's stock doesn't deserve to be underperforming the S&P 500 in 2021. And if you zoom out, can't believe I just used that term, never liked it. Nonetheless, if you zoom out on the year, Apple stock is only up about 7.5%. Obviously, that trails the S&P 500. Surprising note there as well. But Chatterjee says that is not justified given Apple's shift to more services. And likely in front of this bullet point here, number 2, here comes the big iPhone launch in September. Always a very important event for Apple, as I will dive into very shortly. And then last but not least, iPhone 13 volumes are likely to be stronger than expected, Chatterjee notes, in large part because by the ongoing push to 5G. And I think this quote from Chatterjee is probably the most important out of this note. It says the historical track record for Apple shares heading into the September iPhone launch event has been to outperform the broader market consistently each year. And this ultimately brings me to my take, which includes the chart that Chatterjee put together. As you can see, in the second half of the year, historically, Apple shares have outperformed the S&P 500, really by a wide margin. Sure, there have been a couple down years, but you look at the past 2 years, Apple has done pretty well after it's released the new iPhones. And my take is pretty simple. Step in front of Apple's train and risk getting run over. It's going to be hard to come here and try to bet against an Apple's stock, just especially off of the move we are seeing in right here. Obviously, one of the most widely owned stocks. Now people are getting more excited about it. A very interesting year-end rally here into Apple.
Most definitely, Brian. And one little thing that you said that I just want to pick up on, and that is the ongoing promise of 5G, which Apple has certainly talked about, which a lot of the telecom providers have talked about, including our, for now, still parent company, Verizon. And I feel like maybe consumers haven't quite adopted that in the numbers that would be hoped. And I don't know if that disadvantages Apple at all. Maybe people just buy the phones and they won't turn on the 5G service. But I think it's something to continue to watch, because I think you have 5G on your phone, if I'm not mistaken, Brian Sazi. And I don't know how often it actually picks up the 5G.
All the time, Julie. It's super fast. Love my 5G, which is in fact powered by our parent company, Verizon. But listen, it gave me another reason to go out there and buy a new phone. I paid more for this phone. I like it. I use it. I'm downloading more apps. Things are faster. It works for me. And I suspect a lot of other consumers are out there like me, generally have no clue what they're buying. You just need the new iPhone because your iPhone that you've had the past 3 years really sucks. It's not working right anymore. So why not pay $1,100 for a new iPhone, download a bunch of new services. Apple makes more money, stock goes higher, end of day.
And we can't have it both ways. You can't argue that consumers don't know what they're buying, but also 5G is a big, super cycle for business. But whatever, let's leave that aside. I think something also for Apple here, and maybe it's, maybe it's something that doesn't come up this quarter. Maybe it never comes up, right? I mean, Apple's been a juggernaut now for 15 years, and Sazi, now or any other time, it hasn't exactly been the best idea to get in front of the trade. I mean, 2013, maybe 2012, when Samsung was very hot, maybe the last time we saw kind of an extended lull for Apple shares, but otherwise, it's been a pretty clean run here. You do wonder about the China part of the business, their exposure to China. We're having conversations about, Didi and other Chinese listed ADR or U.S. listed ADRs of Chinese companies, and sort of, Jared's talking about these companies or these stocks might get delisted from the market. And meanwhile, Apple is just going to, whistle through and there's going to be no impact to its business in China. I mean, I don't know. It doesn't have to matter for the stock, and it may never matter for the stock, but it is, certainly an exposure within their business. You mentioned Amazon beginning a segment. Well, they don't have that problem. So just something in the background to think about for the Apple story as well.
Yeah, most definitely. And speaking of another hot stock that it's been problematic for, Tesla, which is one of the only sort of large cap tech stocks that has not participated as regularly in that recent upturn that we've seen in the FANG shares. And I don't know, maybe, if we're swapping out Netflix or NVIDIA, maybe it should be FANG T. I don't know, at some point. All right, we're going to take a break. When we come back, we'll be talking more about the markets as well as about the price picture, the inflation picture, and what's going on with chips and semiconductors in particular. is just after 10 a.m. on Wednesday, July 7th. This is Yahoo Finance Live. I'm Julie Hyman with Miles Udland and Brian Sozzi. Let's take a look at stocks here. About 30 minutes into the trading day, and all three major averages are now higher, although the Dow very marginally so. The Nasdaq continues to be the leader, although it's trimmed its gains already in this early session to just about 0.2%. We've been watching yields as well in the Treasury market because we have been seeing them go lower. That continues to be the case. We've now have them once again around the lows of the session, off 6 basis points, 1.31% here for that 10-year yield. Is the chip shortage abating? We're going to catch up with Manish Bhatia of semiconductor giant Micron on what he is seeing in this market and in their supply chain. Making coin, the crypto frenzy may have died down, but Coinbase is still a good bet. At least that's according to an analyst who we'll be speaking with later this hour. Strikes and gutters, ups and downs. We delve into the business of bowling with the president of Bolero as the company prepares to go public through a SPAC deal. But first, this morning, the morning brief. And we talk about what's going on frequently with inflation. This, of course, has been our preoccupation. It's been the preoccupation of the market. It's been the preoccupation of economists. The latest data coming in seems to be showing that prices are we're seeing a little bit of relief on the price front, even though, we talked to Bill Smead last hour who pointed out if you go to a car dealership right now, you're still paying up. But that is not quite as maybe universal as we had been seeing a month ago. And that's what you wrote about, Miles, this morning, as reflected in some recent data points we're getting.
Yeah, and the inflation conversation, again, it always needs to be decomposed into this magnitude versus duration conversation. And so as well as, the rate of change, the second derivative, as it were, right? The rate of change. And so what we are continuing to see in data, and we got this in service sector data yesterday, is that while the prices paid sub-index, for instance, in the ISM non-manufacturing PMI, the prices paid sub-index remained quite elevated. I think the number was 79 and some change was the index reading, but it was down from what we saw in May. And so a slight moderation in the pace at which prices are increasing for suppliers or for businesses is going to inform how we think about inflation going forward. It is going to inform whether that inflation data continues to come in, let's say 5% month over month. And so that's really the conversation today, and it's the conversation the bond market. And I know we talked earlier with Bill Smead, and he had his argument that the market itself isn't saying anything. But I would kind of take the other side and say that there is a story that financial markets are trying to tell you if you want to listen to it. And right now, the Treasury market is telling you that inflation pressures are cooling off. And we can go through a safe asset shortage, portfolio composition effects, flows, mid-year demands from clients who want to have more fixed income exposure, so on and so forth. We can go through the technical factors, but with 1.3% on the 10-year yield, with service sector activity, as we can see here, still high, but off of its peak, the market is saying that inflation pressures have hit their most acute point. That doesn't mean that next week's inflation reading is going to go back to 2%. It still may be a 4.5% year-over-year increase. It may be higher than that. We're still lapping some pretty seriously depressed base effects from last year. But the story that I think we're trying to relay in today's brief, and that we're starting to get from some of this services data, is that the biggest, the most dramatic impacts from inflation, those one-time hits that are shocking to consumers, shocking on the input side, shocking, for employers when they have to hire someone for that first time at $15, $16, $18, $20 per hour, those are starting to ease. We are not going to see an indefinite increase in price at the same rate we've seen this spring. And that, again, is what I think the market is trying to tell you. And that's what we are starting to see the outlines of in the data.
Miles, in terms of slowing, so if we in fact get more slowing reads on inflation, does that quantify as deflation, or do you need to see outright declines in some of these readings?
No, I mean, deflation is inflation and deflation, right? It's either an increase or a decrease in the overall level of prices. No one thinks that the overall level of prices in the economy is going to go down. In fact, it hasn't gone down. There's never been is we haven't had sustained deflation through any of this low inflation period. The whole conversation about inflation, sorry, it has nothing to do with what you pay for a burger. It has nothing to do with what you pay for a one-time purchase like a car. It has to do with the overall level of prices in the economy and how fast the overall level is changing. And if the overall level of prices changes at a rate that exceeds income growth, certainly if it exceeds GDP growth, then the reason it matters is then the thinking from financial market participants is the Fed has a problem or any central bank has a problem, and then the central bank has to act dramatically to rein in those inflationary pressures. But no, if you start seeing inflation readings, meaning the overall level of prices rises 0.1% month over month or whatever it is, that doesn't mean there's deflation. I think people, the whole problem with this is that we're just throwing around words and everyone gets all worked up about it and everyone, just talks about it through the lens of, well, here's what I think. But there are definitions, there's economic definitions around this stuff, and that's the way that this discussion proceeds. This is the lines along which this discussion proceeds, for the Federal Reserve, for instance, and that's really why we care about this in the first place. And so I think that's why we ran out of steam here. How many times can people talk about the Chapwood index and just claim that shadow stats is real inflation? We did that for a few months, and then people move on because the people who are citing that really just have a bridge to sell you anyway.
A passionate mini Yahoo you here on inflation terminology.
I just can't sit here and do is it deflation now? It's just ridiculous. We just need to think about why we're talking about this and not just wildly swing between inflation and deflation and end up, misinforming folks.
Well, what I sort of find interesting here is that there was this sort of hyperventilating about inflation is not going to be transitory, or this pace of inflation is not going to be transitory, and probably quicker maybe than anticipated. Maybe we're seeing that the Fed was right. I don't want to be premature here, but
the market says.
Looks like it.
DD shares are deflating.
All right, let's move on to a very specific area where there has been a lot of attention on prices, and that is semiconductors. We talked a lot about chip shortages, about inventories being low, how that is then working its way through the supply chain and proving problematic for all kinds of areas. And there's been a lot of ink spilled on why this has happened. One area that has not been as explored has been the political effect and how that has contributed to chip shortages. Someone who is looking into that for us is Rick Newman. And Rick, this is sort of, in addition to all of the other dynamics that are affecting the chip industry, there are also the dynamics of what happened during the Trump administration when it came to trade. So talk to us about and explain to us how that had an effect.
Well, when Donald Trump, President Trump, imposed those tariffs on Chinese imports in 2018, semiconductors were one of the categories of product that got a 25% tariff, and that remains in place. Now, China is not a huge supplier of semiconductors to the United States, but imports of Chinese semiconductors fell from about 11% of the total supply in 2018 to only about 5% of the total supply now. And I'm sure there are automakers and appliance makers who would love to have that extra 6% semiconductor supply. Another thing Trump did, if you recall, in 2019 was prevent or ban U.S. companies from selling products to Huawei, the huge Chinese telecom company. And that included semiconductors. And that really distorted the whole supply chain for semiconductors. And among other things, that export ban only applied to products made in the United States. So if it was a U.S. company that actually got its products from Taiwan or South Korea, for example, those could still go. But that actually created a disincentive to invest in semiconductor manufacturing here in the United States, because there was this one giant customer out there you could not sell them to. And now, of course, President Biden wants to basically give the semiconductor industry $50 billion to incentivize production in the United States. So this is not the whole story of the semiconductor shortage, but it's an important part of it. Trump actually made it worse.
And so you alluded a little bit to how now President Biden might try to make this better. Is it a question of reversing some of what you talked about? Of course, he's also talked about improving and increasing manufacturing capacity of chips in the US, although that seems like we're pretty far away from that. So what else can he do?
Well, so Biden has put out a plan with 6 or 7 important points. And you're right, you cannot just build a semiconductor plant overnight or expand capacity overnight either. That's hard to do. But what President Biden is trying to do, he's trying to make deals with supplier nations such as Japan, South Korea, and Taiwan, although we don't acknowledge that Taiwan is a nation, and try to get some help basically from those countries with US supplies. But I don't think anybody believes this is going to solve the problem anytime soon, because everybody in the world needs semiconductors. And most forecasts I've seen say this is likely to remain a problem. We're going to have this mismatch between supply and demand well into 2022. It's gradually getting better, I think, in some parts of the economy, such as the auto industry, but not quickly. And we've still got products just sitting in lots and in warehouses waiting for chips to show up.
Yeah, and we're going to talk about all of that with Manish Bhatia of Micron in just a second. Rick Newman, thank you so much. Appreciate it. Talk to you later. Just want to bring you a little bit of breaking news here on the job market. It's the JOLTS data, the job openings up 16,000 to 9.209 million in May. The estimate, though, was for about 9.3 million, so a little bit short of estimates. Interestingly, those job openings, it looks like the job opening rate as a percentage of total employment plus openings, 6%. So interesting here, you know, we've been talking a lot about the mismatch here, that people are not able to fill those job openings, but there were still a lot of jobs out there that are open, but a little bit fewer than had been estimated. All right, we're going to take a quick break. When we come back, we're going to tell you the big sale that Reese Witherspoon might be doing. We'll be right back. Well, some other business headlines that we're watching right now. The fight over that coveted government cloud computing contract has ended with its cancellation. The Department of Defense has awarded a $10 billion contract to Microsoft. It was called the JEDI contract, but Amazon contested that choice, arguing the Trump administration had unfairly favored its rival. The Pentagon now says it will solicit bids from both companies for future cloud computing contracts. Reese Witherspoon's production company is exploring a sale. The Wall Street Journal reports that Hello Sunshine has garnered interest from suitors, including Apple, for a potential deal that could value it as much as $1 billion. The company owns titles including HBO's Big Little Lies, Little Fires Everywhere, and The Morning Show, which streams on Apple. Also in media news, Comcast Peacock streaming service is about to get exclusive access to a slate of new movies. Universal Pictures, also owned by the media giant, will send new movies to Peacock no later than 4 months after their theatrical debuts. That deal begins in 2022. Upcoming movies include Jurassic World Dominion and a new Minions installment. And Chobani has confidentially filed paperwork for its awaited initial public offering. The yogurt maker, founded by Turkish immigrant Hamdi Ulukaya in 2005, reportedly could be valued at more than $10 billion. Miles?
I mean, look, you got Chobani going public. Last night we saw Traeger Grills file for their S1. Krispy Kreme has come public. Oatly, Sweetgreen set to come public. I mean, guys, we got a full meal on our hands just from the IPO market. And I'm sure Brian Sazi knows about some other crazy food product that's set to come public that I haven't even heard of. Maybe Bang energy drinks or whatever's keeping you going over there. Maybe they're going to come public.
Hey, good to mention too, Miles, all these companies pretty much selling things that are inflationary in price.
All right, let's move on. Let's get into the Wi-Fi interactive touchscreen here. Talk about some names that are on the move. And old friends here, the meme names on the move. The reason, because they're memes. We see Palantir off about 5%. AMC and GameStop, really, of course, the stars. AMC now off some 11%. That stock was in focus for us during yesterday's trading session. We saw shares were up a couple of percentage points early in the session. They did give up their gains through the day on Tuesday after the company withdrew that proposal in its annual proxy statement that would have allowed them to sell up to an additional 25 million shares in 2022. But again, company saying they were not going to go ahead and do that. But the stock here is under some pressure. And obviously, it's off about 20% over the last 7 days. Of course, AMC at this valuation, and of course, going back in time a year when it was basically going to go out of business, it is still multiples in size relative to where it was. GameStop shares trading around 182. The stock had floated really in that low 200s area for quite a while. And we saw a ton of news flow. We saw CEO turnover. Company came out with its results. Ryan Cohen was formally named executive chairman of the board, and the stock is looking, the chart at least, looking a little bit sloppier here after it had really based out again in that kind of low 200s per share level for a while. And we see now revisiting May levels. Obviously, you look at it on a year-to-date chart, and it looks ridiculous that anyone could say this isn't super constructive. But I know Jared Blicker will tell us really in that mid-hundreds, call it 150 to 180, you're going to see some key levels because as we see here, again on the chart, a lot of people got involved in the name between those prices from, let's call it mid-March through mid-May. So it will be interesting to see how GameStop shares act as we get back into those levels. And again, we really see, Newegg Commerce, company that I don't really know anything about. It's up 94% today. There you go. It's I think it's ranked what I see here, 13th right now in terms of mentions on Wall Street Bets. So getting a little bit of chatter. GameStop, Clover Health are really dominating that conversation, and a lot of the familiar names here: Bed Bath, Macy's, Virgin Galactic, Wish has been a major meme name. Sundial we can see over on the right-hand side of the screen, along with Workforce. All those names, the real stars of the show for the meme trade, under some pressure. And our old friend Rocket Mortgage, which had been a part of that trade, up a couple percent here, but again, really has not done much since getting involved in early March. All right, off for a short break here. On the other side, we're going to talk about that chip shortage. We'll talk more about the latest quarter from Micron. We'll get into all that coming up here right after this. All right, welcome back to Yahoo Finance Live on this Wednesday morning. We are gearing up for the full-on start of second quarter earnings season set to begin next week. But last week we saw results out of Micron, major player in the chip space, as we continue to see some results trickle in. And as we've seen from so many companies over the last couple of quarters, solid beat here on the top and the bottom line as Micron continues to ride both just a huge R&D cycle and a continued chip shortage in the industry. Joining us now to talk through the latest quarter and the challenges facing the company, Manish Bhatia, the Executive VP of Global Ops over at Micron. So Manish, let's talk a little bit about the supply chain from your vantage point, and maybe if you could just flesh out for us, some of the commentary that you guys had on the earnings call, maybe for our listeners and our readers who weren't able to go through that, because you talked at length about the different challenges that you're facing across different markets, and it's impacting the supply chain in some unique ways.
Sure. Good morning, Miles, and thanks for having me back. Sure. On the, Micron definitely executed well last quarter and provided strong guidance for next quarter. We see continued strength in the markets for DRAM and NAND flash, with tightness in supply through the end of the calendar year and into calendar year 22 as well. As we look at the drivers of demand, the twin pillars of AI and 5G continue to propel demand forward for all the different computing architectures across data center all the way to the intelligent edge, and even into electric vehicles, and then on top of that, the digital transformation that has really been accelerated over the last 18 months by the pandemic, where all of us living and working this way, interacting in this way that we are now on video conferencing, wanting to have updated personal computing devices and iPads and mobile devices. All of those trends are also strengthening the demand. And then on top of that, we see long-term sustained stimulus driving demand for all technology components, and all of those need semiconductors, and they all need memory. So we feel very good about the health of our markets for the next through the end of this calendar year and into calendar year 22 as well.
Manish, I know some folks that cover your company on the sell side, they were a little surprised by you guys talking about cost headwinds, perhaps a little bit more than they thought. Where are you seeing some cost pressures?
Sure. So certainly in the near term, Brian, we have some expenses due to COVID mitigations actions that we've had to take across our supply chain, and in order to secure capacity and some components, and that's a near term aspect. But as we look forward, we're seeing a mix towards more high value solutions. And while the elements of cost reduction, which are at the memory level, continued cost reduction in DRAM and NAND at the wafer level, and then the assembly and test portions across our supply chain as we productize those wafers, and of course the non-memory components that we have to put onto our end products, like solid state drives and DRAM modules. Each of those elements, we feel very good about the cost reduction that we're going to have as we go through the next finish this fiscal year and into next fiscal year. What we were highlighting, Brian, was that our mix of products is going to move towards more of those high value solutions that are more complex, like solid state drives for data centers, like DRAM modules that go into servers or into the cloud. And while those modules have more components, more cost associated with them, they also have more pricing premium as well. So that's really a little bit of the color we were just trying to provide in how the mix of our business is evolving and how we see both ASPs and costs playing out over the rest of this fiscal year and into next fiscal year.
More pricing power, Manish, it's Julie here, and perhaps also more resistant to the typical sort of commodity boom and bust cycles maybe that we see in the chip world. And that brings me to the supply chain issues and the shortage issues that we've seen so much of the industry have. Historically, we have seen those sort of boom and bust cycles, right, for chips in terms of pricing. Right now, it's robust for you guys, but I wonder how sustained you think this incredible demand that we're seeing right now is going to be, and how concerned you are, not just for you guys, but as an industry, about ramping production way up and then seeing demand fall back, or people, hoarding chips, for example.
Yeah, yes, Julie. So, what we see right now is certainly strength, as I mentioned earlier, in our end markets, with DRAM and NAND both going to be in tight supply through the end of the year and into calendar year 22. And we try and plan our capital investments and our supply growth to be in line with the long-term demand trends that we see. And so that's how we make our decisions, and we think that's the best way to be able to focus on our return on investment and be able to deliver that return on investment for our shareholders. As we think about the vectors that are driving this cycle, I mentioned just the real strength behind the economic recovery that's being driven out of the pandemic. But as we look forward, going beyond just one cycle, I think the real story is the multi-year, multi-cycle trend for memory and storage continues to be positive and strong. If we go back 20 years and look at the total demand for DRAM and NAND flash memory as a portion of the entire semiconductor industry, it was only 10% of the entire semiconductor industry. Then you go back 10 years to the advent of the mobile era and the smartphone, that became 20% of the global semiconductor industry. And today, DRAM and NAND flash are more than 30% of the global semiconductor industry. So the multi-year, multi-cycle trend is for memory and storage to outgrow the rest of the semiconductor industry. And we're really excited about that trend. And that's really what we're investing our research and development in, to be able to have terrific advanced technologies like our 1-alpha DRAM technology and our 176-layer 3D NAND, which are both leading the industry, and our terrific product solutions, which are serving customers between data center and cloud, all the way to the edge with personal computing, mobile solutions, and automobiles. So the multi-year, multi-cycle trend is what we're excited about, and we expect memory and storage to outgrow the rest of the industry, and Micron as well to outgrow the rest of the semiconductor industry.
Manish, we're so used to seeing you come to us, I believe, from overseas. Where are you now, and how is your day-to-day changing as the economy has started to reopen?
Thanks, Ryan. That's right. I'm here in our Silicon Valley office today, and I've first travel for me in 18 months. And I think we're starting to see, the pandemic is receding in certain parts of the world. Certainly here in the U.S., it's on a good trajectory thanks to the strong push on vaccinations here. And so we are opening up some more both domestic and international travel. But of course, the pandemic is still, impacting us in other parts of the world where vaccination hasn't gone as fast. And so we're continuing to keep and continuing to invest in increasing our protocols and testing so that all of our team members can be operating safely wherever they are in the world. In the U.S., we are starting to see more of our team members come back to site, and we're looking forward to having more and more of them on site, because we do believe that while we've learned a lot during the pandemic about how to collaborate between remote working, remote team members and on-site team members and team members at different sites, we still believe that innovation flourishes most when you're able to interact with each other together. So that's we're starting to have more and more team members come back and hopefully power our innovation engine for the future.
All right, Manish Bhatia, Executive VP of Global Operations at Micron. Manish, always great to speak with you. Thanks so much for jumping on this morning, and I hope we'll be in touch.
Thanks a lot, Miles. Take care.
All right, on the other side of this break, we'll talk to one analyst reiterating an outperform rating on shares of Coinbase. Talk about that call coming up right after this.
Shares of crypto exchange operator Coinbase trading lower here today, and they've actually fallen since their direct listing. But our next guest thinks that they are a good buy at these levels. That's Owen Lau. He's Oppenheimer's senior research analyst, out with the note today, reiterating his outperform rating on Coinbase. Owen, thanks for being here. As you point out in your note, you have a pretty optimistic revenue estimate for the company. It's set to report here in the next few weeks. And you're looking for second quarter revenue of $2.1 billion. As you point out, that's more optimistic than the street. Where do you think that gap is? What do you see that you think other folks are not seeing when it comes to the revenue outlook here?
Right. So first of all, thank you for having me here, Judy. So to me, the difference between our estimate and the street is, number one, I mean, Coinbase is still a new public company. So we still need to dig into the number, dig into the third-party data source to get the right data source to predict the revenue trend, in particular, the trading volume. We felt like we have a pretty good sense and pretty good data source to predict the revenue. And that's what drives the difference between our estimate and the street. And again, like you point out that we see a 24% upside compared to consensus for revenue and about 11% upside in terms of earnings.
Oh, and you talk a good bit in this note about volumes coming in better than expected for the second quarter, and I would suppose moving forward. Should investors should Coinbase be trading in lockstep with Bitcoin? If you're focusing on volumes, do you think Coinbase is just getting lumped in with the decline in crypto?
That is a very good point, and that's the key point we try to make in the note. We think Coinbase should not trade in lockstep with Bitcoin because Bitcoin can be very volatile, but at the same time, because of that volatility, it drives higher trading volume. It is similar to other traditional exchanges, and we think there is still a misunderstanding in the market that people think Coinbase should trade along with Bitcoin going forward. And I think it may take time for people to understand the relationship, but when more and more quarters come out, people see the gigantic record volume and record quarter, people would start to realize that there's a huge difference between the volatility of Bitcoin and also the trading volume of Coinbase.
And, so Owen, granted, Coinbase has only been floating publicly for a few months, so that'll work itself out in time if indeed that break happens. But you guys have a table on here that has, maybe 24 companies that could be a comp to Coinbase, depending on how you want to bucket the company, emerging tech, transactions, an exchange. How do you think about it at the base level, what Coinbase is today and what story they are going to be able to tell long term about, what their business is fundamentally?
Right. So that's another good point. So right now, over 80% of the revenue from Coinbase comes from the trading. And that's why many people still compare Coinbase with traditional exchanges like CME, Cboe, ICE, and NASDAQ. And I think in the near term, it's fine. But the thing that strikes us is, yes, even though you can compare Coinbase with the traditional exchanges, but the traditional exchanges only grow top line at about 9%, but they trade around 10 times revenue multiple. For Coinbase, they grow at around 1,000% in the second quarter. Even though if you look at the next 2 years or so, it still grow at around 100%, but they trade at a discount compared to traditional exchange. So that's one thing we see there's a huge dislocation. Longer term, we believe that the management will add more recurring revenue. So the percentage of that transaction revenue to us, it should go down because there should be more revenue from staking, more revenue from earn campaign, and even more revenue from altcoins. And that would also reduce the reliance on Bitcoin.
Owen, do you think also Coinbase needs to expand its business lines, diversify, make acquisitions? And if so, what are some areas where you think that could happen?
Yeah, so we think this is very likely that Coinbase will still grow through acquisitions. because if they don't use the capital to do buyback, by the way, first quarter they generate about 50% margin, so they have tons of cash flow. And if they don't do buyback, they cannot reinvest 100% of the profit into their business. Then they have excess capital to make acquisitions. In terms of potential targets, there are like rumors out there, there are like reports out there that they may buy another asset manager. I think it's possible because it can increase their recurring revenue stream. That would also help the multiple as well. And also another area they can go after is more of the technology data provider. They acquire skill. That's another signal to indicate that they can get into more of the techie data analytics and even like crypto cloud business per se.
And lastly here, I'm just looking at your 12 to 18 month price target, $444. So almost looking for the stock to double. If we are having the same conversation 18 months from now, how will have Coinbase reached your price target?
So I need to point out in the second half of this year, we're going to see a lot of retail adoption because Coinbase is launching their debit and credit card product. Their competitors like BlockFi, Voyager, Gemini are also launching similar debit and credit products. And I think Visa CFO mentioned in the morning that in the first 6 months, the crypto-related purchases is about $1 billion, which is like way higher than what they had in 2019. So we see that is a potential catalyst for retail adoption. For institutional adoption, even though we haven't heard any additional like MicroStrategy or Taxa to buy more Bitcoin, but actually in the back end, there are more and more institutions to use the underlying technology to drive the digital assets adoption. At the same time, there are more and more asset managers scanning into this space. We have also talked to a lot of institutional investors. They have been showing a lot of interest. So to me, there are multiple catalysts ahead that can drive the stock, that can drive the revenue, and also the current price to our price target.
Owen, look forward to catching up with you after the report to see how this all plays out. And beyond that as well, Owen Lau is Oppenheimer Senior Research Analyst. Thanks, Owen.
Thank you very much.
Thanks. We're going to take a quick break. When we come back, maybe you're lacing up and heading to the alley as part of your reopening festivities. Captain Awesome was one of the names that someone was giving themselves in this video. Sorry, just reacting to that. We're going to talk to the CEO of Bolero coming up next.
All right, well, as the SPAC boom continues, we are finally starting to see more companies come public via the SPAC channel that have a real business. They are not only growing revenues, but they are also making profits and growing those profits. One of those companies is Bolero, and the company's president and CFO, Brett Parker, joins us now to talk through the state of the business and sort of how you guys see things going forward. So, Brett, let's just start with what COVID has been like for you guys at Bolero, being able to keep your lanes open. Have you been able to, what kind of capacity you were able to operate at? And sort of as we sit here today with most of the country having lifted most of the restrictions, do you feel like you're back onto that, pre-COVID kind of runway for growth?
Sure. So, obviously early on, it was a very challenging time. We were shut down everywhere, but by the early part of May of 2020, we started to reopen in the markets where we could, beginning in Georgia and then expanding through much of the South and sort of following the regulatory framework. And, fast forward to where we are today, we have everything in our system other than 2 locations in Canada are currently open, and revenue has come back with a vengeance. So we're already doing more than all of the revenue that we were doing on a pre-pandemic basis when we look year over year for these weeks since the beginning of May.
And Brett, I have to applaud your team because your presentation was incredibly thorough. There is a real business here. This is not like other SPAC transactions. One slide in particular caught my attention. You expressed interest in the presentation on potentially forming a REIT. Now, how many properties, how much land do you in fact own, and how close are you to forming a REIT?
So the current number hasn't been disclosed. I don't think we're yet at enough critical mass to do it. We have some that we own today. We're primarily leased, but we do have a significant pipeline of acquisitions of individual centers that are coming on board, and more of those deals include land. So the thesis is that we will build to enough critical mass to potentially be able to spin that out as its own entity.
It's Julie here. I wanted to ask about sort of spending on those properties. Clearly, as we're showing for the pictures, and anybody who's been to a bowling alley in the last 10 years, we know it's not sort of the sticky floored bowling alleys of yore that I grew up with. So where are you in terms of capital spending, in terms of renovating bowling alleys, and sort of what your goals are on that front?
So as of today, we're in the right around 300 centers that we have in operation. Of those, about 120 look like the fully upgraded experience that you're showing on the screen. And then the balance are, I don't want to say untouched because we have spent money in them, but there's a lot of runway there to continue to bring those further up market. And as we do that, we dramatically increase the revenue and profitability, and the returns are explosive when we reinvest in our existing centers. And then it's a similar profile when we acquire a traditional center and make the same upgrades.
And then, Brett, another part of the business that you guys highlight in here is what you're doing with PBA, the Professional Bowling Association, and some of the media assets that are associated with that. How do you see that part of the business? Because, wholly owned leagues, I guess F1 is kind of the innovator here, but it's become a much more attractive part of the rights market, I guess, if we think about it that way, for investors, and certainly something I'm guessing you're going to talk quite a bit about on the roadshow.
Yeah, it is. And, the PBA is really an interesting thing for us because we acquired in 2019 with essentially a 2-part thesis. One is this can and should be a growing and profitable business as a standalone media property. And we're working very steadily towards that. And we've done a lot to add to the projection value. We set a new record in viewership. So we really moved that business forward. And then the second is it creates this flywheel of growth around the core business where viewers from the PBA, we have increased interest in bowling, which we can then use to drive them into our centers. And then when they're in our centers, we have the opportunity to create more viewers for the PBA. So that virtuous cycle just continues to spin and spin. So as a standalone business, it's a very nice media property to own, and I think it has a lot of upside. But its most significant dollar contribution, at least in the near term, will probably be in what it does to enhance the performance of the core business.
Brian, go ahead.
Brett, to moving forward, where does sports betting fit into your go forward plan?
So there's really two pieces to that. One is betting on the PBA, which is something that we launched this year in partnership with Fox Bet. And that looks much like betting on any other professional sports league. What's interesting is, being a stop and start league, there is an opportunity for a very significant number of bets per show. Because as the data feeds mature, which is something that we're working on, you can go from betting on an entire event to betting on an individual game, to betting on a frame, to betting on a ball. So there's a lot of opportunity there. And then the second piece, as part of our longer term vision, is to integrate that activity as a game of skill into the centers themselves, so that the casual bowler has the opportunity to win real world prizes based on whether or not they can achieve a given thing. If we say, we'll give you X dollars if you can hit a strike, do you want to make that bet, that sort of thing. So those are two different pieces. One happens in the centers and one happens related to PBA, but both are vectors that we're looking at.
Well, Brett, Brian Sozzi tells us that he one time rolled a 300, so I don't think I'll be taking the other side.
Twice.
I won't be taking the other side of that strike bet for him. But we'll see. We'll see if we get the team out to a Bolero Lane for a little team outing sometime soon. Brett Parker, President CFO of Bolero. Brett, appreciate the time this morning. I know we'll stay in touch as you guys get closer to consummating the deal, coming public, and then hopefully hit the quarterly circuit here for those updates. Yeah. Thanks for joining.
Great. Thanks a lot. Thanks for having me. Take care.
All right, off for a short break here. On the other side, a quick wrap-up of today's market action before we send it over to Brian Chung and Kiko. Back with that right after this.
We are now seeing all three major averages in the red. So a little bit of vacillation here between gains and losses in this early session here. As you can see, the NASDAQ had been the leader, and now it's the leader to the downside. So never know what to expect here. That does it for Miles, Brian, and myself in these 2 hours. We're going bowling. We'll leave it to Akiko and Brian Chung for the next 2 hours. We'll see you here tomorrow.
Welcome to Yahoo Finance Live. I'm Akiko Fujita, along with Brian Chung, in for Zach Guzman. We're 90 minutes into the trading day, and we are seeing all three major indices trading in the red right now. We did see the S&P 500 rising earlier on in the session, ending that 7-day winning streak yesterday, sort of coming back, but now dipping into the red in the session. The NASDAQ is down about 31 points, and the Dow down 60 points. Big tech names gaining in the session. Apple gaining among those names. It was up as much as 1.5%, pulling back there. Chinese tech names, though, continuing to get hit as regulators in China move to tighten the screws on overseas listings. Solar power firm Heliogen looking to go public in a $2 billion SPAC merger. We're going to be joined by Heliogen CEO and tech investor Bill Gross, along with the CEO of Athena Technology Acquisition Corp. And President Biden playing down the damage to businesses stemming from the most recent ransomware attack. But cybersecurity experts warn the incident is far from over. Former Homeland Security Secretary Michael Chertoff is going to be joining us this hour for that discussion later in the show. We're beginning today, though, with a quick check of the markets. And Brian, oil continuing to see some steep losses, dragging down the energy names along with it. That sector is down more than 2%. Meanwhile, we saw the yield on the 10-year Treasury falling to 1.3%. That is the lowest level we have seen since February. Let's bring in Yahoo Finance's Jared Blickery to break down all of the day's movers for us. Jared.
Yeah, let's first start out with the sector action today because this is pretty telling and pretty interesting. I have it up on the Wi-Fi Interactive, as you can see there. And in the lead is staples and utilities. So that's kind of a defensive setup. You also got industrials and real estate in there. That has to do with the plunging long-term rates, both the 10-year and the 30-year, which we'll take a look at in a second. When we opened up, these defensive sectors, which are utilities and real estate, they were in the red. So this has been a change in leadership. Tech is now just slightly in the red, as you can see. That's XLK there. And energy financials just really getting whacked here. In fact, let's take a look at the energy heat map, and we can see a lot of red. Exxon down another 2%, Chevron down another 1%. Whatever is going to happen with OPEC Plus still up in the air. And the holdout is United Arab Emirates. They want to raise their baseline so that they can pump more oil relative to some of the others. They were hurt the most by that April 2020 deal, so they're trying to right that ship. Also want to take a look at the travel sector. Got smoked yesterday, and guess what? Not that much better today. Some of the standouts, American Airlines, that's down 3%. Carnival Cruise Lines down 3.5%. And I think it's time to look at these bond yields, right? Because that has been the story of the day. This is the Dow. So here we go. We'll start out with the 5-year and just kind of head up the curve. Now, the 5-year got that huge boost from the Fed disproportionately, the belly of the curve. That is now selling off quite a bit, but not as much as the 10-year. That is just plunging here. We do have some support at 1.3, but really 1.25 is a big level. And you can see that on this 5-year chart that caught this spike up here. Maybe we'll see a level of interest right around that 1.25% mark. Now, the 30-year, I'm watching the 2%, and we crashed below that. So guess what? Next stop, 1.75. That's been a level that's been in play. So we could go down quite a bit further here, another 5-10 basis points. But I think that caps the action because rates are getting way oversold here. So let's go back to our heat map. And I do want to check out what's happening in the NASDAQ. Guess what? We got China stocks under some pressure, and we have another heat map for that. But I do want to point out some of the big winners. I said staples, that was one of the leading sectors here. And we're seeing Starbucks up 1%, Costco up 1%. So a bit of a defensive posture. Now, here's the China heat map I was talking about. You want to see something really ugly? Let's do a 5-day view, and it's all dark red. The losses just keep stacking up as China cracks down on those foreign listings. Hard to imagine trading any of those in 5 years' time, just personal opinion. But you take a look at Pinduoduo up in the upper right, that's down 17%. Tencent, that's down 8.7%. And the list goes on. Here's Didi, down another 17% today. Only IPO'd last week. Doesn't seem fair, does it?
Not at all, Jared. I'm wondering if you could tell me a little bit more about what's going on in Didi. Obviously, there's been no news really since yesterday, but it seems like the fallout has continued. And Didi signed up for this. That's the perils of going public, right? What are you seeing in that stock? Any technical resistance or any other points that you thought were worth mentioning?
I'll tell you what, I do have some news on it, and it may not be the freshest news, but two headlines kind of flew under the radar yesterday. First, Didi, this is a WSJ report, that Didi got a heads up by the Chinese regulators. They wanted them to postpone their IPO. Supposedly this happened more than a month ago. So if Didi went public, knowing what apparently is in this WSJ article, then they could be in trouble. I mean, that just screams shareholder lawsuits right there. They should have made that disclosure in their prospectus because we're seeing the fallout, huge risk from that. Now, I do want to take a look at the Wi-Fi Interactive again. Didi down another 6% today, but you take a look at the price action, and I'm going to change this to a candlestick chart. That's just ugly, and it's really not a lot of price action, only having come to market last week. But we've also followed the travails of some of these other new listings. Now look at CPOP. Pulp Culture Group, this is down another 20% today. It was down substantially yesterday, one of the worst stocks. And then I'll tell you what, we also checking on some more traditional names like Xpeng. Everybody's getting caught up in this mess. Not a lot of green on the screen. And when it is in the upper left, 4 or 5%, I'd call it a dead cow bounce, excuse me.
Yeah, and Jared, on the issue of Didi, we're already getting reports of a class action lawsuit, according to Chinese media. So the lawsuits have already begun on the back of that IPO and the big fallout from that. We are seeing some big gains in tech names today, Apple leading the way there. What are you seeing on that front?
Yeah, let's go back to the Wi-Fi Interactive, and then the NASDAQ is really lighting up here in the mega caps recently. Apple up another 63 basis points. this stock has to be within about 1-2% of its record high that we saw way back in January. We've seen a lot of these formerly kind of downtrodden FANG stocks really pop over the last month. And guess what? This is concurrent with that big decline in the 10-year yield. We can check out Alphabet, Amazon, Microsoft, all pretty looking the same here. They're all breaking to the upside, guys.
Okay, Jared Blickery walking us through the moves. Thanks so much for that. Let's bring in our first guest for the hour. We've got Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always good to have you on the show. I want to start with the moves that we are seeing in bond yields there. Jared just highlighting that, but the 10-year plunging in the session. We're now looking at it yielding about 1.3% ahead of the Fed minutes coming up. What do you think is driving the moves right now?
Good morning, Akiko. I think we have a few factors at work here. I think it's not coincidental that we're seeing a big move right ahead of the Fed minutes being released today at 2 o'clock. I think that's going to be one of those crucial factors that traders are waiting for. And the reason for that being, I think some of it's been a short squeeze. I've been asserting that the market got oversold at the end of the first quarter, and bond investors were underinvested in 10 years. And then they raced back in, and I think a lot of people have been fighting the trade. It's a tough one, it's completely antithetical to the idea that there's going to be persistent inflation. And I think that we have to find out today whether the idea that monetary, which is the more important factor, monetary stimulus, a little inflation risk, who outweighs what, and where are the winds blowing at the Fed. And I think ahead of this meeting, that's where you're seeing the last little gasp of short covering ahead of it.
Hey, Steve, Brian Chung here. It's great to have you on the show today. I want to ask about the volatility that you tend to see in the lead up to FOMC minutes. Right now, I'm looking at a VIX handle around 17. Obviously, nothing close to where we had those levels at the beginning of the year, but still a notch up compared to what we've seen over the last week or so, let's call it. So what type of volatility do you expect to see headed into those minutes at 2 p.m., given the importance of what we saw as a policy shift in the Fed's June meeting?
Well, Brian, I think we've seen some of the type of volatility. Today with us opening stronger and selling off, I think markets have gotten thin ahead of the meeting. And yes, 17, while it's relatively low compared to where we were earlier this year, we had a 14 handle at one point last week. So, you could argue that the VIX has been, picking up off its lows, but you could see from the chart that it's very much closer to the lows than the highs. That points out a very interesting conundrum to me. And that is, VIX was much higher when fiscal and monetary policy were much clearer. Throughout the length of, let's say, the last 6 months to a year, it's been fairly evident that the Fed was going to have its foot on the accelerator and that there was going to be fiscal stimulus in one form or another. And we've gotten a couple of packages, and we still may get the infrastructure package, which counts as fiscal stimulus. But now you have this huge monetary uncertainty from the Fed. At the same time, the VIX is more or less near its lowest levels that it's seen since the pandemic. At the time that the policy is the most cloudy, that's really quite a thing for the market to have to handle. That could set up for something being on the wrong foot if the market is disappointed.
Steve, let's talk about another story we've been following over the last few days, which is the crackdown on these Chinese tech companies. Didi, obviously the very latest here. It feels like there is a regulatory squeeze happening on both ends. Over in China, obviously trying to close that loophole of these companies that are listed abroad, and then over in the U.S. calling for more transparency around these listings. As an investor, do you just stay away from these Chinese companies, or you think there's still an investment case given the growth potential within their business?
I'm going to sort of split the needle a little bit, Akiko. I'm going to say that there is still an investment thesis for these Chinese companies, but I think the investors in the U.S. have to impart a bigger amount of risk premium to these companies. What does that mean? It means either paying less for them or having smaller holdings in them, which also doesn't help the price. I think what's been demonstrated, first with the Alibaba and Ant Financial stories, and now the Didi story, that the Chinese government has its own set of motivations, which are not necessarily aligned with foreign shareholders. And we can argue whether or not Didi was alerted to this, and that's a whole other animal. But it's clear that regardless of whether there was a heads up given or not, whatever the latest moves were from China, they were not particularly user-friendly. They're clearly very eager to keep a tight rein on data and the companies that generate data and store data. And to that end, I think U.S. investors, it's very tough to have clarity as to what is in the minds of the Chinese regulators. And as a result, since they've shown that those moves are not particularly shareholder friendly, they're going to do what they're going to do regardless. I think you have to be much more selective or much more price sensitive if you are investing in Chinese companies. Doesn't mean you shouldn't. There's the growth story is enormous. There's certainly upside in China, but I think it requires a lot more price and risk discipline than investors had been putting in prior, and that's why you see the price action that we're seeing.
Yeah, an interesting point there. It's not just about the regulators scaring companies that are trying to go public in the United States, but maybe even scaring the investors stateside and globally into Chinese stocks that even might be listed on UX exchanges. But again, Steve Sosnick, Interactive Brokers Chief Strategist, thanks for stopping by this morning. And coming up on the other side of this break, we've got another SPAC deal or SPACquisition. I'm waiting for the drum roll, but this time in the solar energy space. We'll have the deal makers right here on Yahoo Finance right after the break. Hitting the tape this morning, the Athena Technology SPAC, again, a reminder, special purpose acquisition company, inking a deal with Heliogen. It's a AI-enabled solar company, and it's as usual with these type of SPAC deals. The SPAC, which was listed as Athena on the NYSE, will now be renamed Heliogen with the ticker HLGN, and the deal would imply a pro forma value of about $2 billion, and the heads of both companies join us to discuss the transaction. We've got Athena Tech CEO Phyllis Newhouse alongside Heliogen CEO Bill Gross. Thank you so much for joining us here. I want to ask you first, Phyllis, your SPAC was on the hunt for a company broadly for a technology company. So why Heliogen? And then given the cooling off that we've seen in the SPAC space as of late, why specifically now?
Wow, thank you, Brian. That's a great question. I'll tell you this. Heliogen is a tech company that's focusing on solving renewable energy issues. And we're confident in the innovation, the technology, their leadership, their expertise, and certainly the technical capabilities. And so when we created Athena, we wanted to deploy our own leadership team that had the expertise in the technology and the AI space. And that's what was so unique about our SPAC. We had expertise that spans across industries. We had strong technical capabilities. And so we were looking for a company that was going to be game changing. And so we were looking for a company with vision and disruptive technology and was capable of solving significant issues, and that had a commitment to diversity and inclusion. And Phil will talk a little bit about that, but also that our missions were aligned with them. And so Hillegion checked all those boxes: world-class management team, the technical management team, one of the most diverse teams I've ever seen. And we saw an opportunity to leverage our technical, financial expertise, public readiness. And I'll say this was what I really loved about this, is that lots of SPACs are transactional, but this was more relational and driven. And there was a closely aligned vision that Bill and I both had. And this is why Hillegion and why now, because we feel like this technology is game changing and is very disruptive. So that's why now.
So let's talk a bit more about the technology, Bill. You've already got some big name backers, including Bill Gates, who have really put their money behind this company. How does it all work in the simplest terms?
Well, our technology is producing renewable energy around the clock. And we solve that fundamental problem of renewable energy, which is intermittency. The power normally comes only when the sun is shining or the wind is blowing. Our technology concentrates sunlight to a very high temperature, over 1,500 degrees Fahrenheit. And then we take that high temperature heat and we store it in rocks or sand or ceramic. By storing the energy, we can release it overnight or on cloudy days. So we can help industrial customers save money with renewable energy, but also to decarbonize. And the energy transition we're going through in the world right now is extreme. The rest of this decade, we're going to be spending trillions of dollars to decarbonize the planet, and our technology helps make that happen cost effectively.
Yeah, it's fascinating to see the technology specifically, because you're really going after some of the biggest carbon emitting businesses. We're talking about concrete manufacturers, mining, steel making, but I imagine ultimately you're going to have to scale this out to really bring down those emissions. I mean, what kind of numbers are you looking at in terms of the emissions reduction, and how big of a dent you're likely to make?
Our customers are some of the biggest emitters in the world, just exactly as you said: cement making, mining, steel making. We're working with Rio Tinto, a large mining company, to reduce their emissions dramatically by big percentages. We're working with ArcelorMittal, the largest steel company in the world. They not only are working with us to reduce their emissions, they also became an investor in our company. They're so excited about this potential. So we can make a significant dent because we can replace the fossil fuel they're burning to get green energy at a lower cost. So this is great for both emissions, but it's also great for the CFO. We actually save the company money because energy is embedded in all of our materials. Energy is embedded in our iPhone, in our cars, in our homes. If we reduce the price of energy, we reduce the price of all goods to consumers. So it's very, very exciting.
And Phyllis, I want to ask you just about the broad SPAC market. Athena had raised about $250 million in March, and what a tide change of difference it's been. The market is very different in July now than it was in March. And when it comes to capital raising in general, what do you think is the market environment for not just Athena, but other kind of capital fundraisers right now? And how is that kind of guiding what might be your next step beyond this deal?
Yeah, well, I want to tell you I love that question, because there were a lot of folks out there that said that, the market was turning when Athena entered the market. But here's what I believe. I believe if you have an incredible team, you've got the expertise, you have great partners, and that's internal and external partners on your team. I think one of the things we looked at is that we knew that if you could get disruptive technology, something that was game changing, something that was really changing the world, I thought in my mind and the team, we said, look, we know that investors still have an appetite for this. So we're going to focus on that. And we stayed in line with our thesis and what we were looking for. And we got exactly what we were looking for because we knew that the market would have the appetite for this. So I look at, in terms of where I'm headed next, yes, I intend to stay in the SPAC market. Yes, I intend to bring more disruptive technologies. And I hope to be shouldering up with more people like Bill that we can bring this innovation to a market that's in need for it.
Bill, let me follow up on that question with you too, because in addition to running Heliogen, you are also a tech investor. You've backed a lot of these startups through Idealab, and I'm wondering how you're looking at this SPAC environment right now. On the one hand, it creates a huge opportunities for startups, but we've also seen, especially in the EV space, a lot of these companies who are just not ready for prime time coming to market and then really getting hit hard in their listing. How do you look at that dynamic at a time when there's going to inevitably be increased regulation and scrutiny on these companies?
I think the whole focus on companies going to the public market needs to be on tested technologies. I think when you're still in a science experiment phase, that's perfect for the private markets. But because we had built a full-scale test facility, which we completed in November of 2019, and we saw that operational for such a long period of time, we feel that the public markets are the right place for this. You're seeing a picture of that right now. That test facility in Lancaster, California, proved the technology at scale, that we could achieve the temperatures, the storage, the reliability, the accuracy. I think all the companies that are going to the public market should do those tests first. And I think in this energy transition space, we are going to have huge tailwinds for the next decade or two. Think about what's happening in the world. We are transitioning to the electrification of transportation. We are transitioning to removing of carbon from all of these heavy industries. These are trillion-dollar industries. The energy industry is 10% of all of GDP. So we have huge tailwinds because of government policies, company policies, targets, and I feel that companies that can make an important difference in that really have to scale to meet this demand.
Bill Gross and Phyllis Newhouse, it's good to talk to both of you. Really appreciate you joining us today. Coming up, the Pentagon looking for a reset to upgrade its cloud capability as it scraps that $10 billion JEDI contract. Who stands to come out big? That discussion is coming up after this short break. We'll be right back. Yahoo Finance Live. Well, that $10 billion Jedi contract may be no more, but the Pentagon is still looking to move forward with upgrades to its cloud capability. The Pentagon looking to both Amazon as well as Microsoft to solicit proposals. And for more on that, let's bring in Yahoo Finance's Dan Halley, who's been following this story for us. Dan, I mean, we were talking about this yesterday. It sounds like both companies plan to benefit in some way. But how do you think this how do you think the race shapes up for Amazon as well as Microsoft now that it looks like we're starting back from zero?
Yeah, this isn't a zero-sum game at all. That's kind of the way it was originally, I think, portrayed. But what happens with JEDI, which was the Joint Enterprise Defense Infrastructure Project, of course, JEDI, because, again, it's a bunch of nerds, that's basically by the wayside. Now, they're replacing it with the Joint Warfighter Cloud Capability Initiative, and this is an indefinite contract with indefinite pricing. So it could be better than the $10 billion 10-year contract that JEDI had to offer. And essentially what all of this is supposed to do is provide cloud capabilities for the military, from the people sitting at desks to the soldiers on the front line, and really allow the military to build out more technologies to meet the needs of the 21st century, things like AI. And so this new initiative, though, rather than going to a single cloud provider, which was kind of controversial under the JEDI program, that's not something that really businesses even do. According to Microsoft, about in 2018 interview, one of the vice presidents had said that, 80% of businesses that they talk to use multi-cloud solutions just out of redundancy. So you would think that the military would want that as well. So that's what they're doing here, a multi-cloud, multi-vendor option with this joint warfighter cloud service. And so essentially, both Amazon and Microsoft now stand to benefit, because it's not just going to be one, it's going to be both. And when the Pentagon announced that they were going with this new direction, they specifically pointed out both Amazon and Microsoft as being the front runners, because they're the ones that have all of the capabilities to do what the Pentagon wants. So they did say that they will talk to other parties, whether that's Oracle or IBM or maybe even Google if they're so interested. But right now, it really does look like, on the face of it, both Microsoft and Amazon stand to benefit from this.
Now, Dan, you laid out pretty nicely what this means for the Defense Department, but tell us about what this means for Amazon and Microsoft, because it's interesting to me to see that the stocks didn't really move that much on the news when it seems like 10 billion is a lot of bees. I mean, that's more bees than I can imagine, at least. But how impactful is that contract, at least for the bottom line for both of those large tech companies?
Yeah, I think it speaks more to Microsoft not falling too significantly on the news, just because it shows that there's people who recognize that this will still provide them with the benefit from that joint warfighter cloud capability initiative that they're going to be doing. So I think really what it shows is that, for both of these companies, they're still the preeminent cloud providers in the country, if not the world. They are the two largest public cloud providers out there. And I think really what this means is that because they have the capabilities to work with the military, they can essentially work with whoever they want in whatever industry they want. So I think this really just speaks to what they're able to do and really kind of gives them a little boost to their, bona fides when it comes to the different types of industries that they can work with. So obviously good news for Amazon, because now they get to play in this game as well. Not necessarily the best news for Microsoft losing out on that $10 billion, but again, this is an indefinite time period and indefinite quantity contract. So it could actually turn out to be much better for them. And look, it's not like they're losing out entirely on this.
All right. Well, Yahoo Finance, Dan Halley, we'll see how this story plays out. Thanks again for stopping by. Let's take a look at a trending ticker as we head into the noon hour almost. It's Newegg Commerce, an online computer goods retailer. Looks like the stock is up, get this, about 83%. There's a few things going on. The company announced this morning it would allow on-demand assembly for custom PCs. Basically, instead of purchasing the parts separately and then building it themselves, customers can just build to order, which would allow a professional to do the assembly and then ship it off to the consumer. And the company's also been getting a lot of internet buzz because of its recent restocks of the very hard to get and elusive NVIDIA RTX graphics cards, which Newegg has had to raffle off. But whether or not all of this warrants an 80% increase in the stock intraday, I'm not so sure. This is a meme market, so what am I to say? Akiko?
Yeah, it's tough to differentiate these days, but an 83% move, certainly steep. there. Coming up, fresh political turmoil in Haiti as an assassination overnight rocks the country. That story and much more coming up in our worldview. We'll be right back. In our worldview today, Haiti's president, Jovenel Moïse, was assassinated in his home just outside of Port-au-Prince overnight. The government saying attackers entered around 1 a.m. local time and shot Moïse as well as his wife, who remains hospitalized. That has sent shockwaves through the country and raised fears about escalating violence and unrest. The prime minister looking to calm fears, saying the country's security situation is under the control of the Haitian police and armed forces. The Taliban have reached a key city in western Afghanistan, continuing their rapid advancement as NATO troops retreat. Local leaders tell Reuters the insurgents attacked the city of Kala Ina from 3 directions as Afghan forces fought back. The advance caused panic among local residents, and it prompted more than 200 inmates from the central prison to escape. The fighting continues as U.S. troops and its NATO allies withdraw from the country after nearly 20 years. And the Ever Given container ship has officially begun its exit from the Suez Canal 106 days after it was grounded. The ship started its journey north late this morning, escorted by 2 tugboats and guided by 2 pilots. The captain of that tugboat estimates the ship will reach the northern part of the canal in 6 hours. One of the world's largest container ships, you'll recall, was stuck in the Suez Canal for nearly a week back in March, disrupting global trade. Its release comes after the ship's owners reached a multi-million-dollar compensation deal with Egyptian authorities. Well, coming up, President Biden plays down the damage to businesses stemming from the most recent ransomware attack, but cybersecurity experts warn the incident is far from over. Former Homeland Security Secretary Michael Chertoff will join us for that discussion after this break.
Welcome back to Yahoo Finance Live. President Joe Biden spending a good chunk of this Wednesday discussing the threat of ransomware with national security leaders, not just to private companies, but also to the government itself. Yahoo Finance's Jessica Smith is in D.C. with the updates.
Yeah, Brian, President Biden did meet with officials from the Department of Homeland Security, the Justice Department, and other agencies to talk about the threat of ransomware and what the administration needs to do about it. We have not heard from the White House about how that meeting went, or not gotten any details about that meeting at this point, but it did come after those high-profile attacks over the past few days, one that hit hundreds of businesses around the world, and then the Republican National Committee also saying one of its contractors was breached, though none of the RNC's data was accessed. President Biden said yesterday that it looked like there was minimal damage to U.S. businesses in that first attack, but the U.S. is still gathering information. Both attacks seem to be linked to Russia. And this happened just a few weeks after President Biden met with Russian President Vladimir Putin and warned him against cyber attacks, told him to take action on this issue and to hold cyber criminals accountable. President Biden did establish red lines. He told reporters that he told Putin about 16 areas of critical infrastructure that would provoke a response from the U.S. if they were attacked, though President Biden has not explicitly laid out what that response would be. The White House said that Russian officials will meet with U.S. officials next week to discuss ransomware. These discussions are part of what they agreed on at that Geneva summit. The White House also met with a group of mayors yesterday about ransomware, trying to strengthen cities and towns from these types of attacks. But President Biden did say yesterday that he'd be talking more about ransomware in the coming days. So we'll be looking for any update from the White House on this issue. Brian and Kiko.
Thanks, Jess. Now, obviously, all of this is coming under a lot of scrutiny in this particular space. So let's talk about this more with Michael Chertoff. He's the Chertoff Group co-founder and a former secretary at the U.S. Department of Homeland Security. And Michael, on the private side of things, we've been watching what's been going on with that IT software management provider, Kaseya, which was attacked less than a week ago, exposed somewhere between 800 and 1,500 companies in ransomware attack. And then you also have that news of the RNC perhaps getting attacked through a ransomware issue via a Russian group known as Cozy Bear. Just broadly speaking, where do we stand on these types of security issues? Are private companies and the government just behind the ball on developing defenses to these types of things?
Yeah, well, these problems have been intensifying. And actually, we've seen the frequency and the scale dramatically increase. So let me separate out a couple of things. One is the issue of ransomware, which, so your viewers understand, involves putting encrypted tools on a database, thereby making it impossible to read the data any longer unless you get the decryption key. And generally what the criminal groups do is they say you have to ransom the decryption key, and if you pay us in Bitcoin, we'll give you the key. Without it, you may have a lot of trouble operating because your records and your data is not accessible. This has been going on for quite some time. In fact, we saw attacks on the healthcare system, on cities, on private businesses. But what is different now is the dimension and the scale has multiplied 100-fold. And that brings us to the second point. More and more of the attacks now are on the supply chain that provides the goods and services and the software and hardware that companies rely upon to operate their networks. In this case, Kaseya, the company that was hacked, provides a server management software called VSA, which it then sells to managed service providers who then turn around and use it to help their customers manage their networks. The problem is when there's a vulnerability in that software, it basically creates a backdoor to literally every end user and every customer who has that software as part of their system. And particularly system management software, by definition, gives the person who operates that tool broad discretion to manage the network, which means they can get into anything. So I might describe what happened in Kaseya as a kind of super spreader event in the cyber ecosystem.
Yeah, Secretary Chertoff, it's good to talk to you again. I mean, that seems to suggest to me that there needs to be a shift in the way in which we approach cyber defense. I mean, it used to be that when we were talking about hacks and attacks. It was about companies really not taking it seriously. Now you've got a situation where they are installing the software that's supposed to keep them safe, and that is the inherent vulnerability.
That's exactly right. And I think that's one of the reasons in the executive order that President Biden issued a few weeks ago when he talked about the federal government. One of the things he emphasized was the importance of verifying and having zero trust in software. In other words, you've got to know who's providing the software. You've got to know the specifications. There has to be an assurance that the software provider is keeping security in mind. And you may have to test it and also build in a plan B for resilience purposes. And I think this is going to be one of the big challenges in the private sector as well. How do you know who to trust? And the worst thing in the world is if the security firm you're trusting is actually uploading the problem.
Secretary Chertoff, I guess, can you just walk us through the basics of how a ransomware attack goes? Because I think a lot of people are taking a step back and they're wondering, what is it about this type of activity that makes it more nefarious than other types of hacking, whether it's phishing or other type, or Trojan horse, whatnot? How do you think this specific type of hacking approach presents different types of risks than, say, more previous, more antiquated attacks?
So there are two separate parts to this. One is, how do you get the ransomware into the target network so you can then deploy it? And that's actually no different from what we see with other cyber attacks, whether it's trying to steal money or steal information or interfere with operating systems. You can use any one of a number of tools. You can phish, trick people into downloading something. You could masquerade as somebody that you're not and thereby gain access. You can steal a password or other credentials. And that's the same, whatever it is you're going to do at the end result. What's different about ransomware is, unlike what we typically see, which is an effort to steal money or steal information or engage in some kind of a fraud, identity fraud, what ransomware does is it locks down all of your data and it encrypts it. And now when you try to access your network, you can't, because there's nothing you can read because it's all in code. And the only way to get it out of code is to get the key that allows you to decrypt it. And you can't get the key unless you pay a ransom. And that is why ransomware is destructive, because what it does is it basically shuts down your operations. To give you an example, a couple of years ago, there was a form of ransomware called NotPetya. This was actually launched by the Russians against Ukraine. And in this case, they weren't interested in getting ransom. All they wanted to do was interfere with the business activities and the government activities of Ukraine. And so they infected, using an accounting software, they infected all kinds of machines and all kinds of businesses. And that cost hundreds of millions of dollars to businesses operating in the region.
How do you think the federal government should respond to this? I mean, we have seen the White House raise this issue with Vladimir Putin, for example. I mean, increasingly, we've seen state-sponsored attacks, and yet despite that being raised in some way, that hasn't necessarily kept the attackers at bay. I mean, what should be the federal response at a time when the threat is evolving so quickly and happening at such a quick rate?
Well, I think this has really become the burning question in cybersecurity circles. Obviously, the federal government can help by warning companies when they get intelligence that there's going to be an attack, by sharing information about how to defend yourself, by working cooperatively in various sectors of the economy to raise the level of defenses. But in the end, there's also a question of deterrence. How do you prevent the Russians or people the Russians are hosting from carrying out these attacks? In the past, we've used sanctions, financial sanctions. That works to some extent. We've indicted people, but the chances of getting them in a US courtroom are very small. And so now the question becomes, should we respond using some kind of cyber attack of our own? Should we, for example, disable the server that is being used to launch the ransomware, or otherwise create a consequence in Russia or for the criminal organization that's not just indicting them or sanctioning them for money, but is actually putting them out of action? And I think that's the next really big step. I'll say one positive example of this we saw very recently. Colonial Pipeline paid several $1 million in ransom using Bitcoin. The FBI was able to recover the majority of that money by penetrating and getting the Bitcoin out of the wallet of the criminal group. When you take the money back from the criminals, you've destroyed their incentive to hack. And so doing more of that, I think, is going to be very positive.
It's really good to get your insight today. A former Homeland Security Secretary, as well as the co-founder and executive chairman of the Chertoff Group, Michael Chertoff. Good to talk to you again today. Thanks so much for joining us. Coming up, we are talking about a new kind of work week, at least one country experimenting with a 4-day work week. They say it's been an overwhelming success. Any chance we'll see it here in the U.S.? That discussion's coming up. Well, the results are in for the trials of a shorter work week in Iceland, that is, and it has been hailed an overwhelming success. I'm going to let Miles explain this first, and then we can discuss it, because I have a sense that, Miles, you are all on board with it. I mean, who's not, right? We don't all want to go into the office 5 days a week, but I'm not sure that's so clear-cut.
I'm still shook by that graphic, which I have not seen before. Wow, that's
it's our hot take.
That's not me, by the way. That's someone else.
All right. So let's start with this story, which comes. This is a grand tradition, I think, in U.S. labor reporting, which is taking something that happens in an extremely small working population. Oftentimes, the Nordic countries are cited. We'll see the work culture in Denmark or Norway. Here we get Iceland. So they have 196,700 people in their workforce. 170,000 of them are union members, and a study of those folks over a 4-year period found that when you reduced work hours for those people to between 35 and 36 from 40 hours. So we're talking an hour a day. It's not a full day of work off, but it comes out to about a half day per week. their productivity did not go down, and they were paid the same for this period. I think as we come off a 3-day weekend here in the US, feels like a Tuesday, but fortunately for everybody, it is actually Wednesday. The conversation then gets going. Why are we working 5 days? What are we doing? Are we working too much? And as we here at Yahoo Finance get prepared to go back to the office, the question becomes, what's the point of being in the office versus not? What are we trying to accomplish? Should we be more intentional about some of these things rather than, I think, the default setting we all had in 2019, which was, well, the office is at this place. You need to be there pretty much anytime you're not on a weekend, or you be there a lot and sit there and show that you care a lot. And I feel like it's good if we get away from that culture. Whether we lose a whole working day maybe is another conversation.
Well, I appreciate that we have our chief work-life correspondent, Miles Udland, here to talk about this. I do want to ask, though, look,
I'm a man of leisure, Brian.
There are demographic differences between us and Iceland, right? And one big difference is actually not even demographic. It's just the way that the sun goes down, right? Because I think in May through June, basically the sun never goes down in Iceland. So I guess when you work and when you're playing, it doesn't really matter when the light is just out there all the time. It's very different here where you can be diurnal, nocturnal based off of the sun going down. Do you think that would ever work here?
I didn't expect this to go in that direction, Brian, but here's my take, that a 4-day work week sounds great. I know a lot of companies in the US have gone to unlimited vacation. I would much rather have that so that you're productive, you get your work done, you're allowed to take vacation when not, but you complete your work, as opposed to a set schedule that is a 4-day work week, which I would imagine is kind of getting at the same thing, sort of getting the good work-life balance, learning to take a break when necessary. I don't know. I don't know what the trial or what the results are, on that. Yeah. But there's a lot of companies that have gone in that direction.
So I'll say a few things. Having worked at a company where there was unlimited vacation, let's be extremely clear, that is favorable for the company. Very, very favorable for the company. Not the least of which is that when you leave, they don't have to pay out any unused vacation, because there is no unused vacation. It's unlimited. So that's part of it. Another thing that I think about a lot for us specifically, the three of us here, our job is to cover financial markets, and they're open Monday to Friday. And I think actually I have found, when I compare it to friends in other fields, or even folks I know who cover other parts of the news business, we actually have it pretty good. We have a decent amount of structure around when we're most on and when you're pretty confident things aren't going to pop off. So I think we have a good, kind of position in the industry that way. And I guess the question too about losing the working day is, I think it comes down to how much time do you have? I always remember this when I started working. You leave the office, people say, have a great night. And I'd be like, have a great night? I got an hour and a half. I'm exhausted. I'm going to sit down. I'm going to stare at my phone for 90 minutes, pass out, and I'm going to show up here tomorrow. Have a great night. The night's going to stink. Every night stinks. And I think the point of having a 3-day weekend, or just having more time to yourself, is that you are not so precious about your leisure time. You're not like, I must relax now, because if I don't relax now, I'll never relax. And I think the pandemic has enabled, in some situations, people to appreciate that a little bit more. I can go turn over laundry after this hit before my next meeting. I could go actually make a lunch instead of having to buy Chipotle again or something like this. And it's those little things that I think make people happier. And I hope that as we recalibrate here after the pandemic, we don't lose all of those things, because it's not a lot. It's on the margins, hour here, hour there. I'd love a 3-day weekend every weekend. I know it's not going to happen, but I think changing some of our norms around how much you have to be on and locked in, sitting at the desk, as we all know, frankly, wasting time between hits or whatever, if we can change some of that culture, I think we're all going to be happier.
No, you're definitely right. We're blessed to be able to work market hours, not have to work the weekends because the markets are closed. But Miles, just for saying that, we're going to put you on the assignment to cover the overnight Asian markets for us. But have a good night, Miles. Thanks again for stopping by. We'll have more market coverage of what's going on as we head into the noon hour here on Yahoo Finance on the other side of this break. Welcome to Yahoo Finance Live on this Wednesday, July 7th. Brian Chung filling in for Zach Guzman, who's out this week alongside Akiko Fujita, also in New York. Let's take a look at the market action as we cross into the noon hour here on the East Coast. You can see that all three major indexes are now positive in the green, just barely. It seems like it's been recovering from some of the steep losses that we had basically into the beginning of this show around the 11 a.m. hour. But you can see the Russell 2000, some of those small cap stocks still struggling, as that's down about 0.7%. But of course, bond market action getting a lot of attention as the risk on trade appears to be fading a bit, but was in effect in the beginning of the morning. You can see the 10-year yield down about 5 basis points and the 30-year on the longer end of the curve down about 7 basis points. But here's what we got on dock for the next hour. JOLTS data this morning showing quits rates falling, but not in the food services industry. So what are fast food restaurants doing to not only draw in labor, but retain them in this unusual labor market? We'll talk to one Texas chain of the chicken tenders variety. And the labor market theme continues as employers scramble to remove any and all barriers to hiring, and one possible casualty could be drug tests. We'll discuss how employers are thinking about tests and, by extension, how that has affected the drug testing industry. And lastly, remember all those promises from the Biden administration working on loan forgiveness for students? We'll get an update as senators on Capitol Hill press the education department with a payment cliff coming. But of course, all eyes on the market right now, and that's where we'll begin this hour. We're chatting more about that with Dave Ellison, Hennessy Funds large and small cap financial funds portfolio manager. Dave, thanks for stopping by this morning. Again, some kind of interesting movement. We started off negative in the red this morning, but things have kind of popped back up. You don't want to read too much into one day's action, but what are you gleaning from what we've seen specifically in the bond market? Because that might suggest some more risk off activity as people go into fixed income. What do you think this market dynamic is telling us?
Well, I think it's, again, we've got, the end of the month came last week, and now we have earnings season coming up, and that's going to, people are positioning around earnings season. The rate thing is, it's a crazy story. I think the textbooks that we used in college and business school about the stronger economy and higher rates and all, they're all going to have to be rewritten. And I think we're just dealing with an economy that I think is not as good as people think. And there's just such a voracious demand for yield, and that it's overwhelming whatever the Fed is doing and whatever the economy's doing. So I've been saying for many, many years that we're going to end up like Japan. We're going to have very, very low rates, and the economy is going to, the economy is going to live on growth stocks and a little bit of return in your bank, and that's going to be it. It's going to become a very narrow economy, and you see that now with the growth stocks doing what they're doing for the last 4 or 5 years. So we'll see what happens.
I mean, with that said, is that where you're putting your money behind right now? I mean, what does your portfolio look like when you consider the fact that you just mentioned that you just don't think the economy is as strong as maybe the market has suggested?
Well, I think the market is basically saying, look, I believe in growth, I don't believe in price or inflation. And I think they started to change their mind a couple months ago, and now they're realizing that the only real opportunity in the marketplace is companies that can grow. I don't care if your price goes up or down, lumber goes up, it goes down, it doesn't matter. There's no real growth in the demand for lumber, but there's growth in the demand for tech services and all the other stuff that's around that industry. And that's why those stocks continue to do well. I run 2 financial funds. And in the large cap portfolio, I'm basically buying the growth payment companies, whether it be Visa, MasterCard, PayPal, Square, WorldPay, you name it. I own some banks, but the banks are really going to struggle here if rates don't come back up. And I just don't think rates are going to go up. I think we're missing the truth of the market. In a sense, the economy ran on leverage for many years. I started in the early 80s. The economy and the market ran on leverage. And every little downturn, every big downturn in the market was because the leverage trade didn't work and it broke, and it had to be fixed by the Fed primarily with lower rates. And now we're in a situation where the market and the economy runs on liquidity, and the liquidity flows in and out. It's not leverage. And so that's a new dynamic that I don't fully understand, but I think the market's trading as if we're a leveraged economy, and we're not. We're a liquidity economy now. And you see that with, the Fed funds, you see that with the Fed, and you see that with rates. There's just too much liquidity, too much demand for collateral. And so rates are going to stay low for, a generation plus.
Yeah, when you talk about the humility of kind of not understanding what's going on in this low rates environment, I mean, we don't know what the next step is going to be when it comes to whether or not the next downturn maybe pushes us into negative rate territory. Regardless, what we know is that this is more of a reach for yield market than it was in the past. So I guess my question to you is, what do you think is going to be the next cycle that could be the next downturn? And what is that advising you in terms of maybe asset classes that if you don't like them, look, I'm just going to stay away from that. I don't want to be anywhere close to there.
Well, I think you're seeing it now. The market is doing a lot of the work for you. You look at the best performing stocks the last 3 or 4 years, or the last, maybe not the last 3 or 4 months, because it's all been this reflation trade. And Wall Street loves that because they want trades, right? They want people to think there's a change in the weather, so people will buy new clothes, in a sense, as a metaphor for buying new stocks. We've had that change in the weather. It didn't work. And the market's jumping right back into the growth phase of the market in terms of the stock. So, I think it's my sense is that, the Fed tapering is actually going to make rates go lower, not higher, and that's why the Fed is resisting the tapering. And so I think what's happening in the market is the exact opposite of what people think should be happening, because there's so much liquidity and in the system that is looking for collateral. If you look at the bank, the loan to deposit ratios at the banks, meaning that the loans are much, much higher than the deposits are much, much higher than the loans. And in a lot of the cases, the deposits are twice the loans on the books of these banks. I mean, that's at all-time historic highs. And every bank I talked to in the last, month and a half leading up to earnings season, they're all telling me that deposits are still coming in and they're paying them basically nothing. So that tells me that consumption is just not there if people are still putting money in the banks now.
Yeah, these banks are swelling on the balance sheet. That's because of the amount of quantitative easing that the Fed's done. You have some banks actually turning away wealth management funds now. But again, Dave Ellison, Hennessy Fund's large and small cap financial defense portfolio manager. Thanks for stopping by. Let's take a look at shares of DD right now. Again, as we cross into that noon hour, it looks like it's still experiencing the fallout from the regulatory news over the weekend, down about 6.5%. Chinese stocks across the board have been having some noticeable stock movements as well, not noticeably as at least Chinese EV maker XPeng, which debuted in Hong Kong public markets. The shares actually ended flat in its first day of trading. They're also listed stateside. They had listed before that. And Nikiko, I mean, this is a story broadly beyond DD that reaches into so many different directions. So you think about big tech, U.S.-China relations, the liberalization of capital markets. I mean, I guess the question is, are we reading too much into this when we start to look at literally every other Chinese-listed company and say, is this because of the DD fallout?
Yeah, I mean, it does feel like there are very specific targets for the Chinese company. I mean, you want to start by looking at these companies that have enormous amounts of data that have sort of been deemed as critical infrastructure. And DiDi is one of those companies. Obviously, 90% market share over in China as ride-hailing market there. We've gotten a number of layers that we've been looking at, Brian, and some additional developments here. Over in China, Caixin reporting that DiDi has now been hit with a class action lawsuit here in the U.S. They're essentially accused of misleading investors. 2 class action lawsuits that allege that DiDi did not disclose the fact that they had been told by regulators to try and delay that IPO. And if, in fact, they are able to prove that point, that would mean that DiDi was in breach of disclosure rules here in the U.S. In addition to that, we had WeChat as well as Alipay removing that shortcut to DiDi, which is certainly significant because if you think about WeChat alone, they've got 1 billion users there. That's a big development. And then you've got, I think, what is the larger picture here that points to what could potentially happen in the motivation, which is that Chinese regulators are now looking at revising some of the rules for Chinese companies who are looking to list outside of mainland exchanges, specifically trying to go after variable interest entities or VIEs, which basically allow Didi as well as Alibaba, Tencent, so many companies to be able to list outside of the mainland exchanges and expose what has been a loophole for regulators in China.
Yeah, and absolutely. You mentioned that class action lawsuit, and you do wonder to what degree it would even help a company if in the future they were a Chinese company trying to list stateside. It's not going to be enough just to put into your S1 that one of the risks to your business model as you go public would be some sort of regulatory headwind coming from the home country. I don't think that would be even enough of a fail-safe, if you will, to protect these companies once they do decide to go public, which means that really the only other avenue and option here for these companies is to not list on the US side. And we've seen the reaction from investors. We've seen the reaction from some of these Chinese companies as well. And you really do wonder if the door is shutting here. Now, of course, you don't want to read too much into that one story, but it just seems like the scale of this is just so remarkably large, Kiko.
Yeah, and if you look at the Didi's S1 filing, they did in fact list some key risk factors that had to do with laws and regulations within China, and they did state that that could have a material impact on the stock price. This class action lawsuit, though, alleging they should have gone a step further here if in fact Didi had already had that conversation with regulators to delay the IPO. And obviously, you know, we're talking about Didi today, Brian, but there's a number of other companies. ByteDance, the parent company of TikTok, looking for a potential listing outside of China. That one could be put on hold for much longer or could be forced to list closer to home because of these regulations that are changing over in China. But a story that seems like it is changing by the hour, one we will continue to stay on top of. We are off for a quick break here, but coming up, we're talking about the labor shortage and the extent employers are willing to go to try and lure new employees. One fast food chain offering $50,000 salaries for teen managers. We're going to talk to the CEO of that company, Lanes, on the other side of the break. We'll be right back. Well, job openings hit a record high for a second straight month in May, raising the stakes for employers who are scrambling to fill some of their positions. One fast food chain in Texas is elevating teen employers to managers to retain them, offering up $50,000 salaries. Not bad. Let's bring in Garrett Reed, Lane's Chicken Fingers CEO. Garrett, it's good to talk to you today. Just give me a sense of what you have seen in the labor market, first of all. I mean, we hear $50,000 salaries and we think, well, that's a big bump if you're a teen manager, but we've also heard signing bonuses. We've heard wages being increased. How tough has it been for you to fill your positions?
It's been tough. It's coming out of COVID. We were pretty optimistic about being able to get a hold of managers that have 7 to 10 years of experience. What actually happened was the applications for people with that level of experience didn't come in like we thought they would, and so we have an unbelievable group of young people in our pipeline that we've spent years training and teaching, and we figured we'd give them a shot, and they haven't proven us wrong yet.
Hey, Garrett, Brian Chung here. I guess the question is, right now, you can offer these incentives, you can offer wage bumps, salary bumps, but it's whether or not it's enough to bring these workers back. And we know that on the macro scale, there are still over 6 million people compared to pre-pandemic levels that are on the sidelines for whatever reason, be it childcare, unemployment insurance, fears of the virus. So I guess when it comes to the moving wage bar, if you will, how do you know that this isn't the ceiling here, that you might need to actually not only just raise wages, but maybe at some point raise prices on your menu as well to accommodate the demand for labor?
Yeah, I think when you start talking about raising prices, that's going to be a real issue, and it's not just labor; it's the commodity market. I'm sure you guys do shows on that all the time. Commodities are just as bad as labor right now. We're fortunate to be in the fast food business, where we have a lot of kids that join us at what I like to call a learning wage. So we've got a lot of good kids that work for us at that learning wage. After we teach them and work with them for a period of time, we do move them up into more of a living wage. But it's tough out there, and we are having to pay even those learning wage kids a lot higher than we used to.
Now, Gary, you just mentioned commodity prices. We've heard anecdotes about chicken prices across, depending on what cut you're talking about, going up across the board. But some of that might be temporary, whereas raising wages will be more permanent. But investing in human capital is a lot more of a difference than just paying for the wing itself. You do need both, but one is more permanent than the other. So as a manager here, how do you juggle those two things to make sure it's not just you meeting the bottom line now, but you being able to meet the bottom line in 12, 18 months?
Yeah, I think that's well, what we do in that particular instance is we talk with our franchise partners about this all the time. It's constant training, constant identification of employees with the right skills. It's really being a operator that understands your people. You've got to recognize the ones that are great, the ones that love the culture, the ones that are passionate about the brand, and move them up. And then the ones that are not, you can't keep them around. The reality is, if you elevate the great employees, the people that really love the brand, then you'll be able to have a good workforce. But you're right, you make a really good point. In the future, what's going to happen? Because you can't tell somebody, hey, I'm going to pay you $50,000 right now, and then, hey, just kidding, now you got to make 40. That's not what can happen. So the changes in wages are real. They are permanent. I hope the commodity prices are not as permanent, but I got a feeling they're going to stay high for a while.
At what point do you have to pass the cost on to consumers, those who are at your restaurants? I know you said that's a big concern for you, but how much of a cushion do you have right now when you've got price increases on one hand and then you've got wage increases on the other?
Great question. A question we have with our franchise partner, or a conversation we have with our franchise partners all the time. We're getting dangerously close to that. Right now, we're trying to keep prices where they're at. It's harder for a smaller organization like ourselves because the big guys like McDonald's and Chick-fil-A, they have enormous buying power. So we've got to stay competitive. We haven't reached that threshold yet. We're going to sit it out for a couple more months, see if commodities start to come down. a year ago, we were buying chicken tenders, $55 for a 40-pound case. This last week, they were $118 a case. So it's getting tougher, but right now we're just trying to make do.
Now, Garrett, in terms of just the company strategy, I understand that you're trying to grow right now. When it comes to maybe opening up new stores or new locations, how are you thinking about that right now? Just in the commercial real estate space, are there places where you can expand? And I do know that the labor market shortage and the commodities prices actually might be limiting you, but what do you kind of see as the big picture vision here?
Yeah, we do have quite a few locations. We just opened up one in Houston, Texas 2 weeks ago. It's doing fantastic. The commodities prices trickle down to everything. So the build out of the restaurants, all the raw materials is extremely expensive. So we're having to calculate that into our pro forma right now. You look at the increase in wages and you look at the cost of commodities. It's tougher to make your return on investment look right. Although you've got to have some forward look to your pro formas and you got to say, hey, this is probably temporary. Your fixed cost, though, your real estate fixed cost, if you're going to buy lumber for what lumber is today, that's not going to change. It's going to be there for, the next 20 years. Labor, obviously, the price of that's going to go up and, you hope the other ones come down. But it's tough to make deals pencil right now to get returns to say, yeah, this is what I want to spend investment dollars in. Fortunately, we're in a business that has decent margins. And so we're going to continue to grow and kind of just bite our bottom lip and fight through it.
All right. Well, I'll have to stop by and get some chicken fingers next time I'm in the area. But Gary Reed, Lane's Chicken Fingers CEO, thanks again for stopping by Yahoo Finance this afternoon. And coming up on the other side of the break, our discussion of the labor market dynamics will continue as we talk about employers maybe knocking down another barrier to hiring, drug tests. We'll be right back. Welcome back to Yahoo Finance Live. Labor markets are in a weird place right now, as we were just discussing in that last segment. There are still 6.8 million fewer people out of jobs now than there were pre-pandemic. And we were just talking about ways employers are knocking down barriers to employment. One of those barriers may be drug tests. So let's bring in Bill Curran. He's the founder of the Current Consulting Group. And Bill, you consult for drug test manufacturers and third-party administrators. We were actually just having a very spirited conversation in the commercial break about this type of issue. But what are you seeing in terms of this industry when it comes to specifically the labor shortage? Are you seeing a lot of employers citing it's so difficult for us to find jobs, we don't want to have this barrier of drug tests when it comes to trying to get prospective employees on board?
Well, that's a growing issue. There's no doubt about it, but it's more specific than just drug testing. A lot of employers are concerned that testing specifically for marijuana is preventing them from finding the right employees or finding enough employees. And so it's not really sort of the labor shortage, generally speaking, but what impact does testing for marijuana have on our ability to fill our ranks? That's the big issue right now.
Obviously, Bill, this comes at a time when we've seen more and more states legalize marijuana use. And I wonder to what extent there's a bit of a catch-up period that's needed here. I mean, we were just talking about the Olympic trials last week, and one of the athletes, gold medal hopeful, being eliminated because she tested positive for marijuana. And there was so much outrage, especially because so many states have legalized the usage.
Yeah, so that's a growing trend as well. There are about 36 states that have legalized marijuana either for recreational use, so-called recreational use, sometimes referred to as adult use of marijuana, and medicinal marijuana use. And the challenge with that is that over the last 2-3 years, some of the states that have passed legal marijuana laws have also inserted into those bills language that restricts employers from, say, taking action based on a positive drug test result. Can you refuse to hire somebody on a pre-employment test if they test positive for marijuana? What if it's a reasonable suspicion situation? You suspect somebody's high on drugs, you test them and they test positive. Well, some states have actually said that in addition to the positive drug test result, employers also have to provide evidence that the individual was impaired or under the influence at the time, and that's why it led to an accident or some other aberrant behavior. And so employers are really caught in a tough situation now when it comes to drug testing, but really specifically drug testing for marijuana. Marijuana is definitely the #1 drug that people test positive for, followed by cocaine and opiates and opioids, I should say, and amphetamines, for example. We saw opioid positives and amphetamine positives skyrocket last year during the pandemic. Marijuana went up also, but marijuana was already very high on the list. So a lot of employers are struggling now with, what drugs can we test for? How hard does it make for us to find employees if we test for marijuana? And then in some states, they ask the question, is it even worth the problem? Because they may have to jump through other hoops in order to take adverse employment action or refuse to hire somebody who tests positive for marijuana.
Now, Bill, as you mentioned, there's definitely you can't assume the same trends are happening with marijuana drug tests as there are with other types of tests. But I just specifically on marijuana, if we do see employers abandoning these tests, for example, which is what I'm kind of hearing, do you think that's a temporary thing? Do you think this is just something that they're just using to reduce the barrier for right now, and at some point down the line when the labor market, dynamics return something closer to normal, they'll bring the test back? Or do you think that because of just also the federal trend of where legalization is going across the many states in this country, that a lot of these businesses will probably just leave them for good?
Yeah, I think there's some percentage, it's probably a small percentage, that have just decided to walk away from drug testing and have no plans to come back to it. But in certain industries, safety-sensitive industries in particular, there's still plenty of drug testing going on. They haven't abandoned it. They haven't dropped it. In fact, they haven't even dropped marijuana from their drug test panel. I think where we're seeing more flux and more movement is in the non-safety sensitive industry. Food services, retail, other industries where employees are not necessarily doing something that could potentially cause harm to another person if they're doing their job under the influence of marijuana or any other drug. So I think a lot of those companies are in that catch-22, whether or not they should do drug testing, and then what negative impact does it have on hiring and filling out staffs and things like that. But in safety-sensitive industries, very few, I think it's a very small percentage that have even considered dropping marijuana or drug testing generally. And then beyond that, I think the thing that will probably happen, and this will take a few, 2-3 years to occur, is more companies drop marijuana from their drug test panel or they stop drug testing altogether. We'll probably see an increase in people on the payroll who are drug users. And with that, we'll see an increase in some of the sort of symptoms of having drug users in your workforce. More accidents, more employee theft, more violence in the workplace, things of that nature. And I think over time, companies that drop drug testing, especially in certain industries, will probably come back to it over the course of time.
And Bill, I know you're on the testing side, but I wonder if you have any sense of how significant the worker loss would be if some of these businesses were to implement the drug testing, those who are foregoing it. I mean, we had Garrett Reed on in the previous segment. He's in the fast food sector, and he said an overwhelming number of people he would not be able to hire necessarily if he had to do mandatory drug testing.
So you have to look at two different statistics. One is, what's the percentage of individuals in certain industries that are drug users? So for food services is usually number one or number two. They trade places with retail on an annual basis as to which industry has the highest percentage of drug users or admitted drug users. But it's also an industry that hires from that demographic that's more likely to use drugs. Young adults between the ages of, say, 16 and 25, 26, 27. So they already have that issue of hiring from that demographic. But as Mr. Reed pointed out, he and I had a conversation during the break, that it would be tough if you were testing people from that demographic, which is very high in the food services industry. If you're testing them for marijuana more than anything, you're probably going to lose a fairly significant percentage of your workforce, or have even more trouble finding workers if you have a very strict policy that if you fail a drug test, we're not going to hire you, or if you fail a drug test, we're going to terminate your employment. That would probably have a big impact on certain industries, and food services would probably be one of them.
Yeah, it's fascinating to see the changes there. And Bill, really appreciate you sort of highlighting this for us. Bill Curran, Consulting Group President, joining us there. Coming up, pressure building on the Biden administration to act on student loan forgiveness. The latest developments as we count down to the pandemic, pause on the student loan payments being lifted. That discussion is coming up next. We've got less than 2 months to go until that pandemic pause on student loan payments are set to be lifted. And there is growing pressure on the Biden administration to act to provide students with more relief. Let's bring in Yahoo Finance's RT Swaminathan, who covers that space for us. And RT, we're talking specifically about fixing existing programs, but how quickly is the administration likely to act?
Yeah, so these senators and a lot of them have been sort of arguing for fixes for a couple of years, right? So specifically, 23 senators, including Patty Murray, Chuck Schumer, Elizabeth Warren, a lot of familiar names. They've been urging education to fix existing programs like public service loan forgiveness, like income-based repayment, like borrower defense, discharges for people with total and permanent disabilities. And basically what they're looking for is to simplify loan repayment, close donut holes in forgiveness programs, and basically improve borrowers' confidence in the entire student loan system, because right now borrowers are very, very worried about what's going to happen, right? And what is interesting is that the timing of this, more and more letters are being sent to Cardona, Miguel Cardona, the Secretary of Education, because the payment pause is set to expire at the end of September. And what they're all worried about is defaults and delinquencies spiking. And as we previously reported on, 9 in 10 borrowers said that they're not prepared to pay when the student loan pause expires. So we're going to see more and more letters like this, but the pressure is just escalating, and they have hinted that they might do something, the education department, but we're not hearing anything concrete just yet.
RT, I want to follow up with a question just about staffing. It's across all the agencies, but specifically at the Department of Education as well. There's been some new hires from the Biden administration for specifically the Department of Education. Was there anything on that list that caught your eye?
Yeah, that's a really good point, because there was one person on the list yesterday that was announced that really caught my eye, which is Toby Merrill. She was previously at the Harvard's Project on Predatory Lending, and she used to represent a lot of students in cases against the government, basically looking for student loan discharges. And she was announced that she's going to join the Office of General Counsel. The big other reason why it's such a big deal is because she's one of the 3 lawyers who wrote the memo that basically outlined why the president or the secretary has authority to cancel debt unilaterally without the need for Congress to intervene. So Warren has been citing that letter basically since she made this policy proposal. So it's going to be very interesting to bring this sort of person into the system. Will that change the way they think about policies? What does that mean? I don't know if I'm being too optimistic, but it does seem like an interesting sign for borrowers to keep a track of.
Yeah, well, I mean, people forget that we're only 6 months into this administration, so there is still enough time for them to do something, and we'll definitely keep posted on that. But again, RT Swaminathan, thank you so much for stopping by. And on the other side of this break, we'll check in with Jared Blickery as we keep an eye on oil. WTI crude oil down 4.9% this week. That's actually headed for the worst week since March. Again, we'll have the updates on the other side of this break. Welcome back to Yahoo Finance Live. We're about 15 minutes to the 1 p.m. hour here on the East Coast. Keep an eye on crude oil right now, which is down about 1.7%. But let's get an update on not just that, but all the other asset classes as well with Yahoo Finance's Jared Blickry. What is catching your eye on this afternoon?
Well, let's start with crude oil. No news on the OPEC Plus front, still in a quagmire there. Not an SEC quagmire, just a regular one. You can see it's down 1.5%, not the biggest move. I'll tell you what, look at what's happened since Sunday evening, and you can see this is the biggest downdraft we've had in several months. I think you alluded to that, Brian, before the break. But in the grand scheme of things, really not looking like much of a blip here. You can see we've had some sell-offs before, very mild. And let's remember, back when crude was trading around $45 per barrel, all the way at the left, lower left of the chart, the daily moves could easily be 5, 6, sometimes even 10%. So really, we've gotten used to kind of lulled into this lack of oil volatility. Now we're seeing it kind of pick up again. Not too surprising overall. We still have support just a little bit lower at 70. It looks like 72 is a big round number that's kind of being respected. But let's take a look at the heat map inside the energy market. And we're going to see a lot of red here, not surprised. But let's take a 2-day view, and we can see some dark red. So Exxon's down 4%. Some of the majors, overseas majors like British Petroleum, that's down over 4.5%. Schlumberger, 6%, Occidental Petroleum, 8%, very heavily geared toward the Permian Basin. But these stocks have been doing very well this year. I'd like to throw this year-to-date heat map up, and you can see Exxon still up over 46%, Marathon Petroleum up over 40%. So really holding on to a lot of gains. And as I've been saying, crude oil, one of those commodities that has bucked the downward drafts we've seen in so many others over the last 6 to 8 weeks. Also want to check out, let's see, the mega caps. The mega caps have really been flying high recently. Let's do a 5-day view, and we can see Apple up 5.5%. It's still set for the first record high in many, many months here. Alphabet up 3.5%. Amazon, another record high, up 7%. So the mega caps have been leading here. And it gets back to the bond market. I'm just going to end here with the 10-year T-note yield down another 6 basis points, getting a little bit oversold, but I think we could get to that 1.25 level somewhere down in here. And that ends my wrap with the bond market, guys.
Jared, another sector we're watching closely, a lot of the travel names down today. Of course, we're watching the airlines as well as the cruise liners. What's behind some of those moves?
Yeah, I think it's just the COVID scares kind of manifesting themselves around the world. And I'm going to go to a travel heat map here on the Wi-Fi Interactive. This is today's price action. You can see Royal Caribbean down over 1.5%. Southwest, which was canceling flights yesterday, or at least announcing them, that's down 1%. Carnival down 2.5%. Not the biggest moves, but you take into consideration what's happened over the last 2 days, definitely giving back some gains. A lot of these stocks peaked a few months ago. So if you take a look at the 1 month or 2 month view, you're going to see a lot of red there. Carnival down 20%, difficulty getting off the ground. Well, I guess cruise ships don't get off the ground there. But you take a look at year to date, and guess what? They're still sitting on some nice gains here, not always substantial. Avis, that's a standout. That's more than doubled year to date still, even though giving back some gains there. American Airlines up 30%. But for the most part, yeah, these stocks topped out a while ago, and now they're trying to find a range similar to what mega caps were doing, and now they're surging. So we've definitely seen a rotation here over the last 6 weeks, guys.
Okay, Jared Blickry walking us through the moves. Thanks so much. Coming up, former President Trump going after social media giants in court this time. The details of his class action lawsuit coming up on the other side. We'll be right back. It is time for our hot takes. And today we're talking about former President Trump going after social media companies in court this time, filing a class action lawsuit against Facebook CEO Mark Zuckerberg, Twitter CEO Jack Dorsey, as well as Google CEO Sundar Pichai. The former president announcing that lawsuit in a press conference today, filed in the Southern District of Florida. Brian, I'm not sure I have a hot take on this necessarily, but in many ways, we have seen the former president muzzled. Essentially, we haven't really heard from him because he's not on any of these platforms. And so I would argue that this speaks to the power of these platforms, maybe a bit of irony going into this, seeing that you've got somebody who has kicked off the platforms, who are suing the platform so that he can get back on it.
Yeah, and I think irony is the right word to describe this. We don't need to go into the nuances of what happened to President Trump on these, former President Trump on these particular platforms. But what we do need to recall is that in 2020, we saw the president try to revoke the Section 230 protections that were allowing these companies to skirt any sort of legal liability for content that's published on their platform. Now, of course, at the time, when the president was still, the former president at the time was on those platforms, he was trying to advocate for protecting his freedom of speech. But after he was kicked off, now he's trying to sue not the companies, because he can't do that because the Biden administration revoked the 230 changes that Trump had put into place. And now because of that, he's trying to go around that by suing the CEOs themselves. But again, it just kind of brings around full circle that the idea wasn't necessarily to question the big picture of whether or not these large social media companies should be liable for the content that's on their sites, which I think beyond whatever President Trump at the time was posting on his Twitter account, I think is a valid debate. What we know now from this lawsuit against the CEOs shows that a lot of this was about his personal approach and the way that he was personally being treated on the platform. Now, of course, that debate about Section 230 it appears to have passed, but you do kind of wonder at some point down the line if it's not Trump, if it's somebody else that could bring that debate back up to the forefront of the big tech controversy.
Yeah, and if we're talking specifically about what this lawsuit is calling for, the president seeking immediate injunctive relief to allow his social media accounts to be restored. He's also asking the court to impose punitive damages on Facebook, Google, as well as Twitter. Now, you raised the issue of Section 230. Obviously, there's been a lot of debate in Congress about whether, in fact, the content or the platform should be held liable for the content. And it's interesting to see this discussion in the global context, because, yes, we have been talking about it in the U.S. here. But the other day, we saw India really cracking down on that, saying that Twitter is, in fact, liable for anything that's on the platform there. And so it's interesting to see how these threads have moved in tandem, regardless of which country it's in. And I think that points to the power of social media companies. Increasingly, a lot of these companies are saying, look, how much of it can we be responsible for? But when you have something like the insurrection in January, certainly going to get a lot of people to say, how did you not see that coming when all of the chatter was happening on Twitter as well as Facebook?
Absolutely. And you bring up the really valid point that this is going to be a different debate in different jurisdictions around the world. We were talking just yesterday about the issues that these social media companies are facing, tech companies at large, with some of the concerns in Hong Kong over that law of anti-doxing. Now, if you tried to apply some sort of similar law here in the United States, you do wonder to what degree the big tech companies might have a different approach to speaking out against certain laws or regulations, just because of the differing social atmosphere that kind of surrounds these types of issues. It just shows that the big tech companies, at least for now, if they were able to avoid the Section 230 debate, might just be inevitably kicking the can down the road for some other type of government run-in in the future.
Yeah, it does seem like a fragmented approach, though, doesn't it? I mean, you think about social media in many ways, it is about connecting so many people across borders, and yet you've got individual countries really trying to find a way to crack down on some of these platforms because of the speech that they believe has incited certain types of actions. Obviously, in Europe, there has been issues about content. It's been more about antitrust issues as it relates to these platforms. It's going to be an interesting discussion moving forward, just given the scale and scope of these platforms. You look at Facebook alone, I mean, we're talking about more than 2 billion users.
Absolutely. And that's a big reason why a lot of these big tech companies, they try to hire people that were in the government. You recall Nick Clegg, right? Obviously going over to Facebook, people were like scratching their heads at the time, but it makes sense that you can have those political know-how inside the company to deal with all of that issue. So obviously a lot to watch out for in that space, and we'll see if there are more headlines. I expect there will be out of that story.
You're certainly right about that. The former president, if anything, does like headlines and likes to get the publicity for it. So I'm sure we will hear much more about it. Let's turn our attention to the markets before we let you go here, because we have seen all three major indices now turn in the green. The Nasdaq just dipping into the green, up about 9 points or so. The Dow up 47 and the S&P 500 up about 11. Remember, yesterday we saw the S&P 500 ending that 7-day winning streak. So it looks like we are back on a positive path here. But of course, still more to go in the session. We've got much more to come here on Yahoo Finance Live. That does it for Brian and I. But Kristen and Alexis are going to pick up the coverage on the other side of the break. Welcome into the next 2 hours of coverage here on Yahoo Finance Live. I'm Kristen Myers here with my co-host Alexis Christoforous, and let's take a look at what is happening today. Now, the Fed is set to release the minutes from its June FOMC meeting in about an hour. Now, investors will be looking for even more clues as to the direction of monetary policy, especially movement on those interest rates. And rising cases of coronavirus in the United States
are showing the risk of that Delta variant of COVID-19. Now, the World Health Organization has started to ring alarm bells of a dangerous period up ahead. And are you looking to retire anytime soon? Well, we'll be breaking down the best and worst states to spend your retirement later on in this hour. You might be surprised at who clinched that top spot. Taking a quick look at the markets right now, Alexis, I'm seeing all three major indices right now in the green. S&P 500's right back in that record territory, of course, after snapping that winning streak. Of course, we're seeing tech stocks. We're seeing investors pouring right back into those as the NASDAQ has now flipped into the green from the red a little bit earlier on in the trading session.
Yeah, Kristen, I was going to say, we certainly didn't start out that way today. Stocks were lower. We've really been swinging between modest gains and losses here throughout the day as investors search for the next catalyst. And it very well could be those Fed minutes you referenced. We're going to get those at 2 p.m. Eastern, and our own Brian Chung is going to be here to break that down for us. We saw the Dow Jones Industrial Average higher, the S&P 500 in record territory, as you say, even the NASDAQ, again, flirting with a record high. And remember when investors were obsessed with rising inflation? Wasn't that long ago, just a couple weeks ago. Well, if you look at the bond market, those inflation worries seem to have all but disappeared. We've got the 10-year and 30-year Treasury yields now at their lowest levels since February. Jared Blickery here now with more on the action in the bond market. And we know sometimes, Jared, the bond market's a couple of steps ahead of equity investors. What are they telling us about inflation, do you think?
Well, I think the message was sent a while ago, and I think we're at the tail end of this move. Let's go to the Wi-Fi Interactive, where we can see over the last 2 days just a huge slip downward. Once we broke this support right here, it was off to the races to the downside. We're looking at a 10 to 11 basis point move, which is really big in bond terms. That equates to about 0.1 or 0.11%. Seems small, but small things in the bond land mean big things for the indexes and also their components. So let's take a look at the NASDAQ 100, where we see a bunch of these mega caps at or near record highs. Apple, Microsoft, Amazon, Alphabet, all set for record highs. Facebook almost there. It's fallen off a little bit. Tesla, yes, a mega cap, down today 2.5%. NVIDIA also near its record high, down 1%. So Tesla really the only one of this group that is substantially off of its record highs. But we got to take a look at inside the energy market. That is one of the other big stories of the day. This is what's happened today. I'm going to give you a 2-day view so you can see the price action for this week. Not looking good. This is on the back of a decision, or an indecision, I guess you should say, by OPEC Plus to increase production. And this was something that was supposed to happen last Thursday. You take a look at the 7-day price action in crude oil. This is, here's last Thursday. So we got a little bit of a spike up here. Looked like they were going to come to an agreement to increase production at a modest rate. Then the UAE dropped out, postponed, and here we have this violent sell-off. But I'll tell you what, it's only about 5% peak to valley, and that is the biggest weekly drop we've seen since, I believe, March, but still not a biggest deal in the grand scheme of things. Also want to check out meme stocks, because we got a few high flyers here. This is over the last 2 days as well. Newegg up 222%. 500% over the last 5 days, or 7 days, excuse me. So this stock, it was trading at about 10. It is now trading at 61. Just an incredible meme stock story there. But for the most part, a lot of these other names in the red. And I'm going to go back to an intraday view, and we can see some of the biggest losers here tend to be the more obscure biotech plays. Here's a familiar name, AMC, that's down 8%. Looking at the price action over the last month, you can see that it had been consolidating here, kind of dropped off, and now we're testing these levels from about 1 month ago. Just check out a year-to-date chart here before we go, and you can see that testing the lower end of this range, 40 seems to be a critical support area. So that's the level I would watch where I long AMC, and you wouldn't find me short AMC, that's for sure.
All right. Thanks so much, Jared. We'll see you later on in the next hour. I want to continue this market conversation now. We're joined by Francis Newton-Stacy, Director of Strategy at Optimal Capital. So, Francis, I do want to start with some of those bond yields. A pretty interesting move here, because it doesn't seem too long ago that we were talking about an economy that was overheating. Inflation risks were one of the biggest things that investors had been talking about. And now it seems as if we've done an almost about-face. What do you make of these recent moves that we are seeing with some of these bond yields?
I think the most important thing to remember is that markets are anticipatory. So we actually started the inflationary and reopening trade upon the vaccine announcement on November 9th, right? And there was nothing in the economic data that indicated that that trade was valid. But markets try to price the next thing in, the next thing in, the next thing in. And markets have, went ahead and priced in, when you had a relative weakness in the NASDAQ, they priced in rising interest rates. And they priced in the possibility of inflation being rampant rather than transitory. But now markets are trying to price in the next thing. And we do have some deflationary pressures coming into the system toward the end of the year, and deflationary pressures mitigate inflation. I always think of these things as a seesaw. And so because we have those things, the thing that got us to all-time highs is we had record acceleration in growth, record acceleration in inflation. We had acceleration in corporate profits, and then we had record monetary and fiscal stimulus. And those 5 things got us to these all-time highs. So when we look at maintaining these all-time highs and these valuations, if you have a softening on any one of these 5 points, the market is going to reprice that. And I think we've lost some enthusiasm with regards to earnings. When we look at valuations, if you remove the inflationary component on the 10-year, obviously you're going to get more support for valuations in quote unquote the tech stocks. But we have to see if earnings also hold true. We have to see if indeed our corporate taxes are going to go up. And we have to see if some of the supply chain disruption in input costs affects those balance sheets as well. So this is a delicate balance. But I think the important thing to note is that we have a possibility here that inflation has peaked ahead of growth against those Q3 year-over-year readings.
So, Francis, does that mean that the market is going to climb higher without that huge inflation hurdle? It's going to need to, or at least investors thought it would need to clear. If inflation looks like it is indeed going to be transitory, what is out there right now that could stop the market from moving higher?
Well, exactly to your point, we don't know until we have more data. All we can price in is the fact that we have the possibility that inflation has peaked ahead of growth. Now, in the second quarter, we had the worst numbers in history. So any numbers compared to that for the second quarter this year, we're going to show an obvious acceleration. You have exactly the opposite in the third quarter. You have record acceleration off of the lows last year. And now, even if the numbers are super, super strong, they're going to show a dramatic deceleration in those, 5 points. So until the market has new data, for instance, Janet Yellen testified earlier this year that 1 in 10 were not paying their mortgages. I know that people are now starting to come out of forbearance, but we don't know what the ultimate result is of those 10% as far as, what of those loans is going to default. You also have that she testified that 1 in 5 were not paying their rents. The eviction moratorium has been extended, so you don't know ultimately the impact of that. These are potential deflationary pressures coming into the system. Another one of those 5 factors is the fiscal spending. The fiscal spending, even though these packages remain trillions and trillions of dollars, the rate at which this money is being put into circulation has slowed because now the packages have trillions coming in over a number of years rather than these direct liquidity injections. The Fed so far is holding pat with $120 billion in bond purchases a month, right? And they've talked about potentially tapering. Some speculation between experts is, are they going to back off of the mortgage-backed securities first? As they have 40 billion of those and they have 80 billion of treasuries. And they're going to have to respond to that based on the rate that fiscal spending decelerates. Because as fiscal spending decelerates, that is de facto tightening a little bit because even though, we're still spending more and more and more, we're spending at a different rate and market participants are going to price that in. So having these potential deflationary things coming into the system at the end of the year is starting to potentially confirm the narrative that inflation could indeed be transitory. And it's also starting to confirm the narrative that the Fed is going to remain easy. So that gives the stock market the comfort of the Fed ease with interest rates not going up. And until we have further data about earnings or other potential problems with valuations, you're exactly right. We'll probably have another leg higher.
Francis, I'd love to get your thoughts on an area that has been red hot lately, and that is the small cap stocks. We've seen the Russell 2000 index up about 50% since September. Do you think that there is more room to run or has the Russell peaked for now?
Well, that's the key point is for now, right? So for instance, they are relatively quote unquote cheaper in the scheme of things, right? But if you consider that the NASDAQ is more of, since COVID, is more of a defensive play, and you consider that we could have a stop off in deflation before we have a reacceleration when we wash out the base effects that, the anomalies and the base effects and other things that occurred because of COVID. So if you have the stop off in the deflationary perspective, you're going to see defensive things. The US dollar is up today ahead of the Fed minutes. Gold is maintaining a high level. Duration is obviously getting a bid with the lowering of the interest rates. You're going to see some of the defensive things that worked during COVID, the stay at home or the tech stocks. In the interim, before you see that people go back to this idea that, okay, we are indeed reopening. We didn't have another full lockdown on the Delta variant if it turns out to be that's the case. And now we look at the relative cheapness of the cyclicals. So I feel like that stop off in deflation and some of the economic changes that are occurring while the supply chain disruptions change. I think the canary in the coal mine was the sell off in lumber to say, whoa, we're backing off of some of these commodity prices, which of course trades inverse to the dollar. So I do think, it depends on your time horizon. I do think ultimately the cyclicals will get another bid just because they are cheaper. But I think for right now, the reopening has been fully priced in. And I do think that markets are anticipating potential headwinds coming into the latter half of the year.
All right, Francis Newton, Stacy, Director of Strategy at Optimal Capital. Thanks so much for joining us as always. And coming up next after the break, COVID cases are rising in the United States, showing the risk of that Delta variant. We'll be chatting about that next.
The CDC says the Delta variant now makes up more than half of all new COVID-19 cases in the U.S. And the World Health Organization warns the Delta variant is putting the world in a, quote, very dangerous period of the pandemic. Joining us now to talk about it is Dr. James Simmons, Commissioner in Los Angeles. Dr. Simmons, it's good to have you on the show again. I know you're there in LA, and I'm wondering if you could paint the picture for us as to what's happening on the ground in Los Angeles County, because I understand that regulators there have already recommended even vaccinated folks wear masks again indoors as you see a rise in Delta variant COVID cases.
Absolutely. This was a little bit shocking to some folks, but I think those of us who are kind of intimately on the ground and looking at the numbers, this wasn't as much of a shock. You know, they're even saying people who are fully vaccinated should wear their masks in indoor settings because there are still a significant number of people who are unvaccinated. And unfortunately, like lots of parts of the country and unfortunately the world, we are seeing a slight uptick in cases, particularly around the Delta variant. So even as far back as just a few months ago, the Delta variant was accounting for less than 1% of cases here in California and LA County. And now it's the majority of cases in the entire state. Previously, it was what's now called the Epsilon variant, which was the Cal 20C variant. Now it's Delta, just like the CDC announced that the majority of cases in the United States are now driven by the Delta variant. And that happened in just over a 2-week period. So we're seeing increases in the Delta variant here. We're also seeing a slight uptick in hospitalizations. Statewide, we're up about 20% in hospitalizations just over the last 2 to 3 weeks. In LA County, we're about 34%. Now, those numbers can be deceiving, right? This is what we do a lot on Yahoo Finance. We talk numbers, and the numbers can be deceiving. That's up 34% from an all-time low of LA County hospitalizations of about 200 folks. Our high in hospitalizations was greater than 8,000 statewide at the peak. So it's up 34%, but it's absolutely nowhere near the huge numbers that we had in December, January, and February. But it's enough of a concern. It's enough of an uptick that right now I think, county officials are saying it's really important that those, everyone wear their masks inside, particularly to protect those who are unvaccinated, which we clearly see are unfortunately taking the brunt of this new, increasing Delta variant.
I'm really glad you injected just a little bit of pragmatism because I think I know I'm not alone. I read some of these headlines and I become incredibly worried and nervous and anxious about this Delta variant. Curious to know how much unvaccinated folks in the United States are going to really weigh on our progress, not just broadly, but especially now that we have this Delta variant really sweeping across not just the United States, but globally.
Yeah, it's really going to be something of a concern, and it's a multifactorial concern. I know a lot of folks don't like that word recently, but a multifactorial concern in that if you are unvaccinated, and we know that the Delta variant is more transmissible, right? The data is still a little bit unclear as to whether or not it leads to increase in hospitalizations or serious illness, but we do know it's more transmissible. So you have more of a likelihood to get COVID. And then, of course, you may be someone who might get sick from that. We see that in our unvaccinated populations going up tremendously, particularly in states with really low statewide vaccination rates. So unfortunately, that's a lot of states in the Southeast and some of the states out here in the West. And what's really difficult about that is that not only are you putting more people at risk for getting sick, there's potential. Now, I don't think this is going to happen like it did before, but there's potential to start overwhelming local hospital system, local healthcare systems, nothing, large scale like we saw here in California where the entire state was strained. But local community hospital systems are going to get overwhelmed potentially from this as well. The more we give the virus an opportunity to go into naive hosts, meaning people who don't have immunity from either the vaccine or natural immunity from having had COVID in the past, the more we give the virus an opportunity to continue to mutate. And that could be dangerous down the road, that there may be more mutations that could unfortunately become resistant to the vaccines that we have. Now, the good news I want to say on the tail end of that comment is that we know right now the vaccines are very effective so far against the Delta variant. So whatever your hesitation has been to get vaccinated, I know it is a very emotional decision for a lot of people. It's not necessarily a logical, factual, numbers-based one, but an emotional one. Whatever that is, we are still really encouraging you to talk through those emotions, meet folks where they are, talk to your providers, talk to your family and loved ones, and really, really, really get that vaccine if you can do it. We're I know Joe Biden has been begging and pleading a lot, and I'm not necessarily sure that that's the best strategy at this point, but I am telling folks that we will start to see surges again, and people will start to get sick and die again if we don't get vaccinated.
You know, you talk, Doctor, about pockets of the country seeing lower vaccination rates, and we're so interconnected, right? I mean, people from the South could be traveling up to the North and spreading the Delta variant if they're bringing it along with them, and they're unvaccinated especially. So do you foresee in the not too distant future that lockdowns will have to happen again, possibly in much of our country, and perhaps even restrictions on travel as we try to get our arms around this? Because in some ways, it almost seems as though we're watching a train wreck. We have the ability to stop it, and we're not.
Slow, persistent train wreck coming, right? It's super, super scary. And listen, I don't think, now, this is a little bit of a bold statement. I don't think we're going to go back to lockdown levels like we did before. Frankly, I don't think anyone is necessarily a fan of that, but for a couple of reasons. Obviously, the economic impacts, which we talk about a lot here, but as well, we have 47.7% of the entire country are fully vaccinated at this point. 57% plus or minus of 18 plus are vaccinated with at least one shot. That's completely different, a categorically different situation than when COVID ran its course through most of the communities in the United States pre-vaccination, right? So we're probably not going to get to a place where communities, and even, on a federal level, on a national level, will happen to talk about big lockdowns again, because probably enough people are vaccinated to not overwhelm local hospital systems. And that's really the biggest driver, unfortunately, is do we have the capacity to care for people who get really sick from something like COVID as quickly as it happened before? Well, now we have lots of folks who are vaccinated, so we're probably not going to reach those levels. I will say we'll likely start to see very short, very targeted types of lockdowns in states that were in favor of them before, because the data is playing out to be really rich to show that those lockdowns really work. When people are not around each other, they're not spreading the virus to each other. It's really that simple. And so you may see small targeted lockdowns, you may see travel restrictions, things like that because of this Delta variant, but I don't think anything on the scale as what we had before.
We only have about 30 seconds left with you, so I do want to ask you about this new initiative that's been proposed by the White House of these door-to-door vaccinations. Is this a good idea? I know that it's an initiative and something that's been done in a lot of developing countries before for things like polio, for example. Are we at a point right now where we need the government and we need public health officials to go door-to-door to start vaccinating folks?
I think we should have done this a long time ago. I think it should have been a part of the initial push for this, particularly in Black and brown communities where there's hesitancy against sort of the large healthcare system for very well-founded reasons, right? It's that interpersonal connection that is really going to make a difference as to whether or not people are going to get vaccinated. So if I'm talking to a fellow church member of mine, or someone who works out at my gym, or someone who's a part of a community organization that I'm a part of, really pro-vaccine, and they can really have an emotional conversation with me about it, that makes a bigger difference than sort of these large-scale public health initiatives in particular communities. So I think we absolutely should be doing that. We should have done it earlier on. And I definitely hope that there's more federal funding as well as state fundings for these smaller community-based initiatives. I think they're really going to start to make a difference.
All right, we certainly do hope so. Dr. James Simmons, always great to see you. Thanks. Coming up, former President Donald Trump is suing the CEOs of Facebook, Twitter, and Google. We've got all the details for you right after the break.
welcome back. Well, former President Donald Trump has announced that he is the lead class representative in a class action lawsuit that he is filing against the heads of the social media giants Facebook and Twitter. Here with more details is our senior columnist, Rick Newman. Rick, I almost have a smile on my face telling everyone that news. I need more details. I don't know who he's in a class with, who else has signed on for this lawsuit. So tell us a little bit more.
Well, first a disclaimer, INAL, I'm not a lawyer, but I can tell our audience that people who are lawyers are lampooning this lawsuit on the internet, on Twitter, and on other places. Trump obviously has a grievance against Twitter and Facebook, which have both banned him, Twitter permanently and Facebook for at least 2 years. And I think it's probably fair to say this lawsuit is not going to get real far. But look, what is Trump trying to do here? He's trying to get attention. I mean, he's had a hard time getting attention lately. He's actually out doing rallies again, but I don't think too many people are actually following those. And he's also using this to fundraise. I mean, some reporters have been quick to point out that Trump has already sent out fundraising appeals saying, I'm suing the evil Facebook and the evil Twitter, so send in some money now. So mostly, I think this is just a publicity stunt meant to keep Trump in the news.
So, Rick, I know that when he made the announcement during that press conference that he was going to sue the CEOs of these social media giants, he said it was going to be a class action lawsuit. How is that going to work? I mean, I know you need to be more than one to have a class action lawsuit. So any idea how that's going to happen?
I mean, it doesn't take a lot of effort to get people to join a class action lawsuit. Really, you just have to add your name to the list of plaintiffs and I guess give some reason why you're joining this lawsuit. But let's just go back to the basics here. I mean, it's very well established that no internet company, including Yahoo, for that matter, is required to publish the content of anybody who wants to use that platform. I mean, these companies have their own First Amendment rights to limit the content, especially if it's troublesome, if it's hate speech, or if it's problematic in some other way. And Facebook's board of advisors, this group of outside experts, has said that some of what Trump put there was, very problematic content. I mean, he arguably did try to get people to riot at the Capitol on January 6th, which worked. And even if he didn't, there's no requirement that these companies have to publish this content. So that's just one of several reasons where this is probably not going to go anywhere. But look, Trump is going to keep telling his fan base and these core Republican supporters that he's fighting on their behalf against the liberal media that wants to silence conservative voices. None of that is true, but that is how Trump is characterizing it and will continue to.
Now, this seems to me like a pretty interesting political strategy. I know that that Trump is essentially fundraising off of this, and he's done, you and I have talked about this a lot, he's done incredibly well in terms of his fundraising efforts at almost every single event or speech that he makes. I'm curious to know, however, because Republicans essentially blocked attempts that were made in Congress to investigate essentially what happened on January 6th with those riots at the Capitol. But with this lawsuit, wouldn't he then need to testify about the events on that day? And wouldn't this open up some kind of opportunity for folks to get that kind of investigation and get those details out there that essentially there had been attempts to essentially squash?
I suppose, there is going to be an investigation, a congressional investigation into what did happen on January 6th. It's just going to be a Democratic-led investigation rather than a bipartisan group. And I suppose that, yes, Trump could put himself in the position of having to testify because he was still posting on Facebook at the time, though not on Twitter. But that supposes that the lawsuit even gets that far, and I'm not entirely sure it's going to get that far, Kristen. I mean, some of the legal analysts have been pointing out that Facebook is based in California, and yet Trump filed the lawsuit in Florida, and probably you have to file it where Facebook is headquartered in order for this to be serious. Now, let's keep in mind, Florida did pass its own law that it calls for some penalties against internet companies if they silence, in quotes, conservative voices. So I think this is just about 95% spectacle and attention-getting effort, and perhaps 5% or less a serious legal effort.
Well, I mean, it definitely worked. You and I are talking about it, so
We've
definitely fallen into that trap of giving him more attention. Senior columnist Rick Newman, thanks so much for joining us.
You guys.
Coming up next after the break, it's our Funding Our Future segment. We'll be talking about oil and gas prices and how that could continue to weigh on your wallets. That's next.
It seems the economic recovery has another hurdle to clear: rising oil and gas prices. We've got crude oil now sitting at a 6-year high, and gas prices also on the rise. We have the average for a gallon of regular across the country at $3.13 or $3.14. That is about $1 higher than a year ago. Joining us to talk about it is Rick Edelman of Edelman Financial Engine. Rick, good to see you again. So let's talk about this rapid run-up we're seeing in gas prices and oil prices. It comes at a delicate time for the U.S. economy. We're already experiencing the fastest inflation in years. When do you think it starts to become a political headache for President Biden?
I think it already is. We just came out of the July 4th weekend where millions were on the road, first road trip since the pandemic, and they're experiencing those higher gas prices. We're going to see higher energy costs required this summer as the air conditioners are going to get cranked up with the heat. And then you're going to move into the winter with home heating oil prices if this is sustained. So I think it's already bubbling up as a political issue, and that's going to accelerate as months go on.
Rick, and I know we want to talk to you a lot about digital assets and cryptocurrencies, but I did want to quickly ask you, just because oil prices does impact inflation, and of course we've been seeing today some of those inflation fears largely being shaken off, especially as we see these movements in the bond market. However, as we see these oil prices continuing to spike, how much do you think this is going to remain an actual financial or economic pain point for folks, many of whom are still struggling right now to come out of this pandemic?
Yeah, it's the continuing tale of two cities. We have folks who are doing very well and those who are struggling, and those doing well are doing better and those struggling are doing worse. And what's fascinating to me is that when you look at how the investment community is reacting to higher oil prices, they're shrugging it off. Their attitude is no big deal. It seems that nothing can interfere with the bullish sentiment that Wall Street has. They're discounting all the risks that exist in the economy. They're taking an attitude that nothing's going to go wrong, that there will be no black swans, and that everything will continue to be wonderful. And I hope they're right, but the fact that prices are priced so euphorically without any downside factored in, it makes you wonder that if something does go wrong, or at what point will people change their attitudes, and will sentiment altering cause a change in pricing? This is definitely worthy of concern.
For sure. I want to spend some time, though, talking about these digital assets, because I know you have a sort of a philosophy when it comes to investing in cryptos who should be exposing themselves to that very risky sector. What are your thoughts, Rick?
It's becoming mainstream very, very quickly. We're not quite there yet, but it's a whole lot more than it was even a year ago. We're seeing institutions get involved. Governments are paying much closer attention to this. We're going to see more regulation and legislation, all of that very healthy. We're seeing mainstream Wall Street organizations getting involved. It ain't going away. And so it's very, very exciting in that regard. I think in the next few years, it'll be a routine part of most people's portfolios. So for now, you got to recognize it's still very speculative. It's still very risky. 1% portfolio allocation is plenty for most people. You don't need to invest a lot for it to have a material impact on your portfolio. And a mere 1% allocation, if something goes wrong, it won't harm you either. So I think it makes a lot of sense for people to spend time learning about this, understanding it. Forget about the get-rich-quick nonsense. Focus on this as a technology, an innovative one that's going to improve global commerce in an unprecedented way. And I think you can find a lot of opportunity for getting excited here.
So, Rick, we don't have any cryptocurrency ETFs as yet. So if you want exposure to this space, you essentially have to go out and buy each of these cryptocurrencies individually. And there's so many out there. I believe there's more than 5,000 cryptocurrencies. We had a chart just a moment ago of just a handful of them. Which ones do you think investors really should be paying the most attention to? Of course, we have the Bitcoin and Ethereum, but there's a lot that's been made about Dogecoin even recently. Which do you think essentially should get the most level of seriousness from investors?
Well, the two, as you pointed out, are Bitcoin and Ethereum. I would completely ignore Dogecoin. That is nothing more than a joke. It's a scam, and it's going to be something that ends very badly. But here's the really good news. There is no ETF out there, but there are other ways that you can invest in funds that allow you to delegate the job to a fund manager. These funds trade OTC. They are offered by Bitwise, Grayscale, and Osprey that allow you to invest either in specific coins, such as Bitcoin or Ethereum or Polkadot, or in a diversified fund, either in coins or in DeFi. So there are increasingly a wide variety of investment opportunities. In other words, the investment community is no longer waiting for the SEC to approve of an ETF. There are other ways you can engage. You don't have to wait for an ETF anymore.
All right, there you have it. Rick Edelman of Edelman Financial Engine, thanks so much for being with us. And a reminder that Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Coming up, Florida is no longer the best state to retire. We'll tell you which state came out on top right after this.
Welcome back. Well, if you are looking to retire, the Sunshine State should no longer be on top of your list. That's according to a new study from Bankrate. Georgia has beat out Florida as the best place to retire in the country for its affordability, culture, weather, and more. We're joined now by Jeff Ostrowski, an analyst with Bankrate. So, Jeff, typically we see Florida as the top spot for places to retire. Why did it slip in its rankings? What made Georgia the most desirable place to retire in the country?
Well, I will say it was a pretty close race. So the Florida and Georgia were neck and neck in our rankings. But in some ways, Florida has been a victim of its own success over the decades. So we really weighted affordability heavily in this index. And Florida is no longer super affordable, but Georgia is more affordable in comparison to Florida. So the median home price in the Atlanta metro area is about $279,000 now. And that's less than any of the metro areas in Florida, and it's less than the national average. So Georgia is really presenting a good value for home buyers. But the cost of living and the tax burden are fairly low in Georgia, and so that really propelled it to the top of our rankings this year.
Yeah, you mentioned the key word there, taxes, right, Jeff? I mean, when you think about retirement, you want to go to places where you have the lowest possible tax rate, which is a reason why Florida has been so popular for so many years. So I was surprised to see Massachusetts be the 5th best place to retire, according to your study. I don't think of Massachusetts as a low tax state. Tell us why it made the list and why so high up.
You're correct. So yes, Massachusetts is an unaffordable state. It's a comparatively high tax state. Massachusetts was really propelled into the top 5 based on our wellness ranking. And so that looks at things like public health, access to health care, food availability, economic security. And it's intriguing. As I was running these numbers, there was no one state that did well across the board in these categories, and there was no one state that really did poorly. And so the states with higher taxes and higher costs of living also tended to have better wellness rankings. So it's sort of a give and take. And there's, even though we rank these states from 1 to 50, there really was, no state that stood out as clearly the best choice or clearly the worst choice.
That said, there is still a bottom to this list. So take us through some of those worst states, so to speak, to retire, and what made them essentially clinch those last spots.
Well, Maryland repeated as the last place state in our ranking. It was brought down by a high cost of living, a low affordability reading, and then its other rankings just weren't really good enough to move it up in the pack. And speaking of taxes, I know I talked to a financial planner in Maryland who was lamenting that Maryland is one of the few states that imposes its own estate tax. So that might be a disincentive to some wealthier retirees from staying in Maryland. And in some ways, Maryland, like Florida, is sort of a victim of its own economic success. I mean, much of Maryland is in the DC area, which has been booming. Home prices have been soaring there over the decades. So, it's not necessarily a bad place to live in your working years, but it didn't do well on our retirement index.
I'm glad you said it, because there really is no one state that sort of checks all the boxes, I think, when it comes to the ideal retirement place. There's always sort of a give and take, right? Something that you're giving up for something you're going to be getting. But I'm wondering, when people are thinking about where to retire, what are some tips you can offer them? I mean, I would think you'd want to try out the place you're thinking about retiring in before you actually wind up moving there.
Right. And one caveat here is that this is a very subjective and personal decision. And so we're dumping this data into an index and trying to put some objectivity onto this decision, but it's still going to be a deeply personal decision. Where you retire is going to depend a lot on where your family lives, where your friends are, and what you like. I mean, in this index, we downgraded states with cooler temperatures and upgraded states with warmer climates. But if you hate hot weather and you like snow, then this index probably isn't going to going to apply to you and in your personal situation. But yes, one piece of advice that I heard from a number of retirement experts I talked to is go try out a state. Don't just move somewhere on a whim, but go live there. Maybe rent a place for 6 months or a year and get to know the area and see if you really like it before you commit to buying a retirement home.
You know, looking at some of the categories that you guys were scoring, essentially to rank some of these states, I do think of some of them as tied to sometimes the politics of the state. Now, I haven't done a full breakdown of this list, but I'm curious to know if there is a difference between Republican and Democratic states in terms of what's the best place to retire, or is it just a mixed bag right now out there?
I think it's a mixed bag. I mean, certainly we've, some people who are really strongly partisan are, moving to places where they can be with more like-minded people. I don't think most retirees are looking to see whether it's a red or a blue state that they're moving to. But of course, the blue tax states tend to have, the blue states tend to have higher tax burdens and higher costs of living. But it's a bit all over the board. I mean, Massachusetts, of course, is a blue state, and it made our top 5. So it's, the readings are kind of all over the place, but I don't think there's any clear political trend here.
All right, Jeff Ostrowski, bank rate analyst, thanks so much for breaking all of that down for us.
All right,
and coming up, Authentic Brands, parent company of Forever 21 and JCPenney, is eyeing its public debut. We'll be bringing you all the details on that next.
Some beaten down retail brands are getting a new lease on life in the public market. Authentic Brands, the owner of companies including JCPenney and Forever 21, has filed to go public. And Yahoo Finance's Sabeel Marcellus is here now with more. And Sabeel, they have lots of names we're all familiar with, over 30 retail brands.
That's right, Alexis, over 30 retail brands and big names like Forever 21, Nine West, Brooks Brothers. I mean, these are major brands that many of them struggled during the pandemic. So what Authentic Brands has been doing during the pandemic is scooping up all of these struggling retailers. So now they have this massive portfolio, and they filed the paperwork with the SEC, and they plan to go public. Now, we don't know yet for what amount, what the IPO price is going to be, or the exact valuation of the company, but they're working with major players. So the lead underwriters include JP Morgan Chase, Bank of America, and Goldman Sachs. Now, the plan is to have the stock trade under the name AUTH, A-U-T-H. And what we're seeing in terms of this company, so they have over 30 brands, including Sports Illustrated, as I mentioned, Brooks Brothers, Nine West, and also Marilyn Monroe, and they have all these licensing fees, also Sports Illustrated, and the majority of their revenue comes from those licensing fees. So it'll be really interesting to see how this company does if it successfully manages to go public. Now, Authentic Brands, in terms of how it's been doing, spreadsheet net income of $225 million in 2020 on total revenue of $489 million. So Alexis, it's going to be very interesting to see what's going to happen in terms of the shares they're going to be offering to the public. There's going to be two different classes of stock. There's going to be the Class A stock for the public offered to them. And then when it comes to the owner of Authentic Brands and their shareholders, they're going to have a different class of stock, Class B shares, because that gives them extra voting rights.
Yeah, I'll be curious to see what kind of demand this is met with, Sabeel, because we keep talking here about the death of the mall. Is it happening? JCPenney, of course, a big anchor store for lots of those malls. So definitely one we're going to look out for. Thanks for bringing us all the info on that pending IPO for Authentic Brands. Sabeel Marsalis there. All right, coming up at the top of the hour, the Fed is going to release the minutes from its most recent meeting. We're going to be sifting through that for clues about the Fed's thinking in terms of inflation, when it's going to start raising interest rates and taking its foot off the pedal here and start pulling back on those bond purchases. Yahoo Finance's Brian Chung is going to be along to break down that report for us. We'll also get market reaction the minute it comes out. Speaking of the market, let's get a look at the stocks right now, because we've been swinging between modest gains and losses all day. Right now, though, we're in the green. The Dow up 53, the S&P in record territory again, folks, on a gain of 13 points, and the NASDAQ inching up just about 2 points as we start to see more folks dip back into some of those big tech names. And taking a look at the Treasury market, which we've been talking a lot about the activity in the bond market lately, because what we had been seeing was fears of inflation pushing those bond yields higher. And now we've got the yield on both the 10-year and the 30-year sitting at their lowest levels since February. We're going to talk more about that. And again, break down those Fed minutes for you when Kristen and I come back right after this short break.
Welcome in to the next hour of coverage here on Yahoo Finance Live. I'm Kristen Myers here with my co-host Alexis Christoforous, and let's take a look at what's happening today. Now, the Fed is set to release the minutes from its June FOMC meeting in just a few minutes. Now, investors will be looking for even more clues as to the direction of monetary policy. We have Yahoo Finance's Brian Chung poring over those minutes and ready to break those down for us in just a couple of moments. Now, the Labor Department's JOLT survey on job openings showed the continued struggles in the labor market as job openings and hires did remain little changed in the month of May, although they did hit a record high. We'll be chatting more about what this could mean, along with a reaction to those Fed minutes with Morgan Stanley's Kathy Entwistle. And chip shortages continue to weigh on automakers, while a move from Toyota to stockpile chips actually helped the company sell more vehicles, beating out General Motors for the first time. Put us a quick look at the market action right now. You know, Alexis had just mentioned before the break how we've been seeing the NASDAQ essentially flirting with losses and gains all day. And as we can see there, it has flipped into the red, down over 6 points right now. S&P 500, however, still right in that record territory, with the Dow up about 45 points right now. Taking a quick look on a sector basis, only two sectors right now are in the red, and that's energy and communication services. Energy down over 1.5% right now, while on the flip side, industrials and materials continue to do well. Materials up right now about 0.9 percentage point. And of course, we have to take a look over at that 10-year bond yields, as we've been seeing those yields essentially sinking as those inflation fears have pretty much disappeared, and has bounced off of its lows that we had seen a little bit earlier in the session when it had fallen to 1.31%. As you can see there, it's now sitting at roughly 1.32% right now, down about 3.5%. But let's go over to our Yahoo Finance's Jared Blickery for a look at what's trending right now in the markets. Hi, Jared.
Hi there. Well, you know, it's all been about the bonds recently and the mega caps, and we'll get to those in a second. I just wanted to show the Wi-Fi Interactive, the market reaction to those FOMC minutes. We'll get some more color from Brian Chung in just a couple minutes. As you can see here, almost no reaction whatsoever. So let's move on to the bond market, where we've been seeing things really heat up in the 10-year and also the 30-year. So I'm going to broaden this out to a 3-month look. And you can see over the last 2 days, we've sunk about 11, 12 basis points at the max, peak to valley here after we broke through this support level. And this has been fueling the mega cap trade. And you need to look no farther than inside the NASDAQ 100. I'm going to put this on a 2-day view so we can really highlight some of these changes here. Now we have Apple, Alphabet, Amazon, and Microsoft. That's all these guys right here set for record closing highs. Going to be the first one for Apple in quite some time. Facebook not that far off, although it is down 1% today. You take a look at some of the losers here. We got some big ones. Tesla, that's a mega cap too. It's down 4.5%. Some chip stocks like AMD down 3%. But for the most part, we've seen the NASDAQ hitting new highs fueled by these mega caps. That means not a lot of participation recently in the NASDAQ, and that is something to keep an eye on, guys.
All right, I'm looking at our trending ticker page right now, and the number one slot belongs to Newegg Commerce, up 116%. Dare I say, Jared, that it is the Reddit crowd at work again? Is this another meme stock?
Yeah, and there is a fundamental case too. There's a lot of excitement about their PC, I guess I'd call them bespoke PCs to go. Supposed to be done in record time. I'm going to check out the service myself. But here on the Wi-Fi Interactive, yes, Newegg Commerce is up 116%, 1,300% year to date. A lot of that just in the past 7 days. You can see up over 400% in that time period. Not a lot to comment on there, but just a very impressive move. I guess we'll also say that AMC and GameStop in the red for 8% and 5% today, respectively.
All right, Jared, let's move from a meme stock to well, this is not a meme stock, and it's the Yahoo Finance Plus investment idea of the day, and it's on Domino's Pizza. What's behind that bullish call?
Well, this is a bullish call by Argus Research based on some of the latest trends, and they're delving into e-commerce. And no, this is not a meme stock. You know why? $476. We got to get that down to $4.76. Not saying I want that to happen, but yeah, whatever. All right, so let's take a look at what Argus Research is writing about Domino's. And by the way, you can see they're up 24% over the last 3 months. That's a very nice trend that we see. And they're raising their price target to $540 and increasing some of their estimates. So they go over the results from their last earnings report. And then they say Domino's has been spending aggressively on its e-commerce platform, and online sales now account for more than 70% of U.S. revenue. Argus expects the company's carryout and delivery business to continue to benefit from the popularity of online ordering. They're raising their 2021 estimate, and they're saying that the stock appears favorably valued at 31.5 times our revised 2022, when we expect a full year of recovery in the restaurant industry, that EP estimate, and it's below the industry average of 32. Guys?
All right. Thanks so much, Jared. We'll see you at the half hour for a look at those energy markets. Let's turn now to Yahoo Finance's Brian Chung. He's been looking at all of those Fed minutes. Brian, what have you been able to pull out just over the last 5 or 6 minutes or so?
Yeah, not a lot of time at all for what was a particularly meaty and substantive June FOMC meeting. We have to remember that these minutes cover a meeting and a decision from the Fed that was 3 weeks ago. So many things have changed since that point in time. But of course, all eyes on the taper talk discussion. Again, prior to that meeting, the Federal Reserve had been saying it wasn't thinking about tapering its asset purchases or raising interest rates. But we did hear from Jay Powell 3 weeks ago saying that they had kicked off those discussions in that last meeting, even though they're not yet announcing any sort of timeline on paring back its $120 billion apace each month of asset purchases. So let's take a look at where they saw the employment and inflation situation. So the minutes noting that job gains, which at the time covered the months of April and May, they didn't have the June jobs report at the time, were, quote, strong, but weaker than they had expected. So that shows some of the, waning optimism, as the Federal Reserve earlier in the spring had been hoping for something closer to 1 million a month in terms of the pace of job gains. We were getting something closer to 400,000 in the months of April and May. On the inflation front, a lot of people concerned about whether or not these temporary inflationary increases could be more permanent. The minutes noting, quote, participants generally expected inflation to ease as the effect of these transitory factors dissipated, but several participants remarked that they anticipated that supply chain limitations and input shortages would put upward pressure on prices into next year. Translation, yes, it could be transitory, some of these pressures that we've seen on PCE and CPI, but don't expect those to get alleviated in the next year. We could continue to see high readings into 2022, but that doesn't mean it's not transitory. It could still fade away after that point. So it shows most Fed officials not necessarily too worried about inflation running away, at least right now. Now, of course, the question is, what about tapering? Now, the minutes note that the committee standard of substantial further progress, this is kind of the bright line test that the Fed set for itself on asset purchases, was, quote, generally seen as not having yet been met, though participants expected progress to continue. And then an interesting bit, there were a number of Fed officials that appeared to already argue that they need to watch out for any bumps around the side of the bend. Quote, participants generally judge that as a matter of prudent planning, it was important to be well positioned to reduce the pace of asset purchases if appropriate in response to unexpected economic developments, which they later cited as maybe faster than expected growth on GDP, employment, inflation, what have you. And then one last thing I want to point out, because I've been ranting a bit here, guys, but mortgage-backed securities, as they talk about the nuances of how to taper that, there's been some discussion that, well, the mortgage market has been particularly hot. The housing market doesn't need the help. Why is the Fed buying mortgage-backed securities? That debate apparently kicked off in that last meeting. Quote, several participants saw benefits to reducing the pace of these purchases more quickly or earlier than the Treasury purchases, which is the other side of its asset purchases. But there was another contingent of the FOMC that was saying maybe you should reduce the Treasuries and the mortgage-backed securities at the same rate. So that seems like a debate that could be heating up in the next few months. But again, no necessary announcement from that meeting. And then the dot plot projection, that's not something that's part of the discussions in these meetings. So we don't have any sort of detail on how some of these Fed officials project interest rate hikes in the future. But I think that in a nutshell kind of describes what we saw from the minutes. Of course, the next meeting is going to be in July, in which case we'll have an update on where Fed policy may be at that point, guys.
All right. Thanks so much, Brian Chung, for again pouring into that incredibly quickly and being able to pull out all of that very important data points. And of course, everyone should check out yahoofinance.com. I know Brian's going to have a nice, lengthy write-up for everyone to take a look at. All right, let's continue this conversation. We're joined now by Kathy Entwistle, Managing Director at Morgan Stanley. So, Kathy, let's just start on the back of what Brian was just talking about. Let's get some of your reactions to what we had heard from some of those Fed minutes. Of course, again, thinking about tapering, obviously that coming up in conversation. What are some of your thoughts? Oh, Kathy, you're actually muted.
I'm so sorry. Thanks, Kristen, for having me. And I was going to say, yes, that was a lot that Brian just gave to us in a very short period of time. So super impressive with the recap of that information. It's pretty much, some of it is really lined up with what Morgan Stanley has been saying in terms of, we've got like employment numbers maybe not coming up as high as we would have expected. And a lot of that has to do with the stimulus checks that went out, the benefits that people are being offered, just people just taking their time coming back to work. We're just not seeing that mad race to, get back into the office or get fully employed again. So that's not that surprising right now. And also, I would say the whole inflation, reflation conversation, we think that, yes, there is some transitory things going on and transitional that might take a little while to work through, like supply chain, but we also think that there's a longer time view here. So very much in line with what was just reported, but maybe also even a little bit more cautionary than that.
And Kathy, what are you reading in the tea leaves of the bond market right now, with yields on both the 10-year and 30-year sitting at their lowest level in about 5 or 6 months? We saw those yields spike when inflation was top of mind. It seems like that's abated, at least for now. So what do you think the message is here from the bond market?
Well, that's a great question, Alexis. I think that there's a lot to think about here, but the bottom line is interest rates will go up, and you don't want to be caught long holding long bonds at this point. So we're suggesting to clients to keep income like interest rate products very short, or investments very short right now, in anticipation of some changes there.
So then what are you anticipating, throughout the second half of the year? How should investors really start positioning themselves going forward?
That also a great question. I think you really have to look at where the opportunities are. And I do think that we've had a little bit of a pause this summer in the mid-cycle rotation, and we have jumped back into more of the growth stocks. If we start to see interest rates become more of an issue, we'll see a pullback there as well. So we're still pretty keen on the mid-cycle view. We think you can be in equities. There's some that we're overweighting, some that we're underweighting right now. We like financials, we like materials, and we like healthcare. We also look to outside of the US for some opportunities. So that would be international, particularly emerging markets, to consider having a sleeve of that in the portfolio as well. It's really about being thoughtful about which companies are going to be able to continue to grow going forward. And a lot of them are going to be, they're very optimistic right now. A lot of the CEOs are very optimistic about their earnings and the numbers that have come in and their balance sheets. But as wages go up, as prices go up, there's going to be some hit to the profit. So we just want to be more mindful about selecting the companies that we think that will do well in those sectors that we particularly like.
Are the small caps among those sectors, Kathy? Because I'm wondering if there's much more of a runway left. We saw the Russell 2000 index really skyrocket over the past few months, outperforming a lot of the other indexes. I think it's up something like 51% since September. Do you think that it's going to continue to move higher, given the backdrop, given that inflation perhaps really is going to be transitory and that the economic recovery is full steam ahead?
Well, basically, the way we look at it is this. We want clients invested in all the different areas of the market. We want them diversified. It's just a matter of how much do we want them to be in there. Morgan Stanley called small caps as an opportunity right after the pandemic, spring of 2020. And that came to be proven to be quite an opportunity. We do still want clients invested in small cap areas because just like we saw the growth stocks as of recent made a big jump, which might not have been as expected. So you've got to have exposure everywhere. It's a matter of looking for the opportunities of where we think we're going and positioning for that opportunity. So small caps, I would have exposure, but not a lot of exposure. We've had quite a run.
So Kathy, I'm looking at the market reaction right now. And of course, some folks might not be as fast as our Brian Chung, at least in terms of parsing out some of that data from those Fed minutes. However, like I said, not too much of a reaction right now, at least in the three major indices. I'm curious to know what you think is going to be the next catalyst really to the upside for investors.
The issue is going to be whether or not the Fed stays on track for expectations of making changes, tapering slowly, making changes slowly. I think that if there's any knee-jerk reaction, we're going to see the same knee-jerk reaction in the markets. You go back to last year with the economy falling apart and the very quick and severe support that the Fed offered to the economy. We want to see, instead of that quick and severe, we want it to be slow and steady and very methodical as they unwind so that our clients are well prepared for being positioned for that. So the opportunities, I think long-term, you always want to have the growth and the dividend paying companies in your portfolio. But I also think that right now, international and emerging markets probably offer a little bit more opportunity than the US at the moment.
All right, Kathy Entwistle, Managing Director at Morgan Stanley. Thanks as always for joining us. And coming up, Toyota's chip stockpile has helped them sell more vehicles, topping GM for the first time. We'll be discussing that next.
Welcome back to Yahoo Finance Live. The global computer chip shortage has cost the auto industry billions of dollars in lost revenue, but some smart planning by Toyota helped the Japanese automaker come out on top in the second quarter, beating GM for the very first time when it comes to U.S. sales. Joining us now is Jeff Schuster. He is the president of America's Operations and Global Vehicle Forecasts at LMC Automotive. Jeff, it's good to have you here. Before we talk about Toyota specifically, just paint the broader picture for us. How has the computer chip shortage started to impact auto sales here in the U.S.?
Well, thanks for having me. No question about it. We started to see the impact last month. We had been running really hot. The industry was on pace really for a record year. If we look back, March, April, and even May was above a 17 million unit selling rate. We saw that dip to around 15.4 million units last month. So certainly saw the industry take a breather from the recovery that it was on, and that is solely to do with the chip shortage, which has caused inventory on dealers' lots to be extremely lean, if existent at all.
So I think that the next question is, how long do you anticipate these shortages continuing?
It's something that we think is getting close to peaking in terms of the problems at production facilities. However, we've lost about 1 million units in the North American market already as far as production goes, and about 3 million units globally in production. And we don't anticipate much of that getting made up. In fact, right now, about 750,000 units is all we expect to get back. So really what that means is the problem we're facing right now for the industry and inventory shortages specifically to the U.S. market, it's going to be with us well into 2022, at least through the first half, and it may even spill into the second half before we see what we consider normal inventory levels for dealers.
So let's talk a little bit about Toyota here. I mean, talk about foresight. They stockpiled the chips, Jeff. Do they normally do this? It's just sort of par for the course for Toyota, or did they know something perhaps the rest of the industry didn't know, and so they started to stockpile?
I don't know if it's necessarily normal. I think different companies clearly have been affected differently across the globe. Toyota is sitting in a very strong position from a chip standpoint and from a disruption in their production, both here in North America, but also in Japan and abroad. In fact, they've had very little shortages or very little losses due to shortages of chips. They've had some other disruptions here in North America, but very, very little. So that position and that decision that they made to stockpile chips, or maybe had an early indication through their strong supply chain network that they've established in Japan, maybe gave them that early indicator. Others, have fared in between. Toyota and the at least in North America, the one that's been impacted the most has been Ford. Launching the new F-150 has been a challenge for Ford.
So Toyota seemed to really paint this off as a one-off, essentially topping GM in terms of those sales. However, I know that you're saying that chip shortage has hit a peak, but is going to continue for some time. Do you think that perhaps it's not actually a one-off, and those chip shortage woes are going to continue to weigh on GM, especially as they try to go up against some of these other automakers and folks that are out there buying cars have to turn to competitors in order to get some of these cars?
Yeah, I mean, it certainly is going to be impacting all automakers to some degree going forward. GM actually is in a fairly strong position. They have restarted all but one factory here in North America. So their disruptions, I think, are at least the majority of them are behind. I think we're going to see likely some sporadic plants that are going to have to be taken offline temporarily for shortages like that. There's other materials that could become short as well. So again, I think it's going to be something that'll have to be managed on a daily, if not hourly basis going forward. And it's going to take some time to rebuild that inventory. So yeah, certainly. We may see this happen again in a month, but GM is in a fairly strong position going forward now that their plants have restarted.
And Jeff, in about 30 seconds here, would love your take on the effect high gas prices might have on some of these gas guzzling cars, like an F-150 pickup, which seems to do well regardless of gas prices. But we've got now gas at its highest level in years. Experts are saying it will probably go up a little bit more from where it is now towards the end of the summer. What's the impact, do you think, on auto sales?
Yeah, I think historically speaking, when we go back to 2008, we saw gas prices, $4.50 a gallon. That's when we saw a major impact to larger vehicles. But I think a key point back then is we had an array of small cars that were available that just aren't around any longer. So the likelihood of going back down and shifting down to small compact cars is small, but I think we could and likely would see a shift to smaller SUVs or crossover utility vehicles. So in other words, the larger vehicles in favor of something in the midsize or even smaller SUV arena. That's likely a shift that we could see take place. The other area that it could reignite interest in, and it's something that's been getting a lot of attention as well, as electrified or electric vehicles. So better electric vehicles are certainly on the rise. We're seeing a lot more available products, and this could jumpstart that as well.
We're seeing more of those charging stations too. All right, Jeff Schuster of LMC Automotive, thanks so much for being with us. And coming up next, we're going to hear from Nextdoor's CEO, Sarah Friar. She is the CEO of that social network company that's going to be going public soon. We're back right after this.
Welcome back. Yahoo Finance talked with Sarah Friar, CEO of the hyper-local social network company Nextdoor, about the company going public in a more than $4 billion SPAC, as well as their bump up in valuation. Take a listen.
We're in hyper growth mode. We saw phenomenal growth in 2020. Our DAO, our daily active users, grew 50% year over year. And as you noted, we've now reached 1 in 3 households in the United States. And of course, we're global. So we're in 11 countries around the world, 276,000 neighborhoods. And in countries like the UK, for example, we're seeing that same build happen. Today, we're in about 1 in 6 households, and actually a little bit under 1 in 5 in London. So with that scale brings monetization, brings a great business model. And so the valuation has risen commensuratively.
And, Sarah, I'm curious how you guys, and you outlined it a little bit in the presentation, where you see yourself sitting with respect to competitors. I'm looking at the graph here where you have, you're comparing the use, the frequency of use that Nextdoor has to Instagram and Twitter and Spotify, Weather Channel, so on and so forth. What I don't see on there, which is where my mind went, was, your Angie's List type home, referral services. How do you think about the opportunity that you guys have there, relative to the opportunity you have against some of these social networks that, again, are a little more prominent in the presentation?
Yeah, I mean, for sure, we are a local network, a community network. And so that is why we do have as a comparison set a lot of the companies that you mentioned, where we excel, number one, in retention. So our 3-month all the way to 2-year retention is head and shoulders above those peers. We're best in class. I think the second thing that we bring is a really unique audience. So we do show a chart in the presentation that shows that people who are coming to Nextdoor aren't visiting a lot of the other social media sites. So for advertisers, that unique audience is a way to get their message to people they can't reach any other way. But to your point, we are building overall a marketplace as well, right? We have aggregated all of these neighbors and neighborhoods around the world. They come to Nextdoor for utility and they come for community. But on the utility side, often it's to find the best plumber in that moment, right, where you have a leaky faucet. Maybe it's to find the best cup of coffee because you've just moved into your new house and you're getting to know your neighborhood. So of course, that allows us to really speak to those local businesses. We've done a lot of investment in the last 2 years in building out a business platform, an ad platform for them. It's been incredibly successful, as you can see from our revenue growth rate. And so that does start to bring us into the zone of folks like Angie's List, Thumbtack, who are actually our customers because they come to Nextdoor to be able to put in front of our neighbors those pros that they have aggregated as well. So sometimes it's a first-party return. So a neighbor gives you that recommendation you really need. And then sometimes it's coming from a great customer of ours that can also help you get to that pro in your moment of need.
And you guys also talk about the TAM for the business has almost doubled globally. You see it doubling over the next couple of years. And I'm just curious how much maybe COVID-related mobility trends are driving that, or is it more just Facebook and Google clearly have a chokehold on the digital ad market, but with the growing market, there thus, it follows then that there is a larger opportunity for additional competitors if they can gain a toehold.
Yeah, so there's 2 ways we define TAM. There's the TAM just first of all of neighbors coming to the platform. And what we see there is Nextdoor has an inherent network effect, a true network effect, right? When you join the neighborhood just got better for everyone else on the network. And so we know that when we start in a younger neighborhood, we'll see good engagement. But when we get up into our top quartile neighborhoods, we see an over 2x improvement in engagement. And so what that's doing is driving the TAM of neighbors who can come to the platform. So there's really good growth there. And of course, international only further bolsters that. And then what you're getting to is the digital ad market. So there's not an advertiser that I speak to that isn't moving their spend online, right? Print, TV, just getting harder. With digital, you can really target your customer. And so Nextdoor is part of that shift to digital. Where we are unique is we are hyper local targeting. So whether you're the local mom and pop coffee shop or whether you're the largest retailers in the world, folks like Walmart, we can make sure that you're getting your message into the neighborhood and often in a really hyper local way.
And that full interview can be watched on yahoofinance.com. Coming up next, it's a look at the energy markets plus our ETF report. That's all on the other side of the break.
Welcome back. Time for a look at the oil markets now. Jared Blickery here. And Jared, crude has gone on a wild ride. We saw a huge pullback recently after it rallied to a 6-year high. What's going on there?
Yeah, it's all about that OPEC Plus meeting, and we still don't really have any news if it's going to reconvene, what the decision is going to be. Going back to last Thursday, we know that the UAE pulled out of the discussions. They want to pump more oil. They didn't want to extend the agreement beyond April of next year and also not increase their pumping. So the bottom line is we're kind of at a stalemate. And you look at the energy sector on the Wi-Fi Interactive over the last 2 days, you're going to see a lot of dark red. There are Exxon's off 4%, British Petroleum nearly 5%, Occidental Petroleum, one of the bigger losers, that's down 9%, but still up 71% year to date. Those high oil prices still holding well above $70 per barrel, really fueling that. Now here's WTI crude over the last 2 months, and you can see these two big candles over the last days. Those really stick out this week compared to some of the price action we saw before. Down about 5% for the week. That's going to be the worst week since March or May, I believe, but still, we're only talking about a very small decline from the recent highs. In fact, given the volatility that we've seen in the oil market before, especially when talks fell apart last March, this is very small by comparison. So we'll keep an eye on the situation. Yes, we're seeing increased volatility, but guess what? Nobody's crying over lower gasoline prices. Those are down about 2% off those highs, guys.
And I'll take it, Jared. I think we all will. All right, Jared Blickery, thanks a lot. Time now to turn our attention to the ETF market and our ETF report brought to you by Invesco QQQ. I want to bring in Todd Rosenbluth, now head of ETF and mutual fund research at CFRA. Todd, always good to see you. So from what I understand, net inflows are sort of off the charts. We're in for a record year for ETFs and also for the bond ETFs. Talk to me a little bit about the interest you're seeing in that area.
Sure. So we hit a record year for fixed income ETFs in 2020. We had a record year overall for ETFs in 2020, and we're likely to blow away that overall record by the end of July. We're almost at $500 billion of net inflows already, and that was the mark. Just so for the of net inflows are slightly above that for fixed income ETFs in 2021. Investor adoption towards ETFs has really been through seeing this build up as the pace continues.
Todd, I do want to ask about continuing that question about those bond ETFs. Now, as you were just talking about, they've done incredibly well in 2021. Do you see them really taking off now and really staying that way with all of that strength, given now that we have these inflation fears subsiding and also some of the valuations that we've seen over in equities?
So yeah, investors are likely to rotate into fixed income from more of a defensive posture as we get more volatility in the markets during the third quarter. We've seen Treasury ETFs start to pop up in the month of July from the strong interest as interest rates have pulled back. We think investors are going to be rotating from equity to fixed income during out of ETF as they might have normally done in the past.
So Todd, I know that dividend ETFs were relatively popular in the first half of the year, and I'm wondering if investors are still putting their money to work there in the same way.
Yeah, that's areas of strength. It surprised us when we looked at the numbers from the CFRA data because, of course, they're suspended or cut during 2020, but we saw strong interest in dividend-oriented ETFs, in part the ones that did very well. So dividend ETFs tend to have more of a value tilt, more exposure to financials and energy market because those tend to be higher yielding. And so, you know, the Invesco S&P dividend revenue ETF is one of the more popular ones that we at CFRA belong. Schwab's dividend is another one, SCHD, and we also like the a range of different ETFs. We like Vanguard's offerings, offerings. We think there's a lot of strong choices that investors have if they look forward based on dividend strength. The S&P dividend ETF is another one that I see you're showing on the screen.
All right, we're going to leave it there. Todd Rosenbluth of CFRA, thanks for being with us. And stay with us, more to come right after this.
Welcome back. Let's talk now about what our next guest calls the pandemic paradox as the labor market, where we find labor shortages amid a large amount of people that are still unemployed and companies very much willing to hire. We're joined now by Gary Schlossberg, Wells Fargo's global strategist. So Gary, I do want to start on that pandemic paradox. I'm curious to know how you explain, so many of these labor shortages that we're seeing, considering that we still have so many folks that are unemployed.
Well, I think a lot of it just has to do with the nature of the economic cycle. We're right in the midst of what we would call very much a V-shaped economic cycle. This a direct byproduct of the pandemic, massive layoffs over a year ago, and then followed by a very strong bounce back in the economy. That created inevitable dislocations, people leaving their jobs in search of jobs in other industries, getting settled in, very difficult for those frontline industries hit hardest by the pandemic to pick up the pieces as demand recovered. On top of that, in a very dynamic labor market with very high turnover, you do get people voluntarily quitting, moving to positions where the pay might be higher, the working conditions better. All this kind of churn creates shortages in the midst of plenty. And it will take some time, we think, for these dislocations to unwind.
Yeah, Gary, I think what you just said played out in the JOLTS report today. We saw job openings in the U.S. Inch up in May, but hiring actually dipped. When do you think the labor shortages, though, might actually start to trip up the economic recovery?
Well, we're hoping that we will see that transition during the latter part of the year. It may slow growth at the margin Fortunately, we have the reopening of the economy, a tailwind there. We are hiring. There are shortages. So it's really less apparent on economic growth. Certainly growth would be a bit higher had we had businesses been able to hire at the rate they'd like. But with the reopening, the strength and demand from drawing down high savings, the wealth that's created from the stock market, we do expect to see growth slowing, but still at a rate well above average. But that, in part, because of that very strong economic growth, that will keep the labor market under some strain right through the end of the year.
Now we're starting to see, a lot of employees demanding better pay and other benefits like flexibility to work from home. And while turnover has always existed in the labor market, we have seen a higher rate of turnover lately. How long do you see that continuing, especially as so many folks have said, listen, the summer months, we're going to be seeing these peak levels of folks getting hired?
Well, we should see noticeable relief. We're hoping to see noticeable relief after September. A couple of things happen then. You have the child care issue, many people staying home to watch children. Hopefully the schools will be reopening in greater numbers then. Some of the enhanced unemployment insurance benefits already are coming off in some states, but they will come off more noticeably in early September. So that issue as a lure to keep people out of the labor market should dissipate as well. And we're hoping as well that the concern about vaccinations, concern about the coronavirus will continue to dissipate as well. So a couple of things coming together that hopefully will increase the supply of labor during the closing months of the year. But still some tightness in the market, and we expect to see that persist well into 2022. This is going to be a fairly gradual process, an unwinding. Keep in mind that many of us are expecting to see growth moderate over the course of next year. So that will take some of the pressure off the labor markets as well, if not sooner than that.
What about in terms of wages? Which industries have, seen the biggest jump in wages during the pandemic? I mean, there was talk that perhaps it was some of the lower paid workers in the service and hospitality industry, because there was such a shortage there that those companies had to raise wages in order to entice people to come in.
Well, it was focused on those frontline industries, leisure, hospitality, the entertainment industries, other services industries initially. It is becoming a bit more pervasive now. We are seeing wage pressures permeate the labor market to a greater extent now. We do view that as temporary. It just depends on how you view temporary. Ultimately, though, we think that as these dislocations begin to ease over the course of next year, you will see wage pressures dissipating more noticeably. But at the moment, they're a direct outgrowth of the labor shortages. If anything, they become more widespread and deepening a bit as these labor shortages persist. I might add that in today's JOLTS report, we were beginning to see early evidence of a peaking of these shortages. We're not there yet, but the increase in openings smaller than what we've seen over the past 6 months, and the decline in hiring not quite as great as what we expected. In other words, the gap between job openings and actual hiring, it continued to increase, but not at the same rate. So hopefully we're approaching that peak, and conditions will improve as we move through 2021 and into 2022.
Gary, any of the scarring that we're seeing from the pandemic on the labor market, do you see any of it as being permanent? What permanent changes do you think are being made to this labor market going forward?
Well, I think the most obvious that we're monitoring at the moment, the number of retired workers. By some estimates, I think the Dallas Federal Reserve estimated that something like 2.6 million workers retired during the pandemic, about 1.5 million more than what we would normally expect to see during an economic cycle. And the loss of those workers, and I might add, the odds that they stay on the sidelines is that much greater than it was during the last economic cycle, because household finances are in far better shape this time around. The run-up in the stock market, rising home values, really created a contrast, I think, to the situation after the global financial crisis about 10 or 11 years ago. So these workers are likely to remain more inclined to remain on the sidelines. You get a double-barrel effect on wages. For one thing, you lose that supply of labor, but then secondly, these workers tend to be a bit more productive. Absenteeism tends to be lower. Because you lose that productivity, that could add to the pressure on what we call unit labor costs for businesses as well. Not an overriding factor, but one of the more apparent impacts, we think, of the pandemic. The other is the ongoing issue of a skills mismatch between the strong demand for skilled workers and the added supply, surplus, if you will, of unskilled workers. That was an issue even before the pandemic. It seems to have been accentuated after during the pandemic, and we expect to see that issue linger on to a greater extent as we move through 2021 and into the new year.
All right, Gary Schlossberg, Wells Fargo Global Strategist, thanks so much for joining us today. And coming up, why have there been so many ransomware attacks lately? Well, we've got our tech editor, Dan Howley, here with all of the details as to why.
The rampant growth of ransomware attacks, both here and abroad, has become a national security concern, with the Biden administration now vowing to take action against cyber criminals. But what is driving this surge in ransomware attacks? Our tech editor, Dan Howley, here now to fill us in. Dan?
That's right, Alexis. We're seeing a huge increase in ransomware attacks, not just the attacks themselves, but the different types of targets, as well as how much they're asking in ransom. So I spoke to a few experts who provided some information on why we're seeing this. The most recent is obviously the Cassia attack. That in that attack, REvil, R-Evil, the same people that were provided the software that allowed for the ransom attack on JBS, that meat producer, attacked Cassia, and now we're seeing $70 million being requested in ransomware. And so the reason why we're seeing this kind of growth is two things. One is the proliferation of cryptocurrencies and the ability for that to provide criminals with some kind of cloak as to where and when deposits are being made and transactions are being made. So that allows them to more easily request or demand, rather, ransom. The other is companies paying ransom. So we know that the Colonial Pipeline hack, that was paid. The ransom there was paid. The JBS ransom was also paid. We've seen hospital systems, governments across the world pay up for these types of ransom. And that just emboldens the cyber criminals to go ahead and try for ever larger targets and ask for ever larger ransom. So until the two issues kind of come together or are somehow worked through, we're going to continue to see these kinds of ransomware attacks. Outside of that, the only way that companies can protect themselves is to update to the latest patches. But in some instances, there are issues that companies don't even know exist called zero-day attacks. And those are where hackers know of an issue. Companies don't, and they are able to exploit it until they're able to come up with something to repair it. But this is something that's going to continue onward into the future unless some kind of action is taken by the government.
All right, Dan Howley, thanks so much. We appreciate it. And more Yahoo Finance Live to come right after this.
Markets react to those Fed minutes released an hour ago, but investors have been sending a signal regarding inflation that indicates the fear of those drastic price increases. That fear may be falling. We will explore the dramatic drop in the yield on the 10-year bond, as well as where markets go from here with Julie Beal, a portfolio manager at Kayne Anderson Rudnick. Then we get the latest on Bitcoin and other crypto assets. From CoinDesk's Ollie Leach, he's going to talk about Bitcoin and its continued rise back above 34 grand, as well as Goldman Sachs' call that Ethereum could become the preferred store of value over Bitcoin. And then we will jump into the used car market with the CEO from the publicly traded ACV Auctions, which helps dealers score the wheels Americans so eager and desperate to buy. Before you gas up, though, we're going to speak with the CEO from King Operating Corporation, which helps people invest in oil. We're an hour from the closing bell, live from Studio 5N. This really is a studio apartment. I'm Adam Shapiro.
And I am Shauna Smith. Adam, let's take a look at the market action here with 60 minutes to go in the trading day. You're looking at a bit of a mixed picture. Actually, look at that. The NASDAQ is now turning positive. That just happened within the last couple of seconds. We have all three of the major averages now in the green. The Dow up 82 points. S&P actually hitting an intraday record. That came after the Fed minutes were released just a few hours ago. Industrials, materials, and technology leading the way. But let's kick things off with Jared Blickery. And Jared, I guess, what are you watching here in the final hour of trading? Because we're seeing the S&P not too far from that intraday record high that we saw earlier this afternoon.
I'm watching Newegg. That's where the action is today. We can go over the indices first. So let's take a look at the Wi-Fi Interactive at what really didn't happen at 2 p.m. A pretty muted market reaction here. We are close to session highs. S&P 500 was able to drift a little bit higher here. And NASDAQ Composite off from its highs in the morning here. But the action has been in the bond market today. So that's where we're going to look right now. This is a 2-month look. We've been talking about this fall from grace here, or at least fall from a support level. We hit 1.30%. Haven't seen that since February. Could go lower. 1.25% has a better price action. And also, if you take a 2-year look, we kind of spiked up there a little bit ago. So we're going to be watching the bond market as well. US dollar index not doing too much. Here's a year-to-date look. And you can see just kind of climbing to multi-month highs, but very slowly. And finally, we got to take a look at the mega caps here because those have been outperforming. I like to look at this 2-day view. Apple up 3%, set for a record close. Amazon, Microsoft, Alphabet also set for record close, guys. And then finally, here's the sector action. We got and tech, interesting leadership at the top, energy and financials at the bottom. Look at this. One of the worst days for energy in quite some time, down almost 4.5%.
All right, Jared Blickery, we appreciate that. We're going to keep talking about what's going on with these markets and also how they're reacting to those minutes that were released regarding the last Fed meeting. And we're going to do that with Julie Beal. We invite her into the stream. Julie is portfolio manager at Kayne Anderson Rudnick. Good to have you here. I just want to let you know, one of the takeaways from the minutes that we learned is that the Fed officials may begin their tapering of asset purchases much sooner than they expected. And now there's this debate. Will they roll back on mortgage-backed securities before they roll back on the purchase of treasuries? As investors, what does it mean to us, and which would be a bigger impact on us?
Well, I think if you look at the data, the housing market is so strong. And I think there's a lot of reasoning and support for trimming back mortgage-backed securities first over treasuries. If you look at the dissent within the minutes, it looks like they're pretty evenly split on which one they're going to do first. I would be inclined towards mortgage-backed securities. I just think it makes sense given how hot the housing market is. But overall, I think it's just a good sign because it indicates that they are looking at the data in the same way that investors are, who have been very concerned about inflation. And the goal is to not have to taper all at once.
Julie, the movement that we're seeing today, though, really defies, I think, what a lot of investors had anticipated maybe that we would see when we got something like this. We have big tech now back in favor once again. We've seen a bit of an outperformance from some of those names over the past month. We had the 10-year yield, which Jared was just mentioning, at 1.3%. I guess help us understand, I guess, what's going on when you take a look at some of those big growth names, and then also the action that we're seeing in the bond market today.
Well, I would guess on the tech side, with interest rates as low as they are, that supports a lot of the very sky-high valuations we've seen across technology. And, that has been the gating factor
in the first half of this year in terms of, their ability to grow from the high price appreciation they reached last year. So it's not surprising to me that as we've seen a retreat in interest rates that you see tech valuations expanding. I think that makes sense. And I think it also makes sense that if there is some concern about how the Delta variant is going to go through the economy, that people are flying to a little bit more of the quality tech names. So I think that makes sense. On the bond market side, I think it's just a function of you're seeing what expectations are telling you in terms of, is inflation going to be as hot as we think it is? Is it transitory? And is the Fed going to be able to control it?
Well, along those lines, when you share with your clients, they should pay attention to Old Dominion or Fair Isaac Corporation as a way to protect against inflation. With a 10-year falling to 1.32 and the 2 years falling today as well, do we really need to protect ourselves from inflation?
Yeah, I think that's still absolutely the case, because the problem we have is that we don't have great data in terms of how inflation is playing through the economy, right? Businesses right now, all businesses can see are that their resource costs are very high, wages are going up, they can't find people. Whether or not that's because of the higher unemployment benefits doesn't matter to a business, right? So they're looking at either compressing their margins or having to take price increases. And it's hard for me to say with certainty that those price increases are going to be transitory or permanent, and that should flow through the rest of the economy. So for us, we think it's important to focus on quality businesses that have a differentiated franchise and can offset any price pressures that we see going forward.
Julie, there is some concern out there from some investors that the economy may be approaching its peak, that we could potentially see a pullback here over the next several months. One of the markets guests that we were talking to yesterday said that he expects to see a pretty substantial pullback here. What are you anticipating that we'll likely see, at least in the short term?
I think in the short term, we're going to see continued volatility. So much of the trading that's still happening is still at the retail base, and that is going to add volatility, right? It's a more emotional base of investors. You also have the fact that people have some concerns about how Delta variant is going to play out in the economy, and we don't know what's going to happen to the spending with consumers once unemployment benefits run out in the September timeframe. So I think there's a lot of uncertainty, and how I would characterize this rally is it's kind of a cynical rally where people don't necessarily feel as strongly about the economy, but they feel they have to stay invested. And so I think the fact that it is in this mindset means that they could pull back very quickly. So I would expect more volatility going forward.
I saw that you gave a shout out, and an appropriate one, respectfully, because all of us have felt the brunt of retail investors who felt that we were disrespectful, pointing out that there's a growing ire of people, as you said, who have been discounted. But you also point out that companies that respect a retail investor and want to educate them could stand to do much better than the companies we have focused on in the past. Can you give us a sample of what that's about?
Yeah, I think, there are two kinds of companies that are serving the retail investors, and there are ones that view their retail investors as the product and ones that view them as their customers. And so the ones that view them as their product, like a Robinhood, where the vast majority of their revenue is payment for order flow, for them, the education is not the major driver of their business, right? It's much more about transactions and generating excitement and FOMO, rather than actually educating investors on the basics of diversification or investing in quality businesses. There are other peers like a public.com who's working much harder to speak to people who are excited about investing in the markets. And I think that's a wonderful thing. I think we should be encouraging more education and financial literacy and not talking down to these investors, because, quite frankly, none of my peers have looked on these Reddit message boards, but some of the analysis that's on there is actually quite good. So I think we should be encouraging that kind of deep thinking about investing and realizing that this is a great way for people to build wealth over the long term.
Democratizing our investments. Julie Bill, always welcome back here. We appreciate your insight. She is the portfolio manager at Kane, Anderson, and Rudnick. When we come back, we've got to discuss the growing spread of the Delta variant of the COVID-19 virus here in the United States.
new developments on the spread of the the Delta variant from the COVID-19 pandemic here in the U.S. and now accounts, the CDC saying it now accounts for more than half of COVID cases in the U.S. We want to get to Anjali Khemlani, who has the latest on that for us. Anj.
Thanks, Shauna. Yep, the CDC did let us know that it now accounts for more than half of cases in the U.S. And the World Health Organization is worried about the impact of this globally, as we know that many countries remain unvaccinated, and that could lead to further mutations and further variants. Today, Dr. Mike Ryan had this to say about the Delta variant.
There's been a 33% increase in cases in the European region in the last week. So this is not a flat curve. This is an increasing curve. Making assumptions that transmission will not increase because we're opening up because of vaccine is a false assumption.
So as you can hear, talking about that and its connection with reopening, which we know a lot of countries have been considering. The UK, for example, we know is looking at that July 19th date, and that response was specifically in response to that. But looking at the variant itself, it now accounts for 50% of cases in the US. We know that has really represented an exponential growth. If you trace back to May, when it was less, at the end of May, it was less than 5%. We saw at the start of June, it was about 10%, and now we've gotten to the start of July where it now accounts for more than half of new cases. Meanwhile, looking more broadly, there are new concerns of a new variant in the world, and that is the Lambda variant from Peru. And this is exactly what health experts have been worried about, is that one variant will take over and then continue to allow others to thrive. So a lot of concern there right now.
All right, Anj, stick around. We want to bring in Dr. Tyson Bell, Assistant Professor of Medicine at the University of Virginia. And Dr. Bell, let's just start with the fact that more than 50% of COVID cases in the U.S. are now attributed to the Delta variant. I guess from your perspective, what do you think needs to be done in order to control the outbreak of the Delta variant here in the U.S.?
Well, vaccination for sure. We know that being fully vaccinated is very protective against the Delta variant. And if you're not vaccinated, then you're vulnerable. In addition to over 50% of cases being driven by Delta variant, over half of cases in half of states in the US now report significant increases in cases. And this is going to be regionalized. So states that have high rates of vaccination, even if you see an increase in cases, you may not see that increase in hospitalizations and then deaths because of the protection vaccination offers. But in states that have low rates of uptake, then this can be a really big problem leading into the summer, into the fall.
Dr. Bell, Anjali here, really good to talk to you again. Looking at that, what you just said about the hospitalizations, but we have seen some reports, including that report out of Israel, that the variant is troublesome when it comes to the vaccinations in those breakthrough cases. How should we think about that, especially with no new guidance from the U.S. government on how to handle the Delta variant with no new masking rules, et cetera?
That's a really good question. And as you know, Israel has been a good case study because they were so far ahead of the curve on vaccinating individuals. And a lot of them received the Pfizer vaccine. And they did release that report showing that the efficacy looked a little bit decreased against the Delta variant. They cited 64%. Now, this wasn't in line with many of the other studies that suggest the effectiveness overall is much higher, like more in the high 80s and maybe the 90s or so. But I think the most important thing to note is that Israel hasn't seen a COVID-19 related death in weeks. Their hospitalization rates have not been increasing in spite of the case that they've seen rising in the country. So that still underscores the point that full vaccination is very protective against the Delta variant.
Hi, Doctor. Curious, we're hearing about these new, even stronger variants like the Lambda variant in South America. Is that of concern for us here in the United States? And what can we do, if anything, to prepare for it?
So the Lambda variant is something that we're still learning more about. It looks like it does have a couple of mutations that could give it some ability to escape vaccine protection, but we're going to have to do more studies in order to figure out if that's actually the case or not, and also to determine if it actually of the others that are circulating. It underscores again the importance of trying to vaccinate as many of the worldwide population as possible, because one way that we know that we can protect from variants is to keep the population of circulating virus low. Each time the virus is able to replicate and infect someone new, it's like playing the lottery. And if you have a lot of lottery tickets, eventually you're going to hit the number. And so if we have pockets of the globe that are not protected from vaccination by vaccination, then you're going to eventually see more and more variants. And if you have enough chances, we might have that one that can set us back to square one and escape the protection from vaccine. So again, I don't want to sound like a broken record, but getting as many people vaccinated as possible, countrywide, statewide, and worldwide is really the solution.
And Doctor, at the expense of you, I guess, sounding like a broken record, because I know we talked to so many doctors about this over the last several weeks, but I'm curious just to get your thoughts on what we heard from President Biden yesterday, his efforts now to get the remaining 30% of U.S. adults who haven't been vaccinated, to get them to get the shot. I guess, what do you think needs to be done, or what can be done at this point in order to reach the people that we haven't been able to reach up to this point?
Well, I certainly do think that the traction that we gained from the centralized vaccination effort, that's pretty much gone at this point. And we vaccinated the people that were apt to get vaccinated that way. I do agree with the administration's approach to try to decentralize this process and get it more into community clinics and the doctors and nurses' hands, into the hands of people in the community that they know and trust. There's a survey released recently that showed that among people that have not been vaccinated and choose to remain unvaccinated thus far, if their personal physician talked to them about it and convinced them, they'd be much more likely to get vaccinated. So we do have to make sure that we get it into the hands of local providers to make sure that we can have these conversations, divorced from all the politics that can be involved in it. The most intimate and personal interaction with the patients with their physician in most cases. And to this point, we haven't had a lot of vaccine supply available in actual primary care clinics. So I think that's the next step. And then I think to take it a step further, once we gain full approval from the FDA, which hopefully will happen soon, I think the conversation around mandates for businesses and universities needs to be a discussion to really encourage the last group of people to really go ahead and get vaccinated.
Doctor, talking about treatments, when we're looking, at the individuals who do end up in the hospital, if they do, I know that for the longest time there were discussions about corticosteroids and the effect they had, in addition to, of course, the monoclonal antibody treatments. But now I know the World Health Organization has also been talking about Actemra and Kevzara. Do you have any insight into that? Is that what's being used?
We haven't really been using that therapy much here at the University of Virginia. We've been sticking with remdesivir and steroids, mechanical ventilation when it's needed, high dose oxygen therapy, a lot of the staples. I think the monoclonal antibodies are a very important tool because they have the ability to prevent people from getting very sick from COVID-19. Of course, the variants can introduce a wild card there because you could potentially have ineffective treatments in the setting of that. But the most important thing to do is try to prevent it in the first place, because every person that I treat in the ICU, we're cognizant that that's a preventable complication. We really should not have people getting sick enough to go to the ICU or potentially lose their life in the era where we have vaccines that can really prevent this.
Doctor, very quickly, any benefit for those of us who are fully vaccinated if we were to go and get a booster shot now, whether it be Moderna, J&J, or Pfizer?
I think that literature is evolving. There's some interesting data showing that the mRNA vaccines in particular can induce a very strong immune response that involves not just antibodies, but the cells that produce the antibodies and hold the memory of that response. The J&J vaccine seems to do that too. And so there's that potential that our immunity could last much longer than we initially thought, maybe over a year or even longer than that. I think the variants, again, that could probably introduce another layer of complication here, because if there's a variant that has that ability to escape the immune response, and that does actually set us back to square one. And I think the conversation around boosters will more likely be driven by concern around the variants, at least right now, rather than declines in the immune system, which looks to be very strong from the vaccines.
Dr. Tyson Bell, Assistant Professor of Medicine at the University of Virginia, thanks so much for joining us. And of course, our thanks to Anjali Kamlani as well. DiDi shares are off another 4% today. Now the move lower today, coming after the company was removed from WeChat and Alipay. We've got more on that right after the break.
The losses are mounting for investors in Didi. We want to bring in our own Akiko Fujita to talk about what's going on since the Chinese announced the crackdown on Didi, but other stocks that are trading based out of China and Hong Kong. Akiko?
Yeah, Adam, there's a number of fronts we're tracking here on the story of Didi, but let's start with the legal hurdle because this is the latest development. At least one class action lawsuit being filed here in the U.S. on behalf of investors. The law firm behind that citing specifically that the ride-hailing company did not disclose that, number one, it faced an imminent review from cybersecurity regulators, but also that it had been under investigation for its data collection practices and whether, in fact, it was in compliance with Chinese law, and investors now seeking to recover damages for Didi investors under federal securities law. So they've got a legal hurdle here now they have to face. Now, on the regulatory front and over in China, we had a number of developments that played out this morning. Regulators calling for a Didi app to be removed yesterday, but today it was the largest super apps over in China. We're talking about WeChat as well as Alipay that chose to remove the shortcut for the Didi app. And that's significant because of the scale of these apps. WeChat alone has more than 1 billion users. Users not being able to go through that traditional shortcut would mean an extra hurdle for users to be able to get to the Didi app. Now, in terms of the regulatory agency here, Bloomberg reporting the agency is now looking to revise rules for overseas listings to specifically crack down on companies that use a structure known as a variable interest entity, or VIE. Now, that structure allows companies to transfer profits to an offshore entity registered in places like the Cayman Islands with shares that foreign investors can then own. And we've had a number of companies, whether that's Alibaba, Didi, or Tencent, who have gone public abroad through that kind of structure. And they've been able to really expose this loophole in the Chinese regulation that doesn't specifically reference those kind of companies. Now, the report here is that regulators could potentially be looking to require any company to get approval back home before listing abroad. And that raises a lot of questions for potential listings. A lot of people looking at ByteDance, which is the parent company of TikTok, what that could mean for their potential listing, largely because it's been reported they have been seeking a listing outside of the mainland.
And Akiko, there's lots of questions too, just about Chinese companies that are already listed here in the U.S. Xpeng being one of them. We know shares here in the U.S. were under pressure once again today. They also listed in Hong Kong. And taking a look at the investors' reaction over there, that seems to be a bit lukewarm as well.
Yeah, it's interesting. Xpeng used what's called a dual primary listing that would subject the company to rules and oversight of both the U.S. and Hong Kong regulators. We've seen a lot of Chinese companies who initially listed in the U.S. go for a secondary listing in Hong Kong. And that's no coincidence. They have made it very clear that they are concerned about the geopolitical risk that could come with a U.S. listing. The secondary listing over in Hong Kong, in Xpeng's case, this dual primary listing, is in many ways to sort of hedge against what could be potential downfall here in the U.S. So I thought that was an interesting development, especially given what we have seen with lawmakers here in the U.S. really seeking additional transparency from Chinese companies, really to be in compliance with accounting rules that every other company that is listed in the U.S. Is subject to.
Akiko, thank you. And just a reminder, you can watch Akiko every day. She anchors along with Zach Guzman, the 11 o'clock to 1 o'clock here at Yahoo Finance Live. But when we come back, we're going to be checking out oil.
It's time for 2 and 2, two stocks that I'm watching, two stocks that Adam has for you here with just around 20 minutes to go until the bell. First up, let's take a look at Beyond Meat. Now, this stock moving to the upside. That's Whirlpool here. Let's take a look at Beyond Meat. That's actually under pressure, off nearly 4% today, downgraded by CFRA to hold. They say that they see a more risk reward balance at this point, and this, of course, comes after the stock has rallied just around 30% over the past 2 months. Now, CFRA also saying that they see the Q2 bottom line, that it might miss expectations. One factor in that will be transportation and labor costs. Again, you can see the stock under pressure today, trading at $140 a share. Now, flipping back to Whirlpool, that stock is in the green today with shares up just around 2.5%. JP Morgan naming it a top pick here. They disliked what the street has to say, and they actually think that the stock is in an attractive position at this point. They're bullish that the company will beat the street's expectations over the next couple of quarters. They see upside potential as a result of all this. And over the past 6 months, the stock has been an outperformer, with shares up just around 22%. Adam?
Take a look at what's going on with Ford, Sean. I love to talk about Ford because here's the underdog in the automotive world. So when you look at their shares right now, they're off about 2%, but a couple of things that are going on right now. They've been among the most actively traded stocks all day long. The shares have been up, and over the last 52 weeks, the range is anywhere from $5.74 to $16.45. Year to date, Ford is up 62%. A little bit of accolades, they can brag. 2021 Mustang Mach-E earned Car and Driver's first electric vehicle of the year award. It bests the top 10 top-rated competitors overall in Car and Driver's 3 weeks of testing. By the way, those tests included 1,000 miles of real-world, real-road experience. Then somebody's going to get a little bit of experience. Sir Richard Branson, Virgin Galactic. Okay, a couple things going on with space. That stock is off about 2.5%, but it was down at one point right after the opening bell, about 6.5%. There was a UBS analyst downgrade to neutral from buy, but they actually upped the price target for this stock to $45. The 52-week range anywhere from $14 to $62, almost $63. You should know, by the way, Sir Richard Branson, right now, all systems go for the July 11th launch into suborbit. No, they're not actually going into orbit, but suborbit, but it's a lot higher than a lot of us have ever gone. And he calls it a pinch me moment. Shauna?
All right, Adam, let's take a look at another big mover in the market here, and that's oil, because crude is off once again today. Shares or crude over the last couple of days so far this week off just around 5%, heading for its worst week that we have seen since March. But for the year, it's a totally different story. Prices have rallied. They're up more than 50%. Holding today just above $72 a barrel. We want to bring in Jay Young. He's King Operating Corporation's CEO. And Jay, it's good to see you. And the last time we spoke to you was back in March. You were skeptical that we would see prices really go through the roof, is exactly what you said. I guess since then we have seen prices continue to rally to the upside. We're trading just above $70 a barrel. Where do you think we go from here?
Yeah, I think we still go higher, Sean. And the reason why is because it's real simple. You know, we don't have any big backing in the oil and gas industry right now. Your private equity firms are coming out. Your big public companies are getting replaced on the board of directors by several people that are green or greener. You know, you're just not having the rig count. If you look at the rig count right now, you're looking at rig count at 420, 430. We need 600 to really do what we need to do to keep oil prices down. When we need the oil, when we need it, we're not going to have it. And when we don't have it and we don't have it available to us, it's going to be ugly. And the Saudi Arabia, Russia, who's been trying to put us out of business for years, is going to take advantage of us, I'm afraid, real soon with higher oil prices.
Okay, but they haven't put us out of business yet. So how long does it take to get the rigs up and running and producing the oil that we're going to need? Because we've seen this game play over and over and over again.
Right, Adam. And it'll take time. I mean, a one rig runs about $100 million a year. when you look at drilling, completing, fracking, that's about how much you spend on one rig. We're 150, 160 away from really being where we need to be. Now we've been over 1,000 rigs a day. So now we're at we need 600, we're at 400. It's going to take a long time. And I just don't think we're going to have it. I don't think we have the horsepower with the equity markets, the debt markets, the PE firms, that access capital. I just don't think we have it. I don't think we're going to be able to get that many rigs back in the fields drilling that fast. And if you don't have that, you don't have the supply. And when you don't have the supply, you're not going to have the oil. And when you do and you need it, you're not going to get it. And it's just going to be bad for people going to the tanks and filling up their gas tanks, and they're going to need $4, $5. I mean, we've seen it before, like you said, Adam. I mean, my family's been in this business 100 years. We've seen cycles after cycles after cycles. And yes, it will get better. It will take time. But I think this one's going to last longer. I just don't see what's going to hold the price of oil down long term. Yeah, you're going to see these little $2, $3 little ups and downs. But long term, we're not going to have it because we're simply not producing it. And if we don't produce it, we're not going to have it. And Saudi Arabia and Russia, it's going to be ugly. They're not going to give us any oil at discount prices. They're going to charge us, and it's going to be ugly for us.
Jay, when you say long term, I guess, what is the timeline are you talking about? You're talking about 12 months here? You're talking about over the next 2 years? I guess help put that into context for us.
No, yeah, good question. It may take several years for us to really get back to drilling, a lot of wells. That's 3 to 5 years out, but you're not going to see peak oil demand for 10 years, so we're going to need this oil for a long time, and we're not going to go greener anytime soon. And I mean, don't forget, we need 20 million barrels a day in the United States. That's our appetite, 20 million. Before the pandemic, we were producing 13. That went down to 9 million barrels a day. Now we're back up to almost 11. So we still need 9 million barrels that we import. The problem is that the more oil we need to import, and our friends have a few million barrels, but the further we get away from that 20 million barrels is the uglier it gets, because that's when the Saudi Arabias, the Russias, the people that want to put us out of business, that's where they go.
But Jay, very quickly, doesn't the fact that oil now at $70, last week it was $75 a barrel, at least WTI, that brings our drillers back in. I mean, they can make a profit at a far lower amount. I mean, I think we had one guest years ago who said $26. That's a magic number. Above that, they make a profit. So they should be piling in right now.
Absolutely. The problem is the capital's not there coming in. The private equity companies, all the banks and all the different people. I mean, you can see that by the rig count. Okay, now let's wait. The rig count is going up. And if it continues to go up in the next year or 2 years, and we finally get all those rigs back working, then you may see it starting to go back over again, the price. But it's going to be a while before you see that price come down. Why? Because we're not making it. If we can't make it, we don't have it, and we need it. You know how that story ends up.
All right, Jay Young, CEO of King Operating Corporation. Great to speak with you again. Thanks so much for taking the time to join us. We are going to talk about Bitcoin next. Prices moving to the upside today despite a crackdown over in China. We will discuss right after the break.
All right, we have got just a little more than 15 minutes to the closing bell. I want to draw your attention to what's going on with Bitcoin. It's up about 670 bucks right now, $34,629 and change. But there's other cryptocurrencies out there. In fact, Goldman Sachs says, pay attention to Ethereum. We're going to pay attention to Ollie Leach. He's CoinDesk's Learn editor. And Ollie, it's good to have you here. Help us understand, if you can, the Goldman call, apparently this note leaked, that they see Ethereum as potentially overtaking Bitcoin. What does that mean to those people who are buying Bitcoin today at over 34K?
Well, I mean, it's something to diversify your portfolio for sure. A lot of maximalists will probably fire back at Goldman Sachs for those comments, but they've got a point for sure. Ethereum is driving a lot of the innovation in the space at the moment. They're responsible for the DeFi boom, the NFT boom that we all enjoyed at the start of this year. But the main problem that they have is they have a lot of competition, and this is where Bitcoin kind of pulls away from Ethereum. It has a low supply, 21 million coins, which many people are aware of, and this is a big driver for its value, but it doesn't have really the same competition that Ethereum does. We're seeing a lot of new blockchain projects step up to the NFT space, particularly the DeFi space, and they're all trying to eat Ethereum's lunch. So it's definitely a close call. We'll see how it goes.
Ollie, when we talk about regulation, because of course that's been a big topic, when we talk about not only Bitcoin, but really crypto at large, and particularly what's going on over in China, I guess how big of a headwind do you see this being? And I know we've talked to you about it in the past, but since then we've gotten headline after headline about how it could potentially disrupt the crypto markets going forward.
Yeah, absolutely. I mean, people have been talking about this kind of new level of enforcement that we're seeing in China right now. And it's true, you know, for the most part, even though these bans came out in 2013, 2017, we're really starting to see them amp up that enforcement now to start targeting these sort of fringe companies that offer and facilitate crypto transactions in the state indirectly. So, you know, we go back last year, we were seeing these exchanges getting targeted, but now we're seeing software companies getting targeted as well. And what's interesting is China's stance has always been very, very clear from the get-go. When it started these bans, its message was, you know, do not offer or facilitate cryptocurrency transactions, otherwise we will shut you down. And payment providers, software companies, anyone who engages in these sorts of activities now are going to get shut down.
What about the fact that we keep having these hacks, these cyber attacks on international businesses, and they wish to be paid the ransomware in Bitcoin or in cryptocurrencies? How much longer till the sleeping giants of the world say, okay, enough of this, and that regulatory clampdown begins?
Yeah, I mean, this is a big problem that Bitcoin's currently facing, and for a long time we had that issue of Bitcoin being used for Silk Road for nefarious activities, but people also sort of shy away from the fact that through Bitcoin and through blockchain technology, we're actually able to track all of these payments. It's all transparent. Anyone can see where these payments are going, and in fact, through Bitcoin, some huge sort of dark web websites are being taken down purely because they were able to track the Bitcoin payments to them. So it's kind of a double-edged sword situation. You know, it's not great publicity for Bitcoin, but it does have a traceability element that does help apprehend these sorts of funds. And we've already seen the FBI actually, through some unknown method, actually managed to break into the wallets and get that ransom back. And this may set the precedent for things to come and may even deter people from using Bitcoin in the future.
Ollie, taking a look at the performance of Bitcoin during the second quarter, obviously there was a lot of volatility in the price of Bitcoin. We saw it significantly pull back from its highs. What do you think that means just in terms of the likely trading action that we'll see from Bitcoin over the remaining 6 months of the year?
Yeah, sure. I mean, Bitcoin's very, very seasonal, and August is always coming up to August, and that's typically the worst time for Bitcoin. And we usually see into the final quarter, you know, November particularly, we've seen spikes in the price. So it could just be a seasonal thing. We've obviously had this crazy first half of the year where we had Wall Street bets, we had this Dogecoin run up, Bitcoin touched $65,000, NFTs were booming. It was a really exciting start to the year. And now we've had, you know, the Bitcoin energy consumption debate resurface. We're having increased clampdowns from China now. We seem to be entering this kind of regulatory phase at the moment, which is driving prices down. But long term, I think, you know, I think Bitcoin still has a very bullish case. We still have halvings and things like that to look forward to, which should help to prop up prices as we go forward.
Will we be putting a fork in Dogecoin, which I prefer to call doggy coin? But is it about time that this has jumped the shark? What would you say about the trends we saw in the last quarter about where Dogecoin may be headed?
Yeah, I mean, the big thing for Dogecoin is to be aware of the risks. And I think, in the start of the first half of this year, we saw people getting really excited about it. A lot of people who may have never even engaged in the crypto space were buying Dogecoin because it was available on Robinhood. Everyone was talking about it. But again, it has some serious underlying risks that people need to be aware of. And I think that as time goes on, and Elon Musk particularly, he's lost a lot of favor with the crypto community. So that might be hampering prices and its potential to go back to 69 cents. Yeah, it's a bit of a risky investment, and it doesn't really have the utility to push it forward like Ethereum, like Bitcoin, and like some other projects.
I think we should remember Elon Musk's mother on Saturday Night Live, the television show, said to him, "Do not eat Dogecoin." All right, Ollie Leach, thank you so much for joining us. Ollie is the CoinDesk Learn editor. When we come back, countdown to the closing bell.
Got 8 minutes here until the closing bell. We're looking at gains across the board. The Dow now up over 100 points. Let's get to Jared Blickery on the floor of the New York Stock Exchange. Jared?
Yeah, well, we have the reverse of this morning. The Dow is leading, the NASDAQ lagging. And let's take a look at the price action on the Dow here. And you can see this is over the last 5 days. Probably not going to get a record close, but we should with the S&P 500 and the NASDAQ. But we got to look here at well, not the Dow again. I was looking for the bond market because that has really been the story of the day. And here's a 10-year T-note yield that's down another 5 basis points. We've been tracking that pretty closely. 30-year T-bond, that yield is down 6 basis points below 2%. That's one of those big thresholds. Next stop, $1.75. So want to keep an eye on that. But the action was pretty strong for mega caps today. Apple should be set for a record high along with Alphabet, Amazon, Microsoft. Apple posting the most gains of that group, up about 1 3/4%. Seen some weakness in the chip space. Semiconductors off. We got AMD and Xilinx each off 4%, maybe something to do with their proposed merger, but also seeing some weakness in the travel sector. Carnival Cruise Lines down 3%, so is Norwegian, so is American Airline. And if you want to see some more red, just real quickly, here is the banks, except for JP Morgan and some others in the upper left. But I'll tell you what I've been watching today. Meme stocks. And if you're not watching Newegg, you are missing the party. That is up 150% today alone off of its session highs just moments ago. Take a look at over the last month and you'll see up over 500% there. As far as the other meme stocks going, not a lot of action. AMC is down almost 10%. GameStop off about half of that. And I'd be remiss if I didn't hit Bitcoin here, because you take a look at what Bitcoin has done over the last month. It is consolidating at lows, and usually this is resolved in the direction of the trend, and that would unfortunately be down. But I'll tell you what, we get above 35,000 again, 40,000 in sight, maybe the worst is over, guys.
All right, Jared Blickry, thanks so much. Again, we are looking at gains here across the board with 6 minutes to go until the bell. The Dow up 122 points, S&P up 0.4%, and the NASDAQ holding on to gains. We'll be right back. We've got 2.5 minutes until the closing bell. We have Simona Makuta, State Street Global Advisors Senior Economist, and John Lynch, Comerica's Asset Management's Chief Investment Officer, to help us make sense of the action that we're seeing today. And John, I guess first to you, what do you make of the leadership that we are seeing? Because so far we have industrials and materials, both of those sectors up more than 1% today.
Well, good afternoon, Shauna. Yeah, those sectors are leading, industrials and materials, but curiously, utilities and staples are not far behind, which I find an interesting phenomenon, right? Because If rates were really going lower, you would think, if the market believed rates were going lower, you'd see more sustained leadership from the defensive space. So today's kind of a confused day. If you think about cyclical leadership with industrials, materials, energy down, yet still some degree of leadership from utilities and staples. So I suspect what's going on in the market's just trying to digest what substantial further progress means when the Federal Reserve keeps referring to that. And it would appear that the taper discussion, while maybe going on, is not imminent, and that's why the stocks are rallying.
Simona, let me just get your thoughts on what we're seeing, not only today, but really coming on the heels of that better than expected jobs report that we got out last week. I guess, how are you viewing it at the market's reaction, comparing that to the econ data that we're getting?
I think in some sense you can say that there is alignment here in the sense that we know for sure the economy still has a lot of growth ahead of it, and perhaps that's what the equity market is looking for and banking on. There is still a lot of pent-up demand. In fact, what you're seeing at the moment is not an issue of too little demand, but almost too much demand trying to come online and work through the system. And you're seeing the supply chain issues that are causing prices to rise. So I think perhaps what the equity market assumes is that this must be a fairly good pricing environment for these businesses. And therefore, even though input costs are rising, perhaps the margins can be salvaged here.
All right. NASDAQ is going to settle up roughly. Double. You guys not
All
hearing
right, Adam, looks like we're having some trouble with your audio, so we are going to try and get that figured out. But I think, as Adam was just saying, you're looking at gains across the board. We have the Dow up over 100 points today, S&P up 0.3%, the NASDAQ barely holding on to gains after hitting an intraday record shortly after the opening bell. The NASDAQ closing in positive territory, up just 1 point, though. We want to bring back in Simona Makuta and John Lynch for a little bit more on the action that we're seeing. And John, just in terms of where we're headed for the second half of the year, because I think investors are trying to wrap their heads around some of the leadership that we're seeing, and not so much today, but the fact that investors are once again favoring some of those big tech names. And then we have the 10-year yield, for example, trading down at 1.3%. So I guess, where do you think we're headed from here, knowing that that type of action is taking place today?
Well, I think recently we've seen a comfort factor as the 10-year yield has declined. People have gone with the tried and true, the big five technology, if you will. I think the more likely play, though, for the remainder of the year will be a cyclical bias for the market. And I suspect today's leadership, as we discussed previously, with industrials and materials leading, I suspect that is a good sign. We're going to get second quarter earnings beginning next week. Earnings should be up 60% or so. And then I think as you get more clarity on reopening trade and more clarity on improved demand, the Fed at some point is going to have to start tapering. And that would be okay. That would be a good sign for the market and the sustainability of this expansion. So I do believe for the second half of the year, cyclicality will lead. I think the S&P would probably be fairly valued in that 4,500 range by year end.
Simona, I want to pick up on what John was just saying regarding the stay-at-home trade and whether the Fed's tapering really would be good, not only for those of us who invest in equities, but overall for the economy. What do you think?
I don't know if it would be good necessarily. I mean, one buyer comes out of the market, but I think I do agree would be for sure a signal of confidence in where the economy is headed, and this idea that the economy and the market can stand on their own 2 feet, so to speak, with less policy support. There is no question that the moment of peak policy accommodation is behind us. on fiscal, on monetary. So that's what we need to consider, I think, economists in terms of the macro, investors in terms of the markets. How do we function without that policy support or with less of it? How troublesome, how volatile is that transition? I doubt that there will not be some volatility associated with this shift, but it need not be, drastic as long as you have this sort of growth underpinning the outlook.
Simona, what about the JOLTS report that we got out this morning? Job openings climbing to a record high, then we have the layoffs hitting an all-time low. What does that mean just in terms of the recovery that we're seeing in the labor market?
It's telling us, and not for the first time, that you are in a supply deficit in the labor market, not a demand deficit. The demand for labor, the demand for workers is certainly there. The problem is the workers are a little slow to come back. I think with perhaps the exception of construction, where you are seeing now some weakness for a few months, both in payrolls and in job openings, everywhere else, every company seems to be looking to hire. So I think it's just a matter of speeding up the re-entry into the labor force of those workers who have been a bit slow to rejoin. We should be looking for some really strong employment gains during the second half of this year.
All right, we're going to take a quick pause, go to Jared Blickery, who is on the floor of the New York Stock Exchange. Let's open up his mic and let's go.
All right, well, I've been looking at the NASDAQ and the mega caps. For the last 6 weeks or so, we really saw a resurgence of the growth trade at the expense of value and cyclicals, and it looks like it has room to run. Now, we had a change of leadership today. It ends up that materials and industrials were leading by the end of the day, as previously noted. But I think the growth trade has room to run here, especially into earnings season. Got a couple weeks where you don't have that much news. You take the other factors, we have retail buying call options on these mega caps. Again, they influence the market. On any given day, they can be the big marginal buyers. So I think these moves that we're seeing in Apple, Alphabet, and some of the others have room to run.
John, when you take a look at what's been priced into the market at this point, lots of questions about earnings, what could potentially be another catalyst here for stocks going forward. What do you think has already been priced in up until now?
Well, low rates have been priced in. A Federal Reserve that will remain accommodative has been priced in. And I really believe Jared's point, once we get through this growth leadership, if you will, over these next couple of weeks, it's really going to come down to visibility from corporations and to what extent businesses are, and when reporting earnings, are still positive about their earnings visibility, the sustainability of margins and the degree of economic demand, as Simona talked about with, the supply and demand imbalance in employment. I think you're going to see, improved services employment. We had a disappointing number yesterday, but I do ultimately believe, as some of these unemployment benefits, for example, some of the states pull back on that. I think that combination with improved demand growth, not only domestically but globally, I think that will probably be the next catalyst to get stocks moving again, and again, consistent with our outlook for cyclical leadership in the second half of the year.
Simona, are you worried about these new variants that are popping up with the COVID-19 virus and their impact on, it's not the United States, but reopening globally, and then the impact on the U.S.?
I mean, it would be foolish to not pay attention and not to worry about them at all. I would say that at the end of the day, despite all these headwinds, and I don't think the Delta variant would be the last that we learn of, each and every day we are making progress, and we are sort of gaining another step in the fight against COVID. Vaccinations globally are really finally accelerating. And not only are they accelerating, but they are broadening geographically. So that is nice to see. And I'm hopeful that, as with every week, with every month, sort of the margin of pain in terms of the, forcing in reinstitution of mobility restriction, that diminishes. But we are definitely not out of the woods yet on this health crisis. And so the risk remains. It's just that with the passing of time, the risk diminishes in my view.
Simona Makuta of State Street Global Advisors and John Lynch of Comerica Asset Management. Thanks to you both for joining us here today. We want to get to another big story that we're closely watching here at Yahoo Finance. Former President Trump filing a lawsuit against Facebook, Twitter, and Google, as well as the CEOs of those companies. Now, he is making the claim that he has been wrongfully censored on the platforms. We want to bring in our editor-in-chief, Andy Serwer, for a little bit more on this. And I guess, Andy, just what's your reaction to this? And do you think it's going to get any traction in the courts?
Well, Sean, it's not my reaction that's important. It's Mr. Market's. And for the most part, Mr. Market yawned here. Yes, Twitter stock was down 2% today, but it was a volatile session with the others. I think Google was up a little bit and Facebook was just down a tad. So the stocks did not particularly react to this news. And I would submit that Twitter's trading didn't really pertain to the announcement by the former president.
Andy, when we talk about big media and the gathering that's taking place in Sun Valley, a lot of deals get made at the bar there after their conferences, the elite meet to eat, right? But are we expecting a major deal after this year's Sun Valley?
Yeah, maybe there's a little deal fatigue, Adam. I mean, you know, these are the same people who brought us the Verizon, AOL, Yahoo deal, which is being unwound. And the AT&T Time Warner deal, Warner Media, which is being unwound as well. So maybe the appetite is cooled. On the other hand, you know, there are still deals going on. Of course, Yahoo has now been bought by Apollo, our parent company. And probably bigger in this world is Amazon buying MGM. So there's still a lot of deal making going on. And of course, the flip side also coming out of AT&T, which is the big Discovery deal they're doing with Warner. So these guys, you know, listen, they live, eat, and breathe to do these transactions, particularly someone like John Malone, who is a regular there, Warren Buffett, Bill Gates, Sergey Brin, Larry Page from Google, and Herb Allen, of course, is the master puppeteer. This is the Allen and Company conference you're talking about in Sun Valley, Idaho, hosted by Allen and Company, the boutique media investment bank over which Herb presides. So, you know, I expect something to come out. Sometimes it takes, you know, a couple weeks and months, though, until something transpires. And then you found out actually the deal was done in Idaho.
Well, we will wait to see what comes out of this conference. Andy Serwer, thanks so much for breaking that down for us. We need to take a quick break, but on the other side, ACV Auctions, it's an online auction company for used cars. The company went public back in March. We are going to talk to its CEO about demand for used cars and also how the chip shortage is impacting his business. We're back with that in just 2 minutes.
All right. Well, it was Aretha Franklin. We're going riding in a pink Cadillac, or how about a Jaguar? My favorite color would be British Racing Green or black. Let's bring in George Shimon. He is the CEO of ACV, and this is a platform that help us understand, because for so long, those of us who want to buy a used car, and we're watching used car prices go up. You've actually called that months ago. You can go to a dealer, and they're the old adages that the dealers get their cars at auction. So that's where you come into play. How can I, as a consumer, use the dealer and your platform to get the best?
Yeah, certainly, Adam. So yes, used car values continue to climb, and they've climbed for several months. We just recently saw a plateau. What ACV Auctions helps the consumer do is it helps them auction their vehicle to dealers, but through one of our dealers. So if a consumer wants to get an appraisal for their car, it's got a live appraisal, they can go to any one of our thousands of dealer partners across the country, and in 20 minutes, we've auctioned their vehicle, and if the consumer likes the price, they can accept it, and the dealer will do the trade. And what it allows the consumer to really understand the full value of their car, and it also allows the dealer to make sure they're paying the right price for the vehicle.
George, the chip shortage certainly has had a massive impact on your business, but talk to us just about the trends that you're seeing as a result of this and some of the buying patterns that you've seen as a result of the chip shortage.
Yeah, certainly. So, Sienna, you had me on late last year, and we talked about used car prices going up. And what we saw is it kept going till this past month. Used car prices continued to climb. There was a lack of used vehicles, a lack of supply. We saw prices go up. Last month we saw a leveling, and so now what we're seeing is used car prices had gotten to a point for certain makes and models. A used car was the same or higher than a new car, which makes obviously no sense. But now that you're seeing some of the manufacturers, they're just starting to get chips they need. Ford most recently said for their pickup trucks that the chips are arriving. So between now and the end of this year, we're hoping things get back to normal.
Actually, wouldn't things getting back to normal be better for your platform, because it would return some of the market as opposed to just being a seller's market? It would put more of the forces in play that require negotiating, right?
As a platform, you're really in a good spot, whether there's a lot of supply or a lot of demand. As a platform, you're allowing the market to really understand the actual cash value, the ACV. So we're in a really good spot. But yes, with dealers getting a higher supply of new cars, then they'll be able to sell more cars to consumers, both new and used, whereas up until recently they've had a shortage of new. So we believe that could be positive for ACV on a going forward basis for our new car dealers to have more cars in the lots, which will allow them also to do additional trades, which will then result in more wholesale.
George, when you went public back in March, you talked about plans to expand your footprint. Where do those plans stand today? And I guess, how do you plan to scale your business going forward? Yeah, so we talked about the expansion in a couple ways. One was taking our core business, ACV Auctions, across the U.S., and we signaled we would have coverage across the entire country by the end of this year. That's going well. We're at plan, and we will have territory local sales managers across the U.S., as well as vehicle condition inspectors to inspect these vehicles. Because what ACV does is it brings transparency to these transactions, because our inspectors go out and inspect the vehicle. So that's going well. We're growing across the country. We mentioned next year we'll focus on broader expansion outside of the U.S. And then we also mentioned you'll see ACV add additional value-added services beyond the auction later this year or early next year. So all going well so far.
What are some of those services you're going to add? I mean, we're kind of already there at the world where you're not going to need to go to a physical dealership. It'll be digital, because we can engage via platforms like you and with the digital dealer.
Yeah, the things we mentioned in our IPO, so the information that's public today, you hear us talk about data, pricing, helping dealers understand the value of a vehicle, helping them take in cars and trade cars more appropriately with consumers. So a lot more activity between the consumer and the dealer. So without mentioning specifically what those features and products are, but we'll be investing more significantly within products in the data category.
Thank you for joining us. The CEO from ACV, George Chamoun, all the best to you. When we come back, we're going to talk about the space trade.
Time for news on the move. Haiti President Jovenel Moïse was assassinated in an attack on his private residence early this morning by unidentified attackers. Now, his wife, First Lady Martine Moïse, was shot during the attack and has been hospitalized. Now, the attack comes amid a rising wave of politically linked violence in the country. There are now fears of widespread disorder. Tropical storm Elsa making landfall along northern Florida Gulf Coast, moving north at 14 miles per hour with maximum sustained winds at 65 miles per hour. Now, forecasters expect the storm to move inland and move across the southeastern and up to the mid-Atlantic states through tomorrow. The Ever Given container ship has been cleared to leave the Suez Canal and is finally on the move after the Canal Authority reached a settlement with the vessel's owner and insurers. The ship is leaving the Suez Canal 106 days after blocking a southern section of the waterway for nearly a week. We're going to switch gears and talk about the race for space. Hawkeye 360 is a satellite company that launched new satellites on the recent SpaceX rocket launch last month. Now it helps gather data using a cluster of satellites, also using radio frequency. So we want to bring in Hawkeye 360 CEO John Serafini. And John, it's pretty cool. I was looking at what exactly you guys do and the data that Hawkeye has been able to identify. It's illegal fishing by Chinese vessels in the Galapagos, Iranian smuggling of crude to Syria, poaching efforts in the Congo. I guess talk to us just exactly about how this works and the data that you're hoping to get from the satellites that were just launched on the SpaceX mission.
Sure. Well, thank you very much for having me on to talk about Hawkeye 360. We have a very unique set of capabilities on orbit. Our satellites fly in clusters of 3, which has never before been done commercially. We have one that's in the front, a second satellite that's behind, and a third that oscillates back and forth. And that unique architecture allows us to geolocate signals of interest. Basically, any signal above 140 megahertz up to 18 gigahertz, we can detect, we can geolocate, we can process, and we can analyze. And then we can convert that RF information to actionable intelligence products for our customers. As you point out, that can take the form of detecting illegal fishing or poaching activity. It could take the form of tracking adversary militaries as they move towards country borders, a whole host of different applications and missions which we can conduct.
How do you monetize that? How do you make money?
Well, we're a software as a service company. We sell our data and data analytics on a subscription basis to a whole host of different customers, some of which are on the government side and international governments as well as commercial. And there's a bunch of different value propositions in between, some of which reside in the classified domain and others are purely unclassified.
John, when you take a look at kind of the excitement around space, and certainly right now we have Richard Branson heading to space on Sunday, I believe. Jeff Bezos is heading to space later on this month. I guess, what does that do just for interest in this category and then also just interest in a business like yours?
It's fantastic, obviously. There's just in Q1 of this calendar year alone, a little over $4.5 billion worth of capital plowed into great space companies, to include a bunch that are now going public through SPAC vehicles. And this is great. It's fantastic to see the space as a new asset class receiving the kind of investment that it deserves and allowing us to build new and compelling functionality on orbit to solve really difficult challenges here on Earth. A great example with environmental concerns, what Hawkeye can do in terms of detecting and tracking and helping to stop environmental crimes. Things like illegal fishing, where we're tracking Chinese fishing vessels off the coast of the Galapagos who are engaging in illegal fishing activities inside nations' economic exclusion zones, to being able to detect poaching activities in national parks all across the world, and in particular in Africa. There's a whole host of different missions that can now be done more cost affordably from space, and the investor ecosystem loves it. We're very excited about it.
I keep coming back to the making money side of this. By the way, I think you win the coolest, job in the world, despite Jeff Bezos getting to go up in Blue Origin and the suborbital thing with Virgin Galactic. But I would imagine the majority of your clients right now would be more from the government sector, or are you seeing the private sector take an interest in what you're providing? And what kind of data? I get why fishing data is important, and if someone's fishing illegally in waters not theirs, that's important. But what does the private sector gain from knowing that?
Well, great question. I mean, obviously, there's really big applications and total addressable market sizes in the government domain, right, for both U.S. government and international. And the upside is that the U.S. government recognizes right now that the time is right for embrace of commercial technologies. They recognize that the seriousness and the complexities of the missions which we ask our Department of Defense and the intelligence community to execute against greatly outstrip the resources available to us. And the only way in which to bridge that gap is through a very healthy embrace of commercial technologies. And I think Hawkeye 360 is a poster child for doing so, in bringing private, non-taxpayer capital plus intellectual property and the agility and flexibility of a Silicon Valley mindset to bear on public sector problems. So yes, a lot of the missions and the applications that we deal with today at Hawkeye 360 are addressing government-centric problems. And that's great because they're the world's most demanding and challenging customers. And if you can make them successful, you can bring your technology and your applications anywhere. There are very real commercial applications of our technology and, of course, international applications of our technology, which we're executing against in parallel. We anticipate in about 3 years to be a third U.S. government, a third international, and a third purely commercial.
And how does that compare to what you're seeing today?
Today, obviously, given the newness of space, a lot of people recognize that the biggest drivers of geospatial activity on orbit is governments. Governments have defense, security, intelligence problems that need to be addressed and the ways in which that they can address them through accessing commercial sensors and commercial intellectual property, particularly in artificial intelligence and machine learning and digital signal processing. That means that we can be very real components of those solutions for those problems. And so we're addressing those today. Over time, the commercial markets are going to mature and emerge and be larger, and the marginal cost for us to then shift over to those problem areas over time will be much lower, having built that first to support government missions.
John Serafini, very interesting stuff. Thanks so much for taking the time, CEO of Hawkeye 360. Coming up next, we're taking a look at some of the trends that are underway in travel, retail, and dining as the economy recovers from the COVID-19 pandemic. We're back with more in just a couple of minutes.
There used to be an expression that content is king, but in fact, it's actually data. Data is king. And one of the companies now publicly traded that aggregates data across the World Wide Web is SimilarWeb. We invite them into the stream right now. Greg Mallon is the SimilarWeb Vice President of Solutions. It's good to have you here, Greg, because we talk a lot about the reopening trade and what's been going on in the economy. But you folk at SimilarWeb see things differently based on data. For instance, you recently crunched the numbers and saw all of us shift to our mobile devices, or from our mobile devices rather, to computers, and then back to mobile devices. Tell us what that means as we reopen, but also where we're going on those devices, the sites we're heading to.
Yes, so thanks for having me. When we look at the data last year, right, everybody kind of retreated into their homes, and we didn't see a complete abandonment of people using mobile devices, but we did see a shift more towards the desktop. And this year, of course, we're seeing a reversal of that, right? As consumers start to get back out into the environment, we're seeing an increase in people using their phones and kind of moving around. The areas where we're seeing the strongest recovery and the fastest recovery are areas that you would expect right now in travel, within the shopping space, notably within home and gardening and clothing and apparel. And then we are starting to see signs of life within the event space, right? Ticketing, companies like Ticketmaster and StubHub are also starting to come back to life.
And careers, jobs, obviously another big topic, something that you are tracking. I was going through some of the numbers that you're seeing, the increase, the 20% jump year over year in terms of the January to May numbers in 2021 compared to what was searched on career sites to 2020. Just talk to us about some of those trends and I guess exactly what people are doing on those sites.
Yeah, it's huge, right? What we see users doing is ultimately leveraging these online platforms like never before. And so sites like Indeed or ZipRecruiter are seeing huge increases in not only job seekers going and trying to find jobs on these platforms, but also employers going and trying to find the people for their jobs. And ultimately, there's a huge surge in both supply and demand right now. And so we're seeing that translate into the web traffic.
But you're also seeing, in addition to the web traffic to the job sites, when we talk about retail, home and garden, the volume there increased 21.4% year over year. What were some of the other surprises you saw when you were looking at the retail trends?
Yeah, so the home and garden space has been a fascinating one because it grew year over year in a period when consumers were already doing a ton of home and garden shopping already. So when we were forced into our homes during the pandemic, we saw a huge increase in home furniture buying, right? There was a supply shortage. And even going into 2021, as we started to get back out there, consumers are still working on their homes. And so we see a nice, healthy increase, about 21% in the home and garden category this year already. And if you actually look at one of the largest beneficiaries is American Freight, their traffic is up triple digits. And a part of that is consumers are still waiting for that furniture that they maybe have purchased or those big ticket items that they purchased, even going back into 2020. So you still see consumers working on that. If you look at Prime Day, Amazon's event from a few weeks back, home and garden was one of the largest categories that we saw consumers drive towards. And what was most interesting was actually the lowest share of new consumers shopping on Amazon during Prime Day was with home and garden category because consumers were already doing a lot of their shopping there already throughout 2020 and 2021.
Greg, what about some of the fitness trends that you're seeing? We talked to the CEO of SoulCycle, Evelyn Webster, last week, and she was saying that the company's having trouble just keeping up with the number of riders and meeting the demand that they're seeing in the studios. So what are you seeing on the sites just in terms of what people are searching for when it comes to fitness?
Yeah, I mean, it's exactly what you would expect to find, not just within the gym space, right, of consumers getting back out and looking for gyms and classes within major metropolitan areas. So ClassPass obviously seeing huge increases in their traffic year over year, a year after they were probably shut down in a lot of states that they were popular in. What you would also see is not a slowdown necessarily in home fitness as well. Peloton, Mirror, Tonal, all those companies that saw huge increases in demand during the pandemic are still performing quite well and trying to keep up with that consumer demand that they saw during the piece in 2020.
We have a good relationship with SimilarWeb here at Yahoo Finance. I know, though, that your clients are paying you for some of this data. It's proprietary. You can't tell us who the clients are. How are they using the data, though, that you've just shared with us in order to get an advantage when they're making their investment decisions?
Yeah, it's a great question. I think the biggest piece that we saw an increased one was just knowing, right? So a lot of customers were going and flying blind going into the pandemic. And what we were able to do was kind of shine a spotlight on it. So more than anything else, we were providing information on what their performance was like relative to the market. So they could understand how down were their numbers in 2020 and then how their recovery was performing. And now that the recovery is starting to happen, there's points that we can start to help our customers see acquisition trends. What are search terms that consumers are looking for? If you're in the travel space, the destination side, where are they going to? So you make sure that inventory is appropriately placed and priced correctly to meet the demand that we're seeing.
Data is king. All hail SimilarWeb. Greg Mallon, SimilarWeb Vice President of Solutions. Thank you for joining us here on Yahoo Finance Live. Want to turn our attention to something that happened earlier today on the Yahoo Finance Live platform. Yahoo Finance spoke to Nextdoor CEO Sarah Friar about the company's upcoming SPAC merger. We started out by asking about the company's growing valuation and why she thinks it's justified.
Largely due to growth. We're in hyper growth mode. We saw phenomenal growth in 2020. Our DAU, our daily active users, grew 50% year over year. And as you noted, we've now reached 1 in 3 households in the United States. And of course, we're global. So we're in 11 countries around the world, 276,000 neighborhoods. And in countries like the UK, for example, we're seeing that same build happen. Today, we're in about 1 in 6 households, and actually a little bit under 1 in 5 in London. So with that scale, brings monetization, brings a great business model. And so the valuation has risen commensuratively.
And, Sarah, I'm curious how you guys, and you outlined it a little bit in the presentation, where you see yourself sitting with respect to competitors. I'm looking at the graph here where you have, you're comparing the frequency of use that Nextdoor has to Instagram and Twitter and Spotify, Weather Channel, so on and so forth. What I don't see on there, which is where my mind went, was, your Angie's List type home, referral services. How do you think about the opportunity that you guys have there, relative to the opportunity you have against some of these social networks that, again, are a little more prominent in the presentation?
Yeah, I mean, for sure, we are a local network, a community network. And so that is why we do have as a comparison set a lot of the companies that you mentioned, where we excel, number one, in retention. So our 3-month all the way to 2-year retention is head and shoulders above those peers. We're best in class. I think the second thing that we bring is a really unique audience. So we do show a chart in the presentation that shows that people who are coming to Nextdoor aren't visiting a lot of the other social media sites. So for advertisers, that unique audience is a way to get their message to people they can't reach any other way. But to your point, we are building overall a marketplace as well, right? We have aggregated all of these neighbors and neighborhoods around the world. They come to Nextdoor for utility and they come for community. But on the utility side, often it's to find the best plumber in that moment, right? Where you have a leaky faucet. Maybe it's to find the best cup of coffee because you've just moved into your new house and you're getting to know your neighborhood. So of course, that allows us to really speak to those local businesses. We've done a lot of investment in the last 2 years in building out a business platform, an ad platform for them. It's been incredibly successful, as you can see from our revenue growth rate. And so that does start to bring us into the zone of folks like Angie's List, Thumbtack, who are actually our customers because they come to Nextdoor to be able to put in front of our neighbors those pros that they have aggregated as well. So sometimes it's a first-party return. So a neighbor gives you that recommendation you really need. And then sometimes it's coming from a great customer of ours that can also help you get to that pro in your moment of need.
And you guys also talk about the TAM for the business has almost doubled globally. You see it doubling over the next couple of years. And I'm just curious how much maybe COVID-related mobility trends are driving that, or is it more just Facebook and Google clearly have a chokehold on the digital ad market, but with the growing market, there thus, it follows then that there is a larger opportunity for additional competitors if they can gain a toehold.
Yeah, so there's 2 ways we define TAM. There's the TAM just first of all of neighbors coming to the platform. And what we see there is Nextdoor has an inherent network effect, a true network effect, right? When you join the neighborhood just got better for everyone else on the network. And so we know that when we start in a younger neighborhood, we'll see good engagement. But when we get up into our top quartile neighborhoods, we see an over 2x improvement in engagement. And so what that's doing is driving the TAM of neighbors who can come to the platform. So there's really good growth there. And of course, international only further bolsters that. And then what you're getting to is the digital ad market. So there's not an advertiser that I speak to that isn't moving their spend online, right? Print, TV, just getting harder. With digital, you can really target your customer. And so Nextdoor is part of that shift to digital. Where we are unique is we are hyper local targeting. So whether you're the local mom and pop coffee shop or whether you're the largest retailers in the world, folks like Walmart, we can make sure that you're getting your message into the neighborhood, and often in a really hyper-local way. We can actually change the message in the app to recognize a neighborhood and maybe a piece of information that's particular to that neighborhood. So it's definitely helping drive our growth, and I think it's providing yet another new place for digital advertising to happen.
Sarah, it's Julie here. I want to ask you about content moderation, which I know has been a challenge for you guys, like it has been for most social networks. A little bit different for you guys because you do have that location attached to your users. And I know you have spent some resources on trying to fix, for example, some racist comments that had been in some of the discussions. So now that you're going to have more resources, what kind of efforts are you going to continue to put in or even ramp up when it comes to this area?
So this is a hugely important area, right? We have to earn trust every day. It's our number one core value. Nextdoor is really founded on trust. So remember, where we're different from other networks is, first of all, when you join, we confirm that you're a real neighbor in the real neighborhood. So we don't allow avatars and bots and people to have multiple usernames and so on. So what that does is it brings accountability. It's harder to be completely obnoxious when you know you might end up standing on the side of the soccer field with that same person. On top of that, we built out local moderation because we think it's important to have local context. But of course, technology also plays a part here. So we will invest in areas like machine learning and data science to make sure that we're catching content that may be inherently toxic in a neighborhood, right? We want to build out kindness.
All right, when we come back, this is a growing problem for small businesses attempting to get credit through the traditional sources, banks, and the bank's not supplying that credit. We're going to be speaking with the co-founder and co-CEO from Carrot Financial.
economy is changing with the rise of gig workers, also content creators. So our next guest, his company, Carrot Financial, it's catering to the evolving economy and doing something that he says traditional banks are starting to overlook. So we want to bring in Eric Way. He's a co-founder and co-CEO of Carrot Financial. And Eric, you launched Carrot after noticing this disconnect between traditional banks and how they viewed content creators, and I guess the line of credit that they were willing to extend to some of these creators. So talk to us just about what Carrot Financial does and what it does that traditional banks simply are not doing right now.
Absolutely. Thank you, Shauna and Adam. It's great to be here. So we've built the first and best business credit card for digital creators and influencers. They're actually one of the fastest growing SMB segments in the world right now. You can actually make a living by being a YouTuber, an Instagrammer, or TikToker. But the problem is the existing financial system and banks just don't get you. I previously worked at Instagram, where I built products for creators. I met many individuals there who had quickly fast growing revenue generating businesses who'd really struggle in catching up with banks and explaining to them what they do. In fact, just as an example, one of the creators I met and work with is named Alexandra Botes. She's a chess champion who live streams playing chess on Twitch with almost 1 million followers, makes a 6-figure income, previously went to Stanford, but she was rejected for a business credit card multiple times because financial institutions just had no understanding of what type of business that she is.
You raise a great point. You also point out you've got the Carrot Black card, an exclusive offer, and that the card holders of this instrument make over $500,000 a year. Is one of the reasons, though, that the traditional banks have overlooked this market, the problem that influencers come and go? The person making $500K today, next year may make bupkis.
We've seen on majority, our creators are stable and actually grow in income over time. And that's new and different for 2 reasons. The first is, to your point, being a content creator used to be much more sporadic of a career because there were no direct methods for you to create and distribute content to your audiences, right? You'd be dependent on middlemen, Hollywood agents, publishing houses, recording labels, and you'd need to hit an outsized celebrity status in order to succeed. What we see now, the creators we work with a sneakerhead down in North Carolina, a mom in Texas who posts photos of her dogs. You don't need to become a celebrity, the next Kim Kardashian, but with several 100,000 followers, you can post evergreen content and make a stable living out of that. And the second trend that we've noticed is because it's become way more open to everybody to make content and reach their audiences, we're seeing the new rise of a group of business savvy creators who think of their work as a business and are constantly considering how to diversify their revenue streams beyond just the content piece, using the distribution and trust they've built into other lines of business too.
Eric, what's your vetting process like in order just to identify creators that you're willing to work with?
We look at 2 primary things. The first thing is, just like any other business, we look at their financials. How much income they're generating, what's their cash on hand. The second is a leading indicator to their financials, we look at their social stats. The same way for bakery, you look at how many loaves of bread they're selling and how much people love their bread. For creators, we look at the number of followers they have, their reach, their engagement, how they monetize, how their fans react to them. And while both of these sound relatively simple, there are vast changes, improvements over what traditional banks use to value creditworthiness. And that's FICO. As both of you likely know, FICO was invented many years ago by 2 individuals named Mr. Fair and Mr. Isaac. FICO historically stood for the Fair and Isaac Company. It would be as if all of us today made the Adam and Shauna Company, and we were using that 70 years from now to underwrite cyborg surgeons. The point is, it's a heuristic that was developed years ago that hasn't caught up to new types of businesses we see in the world today. And that includes creators who, despite generating tremendous revenue and income, just are being underserved now.
I like your idea of the Adam and Shauna Company or Adam and Shauna Show. It will be around for 70 plus years. Very quickly, let's go off script here for a second. How many clients you got carrying the card?
So we work with a small group of top creators today that, to date, just in a year and a half of existence, we've processed double-digit millions of payments transaction volume for them so far.
How many?
So hundreds. We're planning with the Series A to scale this out to thousands. because we've seen the top creators we work with now have so gravitated and resonated with the product that many of them have invested and asked us to begin scaling this product out to earlier stage creators too, of which there are millions.
Eric Way, co-founder and co-CEO of Carrot Financial. We wish you all the best. We need to take a quick break. On the other side, a couple of important things to watch ahead of tomorrow's opening bell. We'll be right back.
All right, as we start to wrap things up, want to pay attention to what's coming down the pike Thursday. And Shauna, what you got your eye on?
Adam, I'm going to be keeping a close eye on jobless claims. We're going to get them out before the bell tomorrow. The estimate is for 350,000. That will be down from last week's 364,000. And also important to note that this would be a pandemic era low for the second week in a row. Last week's rating was also the lowest rating that we've gotten since the start of the pandemic. So we're seeing this trend lower after the brief jump up that we saw in the beginning of June. So we'll see whether or not that continues. And then, of course, what this could potentially mean for the jobs recovery going forward. How about you?
Well, we were just having that fascinating discussion with Eric Way regarding Carrot and consumer credit. And tomorrow we get the official monthly Federal Reserve G19, which is a fancy way of saying the consumer credit report. We're going to find out where all of us stand in the United States. That's 330 million of us, not only in total household wealth, but what's happening with consumer credit and consumer credit trends. Also important to point out to you, we had a Kiko on in the 3 o'clock hour talking about XPeng, and that's the electric vehicle maker in Hong Kong. Well, Brian Gu is the president and vice chairman. He's going to be on the Yahoo Finance platform at 9 a.m. Real quick, as we wrap up, let's show where markets ended today. And we were in the green. Dow was up 104 points. S&P 500 was up about 14 points. NASDAQ was up about 1.4 points. We will see you tomorrow. Have a wonderful evening, everybody.